Introduction. This is a tour of the things you can buy with money. Shares, bonds, funds, options, gold, foreign currency, structured notes, crypto. What each one is, how you would really buy it, and what it can do to you in a bad year. But it is built around a question you have probably never been taught to ask. The usual question is, will this go up? That is close to unanswerable, and everybody selling you something claims to have the answer. The question I want to put in its place is this: who profits from me holding this and how much? That one is answerable. It is written down in audited accounts and prospectuses and regulators' publications, and once you know where to look, you will never see a product the same way again. 3 ground rules. Everything here is sourced, and I will name the kind of source as I go. A regulator's own figures, a company's audited accounts, a peer-reviewed study, a trade body describing its own industry, and an issuer's marketing brochure are 5 different qualities of evidence. I will not blur them. Where a figure could not be verified, I will say so aloud and leave it out rather than guess. Fees, tax rates, and compensation limits are exactly the figures that confident-sounding writing invents, and exactly the ones that cause harm when they are wrong. And nothing in this series is financial advice. I do not know your circumstances. I am not recommending a product, a platform, or a portfolio to anyone. Now the honest part. You commissioned this in order to become an expert in trading. I want to handle that respectfully and plainly. Listening to this will make you literate. By the end, you should be able to read a term sheet, work out a fee drag in your head, and recognize the moments when you are not the customer but the counterparty. Plenty of people who work in finance would fail parts of that. It will not make you an expert trader. Nothing you listen to can. The best evidence available, from the complete trading records of an entire national stock market, finds that only about 1% of day traders can predictably profit after costs. That is peer-reviewed academic work by researchers with nothing to sell. We will look at it properly near the end. I raise it now, so that nothing in between sounds like a promise. Chapter 1 is the frame for all of it. Somebody is always on the other side. Chapter 1, who is on the other side? Start with something so obvious that almost nobody thinks about it. Every trade has 2 sides. When you buy a share, somebody sold it to you. They looked at the same price you did on the same day with the same information available, and they reached the opposite conclusion. That person is your counterparty. Counterparty simply means the party on the other side of your transaction, the one whose obligation is the mirror image of yours. You may be right and they may be wrong. It happens, but notice what has just been established. Your purchase was not an act of joining something, it was a disagreement priced. That is the small point. Here is the larger one, and it is the spine of this entire series. In most of what you will be sold, the institution arranging the transaction is not on either side of the disagreement. It is not betting against you, and it is not betting with you. It is taking a cut of the event itself. It earns if you are right, it earns if you are wrong, and in many cases it earns a little more if you do the whole thing again next month. Your outcome and its outcome are simply not connected. That is not a scandal, and it is not a conspiracy. It is the business model, it is disclosed, and it is entirely legal. But you cannot evaluate anything you are shown until you can see it. There are 3 ways money is made from you. Almost every fee in finance is one of these 3 wearing a different coat. The first is a spread. In any market, there is a highest price at which somebody is currently willing to buy, called the bid, and a lowest price at which somebody is currently willing to sell, called the offer or the ask. Those are 2 different numbers. The gap between them is the spread. If you buy something and sell it back 1 second later, with nothing at all having happened in the world, you are down by the spread. Nobody sends you an invoice. Nothing on your statement is labeled fee, but you paid. You already know what this feels like in one context. Walk into an airport currency booth and look at the board. It buys your pounds at one number and sells you euros at another, and the difference is how the booth pays its rent. It does not charge you a commission. It does not have to. The spread is the commission. Almost everything I am going to describe in this series is a version of that board. with better lighting. The second way is a fee, a stated percentage disclosed in a document charged on your money. This is the honest one, in the sense that it is at least written down somewhere you could in principle find it. What people underestimate is not its existence but its size, because a percentage does not feel like money. 1% a year on 100,000 is 1,000 a year. Every year, in the years you gain and in the years you lose. Say that sentence back to yourself in money rather than in percent, and it changes character completely. We will spend the whole of Chapter 3 on what that does over a lifetime, because the arithmetic is worse than almost anyone expects. The third way is a margin embedded in the price of a product, and this one is invisible by construction. Consider a structured note, which we will take apart properly much later. It is a bond issued by a bank, with a payoff defined by a formula linked to a share, an index, or a rate. The bank builds it out of components, roughly a bond plus some options. The bank sells you the assembled package at a single price. The difference between what you paid for the package and what the components cost the bank to assemble is the structuring margin. Now notice why that margin survives. It is not because the bank worked harder or took more risk. It is because you cannot price the pieces. To check the price of the option part of that package, you would need a derivatives pricing model and a volatility surface, which is to say, a professional trading desk. The margin exists because comparison is infeasible. That is the whole mechanism, and I want you to hold on to it because it generalizes. Margin is a function of price transparency, not of effort or of risk. There is one useful, checkable thing to say about those products even now. In several jurisdictions, the issuer is required to publish its own estimated value of the note, and that number is lower than the price you paid. The gap between the issue price and the issuer's own estimated value is the visible part of the margin. It is in the document. Almost nobody looks. Let me put some verified numbers on all of this, because otherwise it is just a posture. Take 3 of the most famous names in finance and read their audited annual accounts for the 2025 financial year, filed with the United States Securities and Exchange Commission. These are not estimates and not journalism. They are numbers a company's auditors signed. J.P. Morgan Chase reported total net revenue of $182.4 billion. Of that, $95.4 billion was net interest income. 52.3% of everything the largest bank in America earned came from the gap between what it earns on money and what it pays for money. Every fee, commission, and trading line the firm has, added together, came to $87 billion. The gap on money beat all of them combined. Look one level down and it becomes sharper. That year, J.P. Morgan took in $193.3 billion of interest income and paid out $97.9 billion of interest expense, of which only $45.1 billion went to depositors. The residual is the bank's. The depositor pays that, in the form of interest not received. There is no charge, there is no line item. The single largest revenue line in retail banking is invisible by construction, because it is a price you are not paid rather than a fee you are charged. That is also the answer to something customers find baffling. When a central bank raises rates, your mortgage rate moves quickly and your savings rate moves slowly. The lag is the revenue. Now Morgan Stanley, same year, same kind of filing. Total net revenues of $70.6 billion. Its single largest line was asset management at $25.1 billion or 35.6%. Net interest was only $10 billion. A wealth manager lives on charging a percentage of your money every year, regardless of what happens to it. And Goldman Sachs. Total net revenues of $58.3 billion, of which market making, the business of quoting a bid and an offer and keeping the difference, was just under $18 billion. 30.9%, its largest single line. Look at the stability of it across 3 very different market years. 18.2 billion, then 18.4 billion, then just under 18. The spread does not care which way the market went. 3 famous firms, 3 completely different answers to where the money comes from. A deposit bank lives on the interest spread. A wealth manager lives on percentage of assets fees. A dealer lives on the bid-offer spread. The customer experience of each is different, and so is what you should be watching. Now bring it closer to home, because the same three mechanisms operate inside an ordinary brokerage account. Charles Schwab, 2025, audited accounts. Total net revenues of $23.9 billion, of which net interest revenue was $11.75 billion. 49.1% for a firm most customers think of as a stockbroker rather than a bank. Set two of its numbers side by side. Schwab earned $15.5 billion of interest revenue that year and paid $244 million of interest on what it owes its brokerage clients. That is the business. Idle cash in an account is swept into deposits, the short-term rate is earned on it, and a much smaller rate, sometimes nearly nothing, is paid to the person whose cash it is. Robinhood discloses it even more plainly. In its audited accounts, there is a line literally labeled cash sweep, worth $229 million in 2025, up from $179 million the year before. When a company names the line in its own accounts, the practice is not a secret. It is simply unread. One more from that same filing, and it is the most instructive number in this chapter. Robinhood's total net revenues were $4.47 billion, of which transaction-based revenue, the money it earns from orders being routed, was $2.63 billion. 58.8% at a broker that charges no commission. Within that, options generated $1.12 billion and equities $302 million. Options produced roughly 3.5 times the revenue of ordinary share trading. That is the clean commercial explanation for why a zero-commission app puts options and crypto in front of you and buries the boring index fund 3 menus down. The product that is promoted hardest is the product that pays the platform most. No conspiracy is required, just an income statement. Which brings me to the thesis of this series, stated now so that you can spend 20-odd chapters testing it against the evidence rather than taking my word for it. The industry earns least from the products that serve customers best, and most from the products that are hardest to price. Plain, broad, transparent index exposure is nearly free because it is easy to compare and viciously competitive. Complexity is where the margin lives. Structured products, leveraged wrappers, bespoke derivatives, retail currency conversion. Not because those products are harder to run, but because you cannot check the price. That is a claim, not a fact, and it is falsifiable. If an instrument contradicts it, I will say so out loud when we get there. There are places where complexity genuinely earns its keep, and I will name them. To keep this honest, every instrument chapter from here answers the same 6 questions in the same order. What it actually is in plain language, how you would really buy or trade it, and the frictions you will really meet. The risks, including the ones that only appear in bad conditions. The genuine upside, stated fairly. How to decide whether it belongs anywhere near you. And last, always last, how the bank, the broker, the issuer, or the manager earns from it, and roughly how much. Nothing here is financial advice. It is a set of axes to think along, not a decision to copy. Before we can follow the money through any particular product, you need to see the machinery it flows through. So Chapter 2 is the plumbing. What actually happens between the moment you press buy and the moment the thing is genuinely yours, and why the most commonly misunderstood instruction in retail investing, the stop loss, is a request rather than a promise. Chapter 2, how a trade actually happens. Most people carry the same mental model of buying a share. There is a price, I pay it, I own the thing. That model is wrong in a way that costs money, and replacing it is the most useful half hour in this series. The accurate model goes like this. There is no single price. There is a highest price somebody is currently willing to pay, and a lowest price somebody is currently willing to accept, and those are 2 different numbers. When you buy at the market price, you are crossing the gap between them, and the gap is a cost you pay without ever seeing an invoice. The highest price somebody will pay is called the bid. That is the price you get if you sell right now. The lowest price somebody will accept is the offer or the ask. That is the price you pay if you buy right now. The difference between them is the spread. It is the market's charge for immediacy, for letting you trade this instant rather than waiting for somebody who naturally wants the other side. Between the bid and the offer sits the mid, the halfway point. That is the number financial websites usually display, and it is a price at which nobody has agreed to trade. The price you see quoted is often a fiction of convenience. Now the idea almost nobody is taught, and it matters enormously later. Depth. Depth is how much size is available at each price level. A share can have a very tight spread for 100 shares and a terrible one for 100,000, because after the first few hundred, there is nobody left at that price, and you have to reach further out to find willing sellers. Which gives us the working definition of liquidity for this whole series. Liquidity is how easily something can be turned into cash at a price close to the last one quoted, and it is a function of size, not a property of the security. Nothing is liquid in the abstract. It is liquid for an amount at a moment. The word for what happens when you find that out the hard way is slippage. Slippage is the difference between the price you expected and the price you actually got. It has two sources. The market moved between your decision and your execution, or your own order was large enough to eat through the available depth and push the price against you. Now, order types, which is how you actually express what you want. A market order, in the words of the American Securities and Exchange Commission's own investor education material, is an order to buy or sell a security immediately. It guarantees that the order will be executed, but does not guarantee the execution price. A limit order, again in the regulator's words, is an order to buy or sell at a specific price or better. A buy limit can only be executed at your limit price or lower. A sell limit only at your limit price or higher. You have taken control of the price and given up the certainty of trading at all. A stop order, often called a stop loss, is an order to buy or sell once the price reaches a level you specify, known as the stop price. And here is the sentence that matters more than any other in this chapter, quoted exactly. When the stop price is reached, a stop order becomes a market order. Chain those two regulator sentences together and see what falls out. A stop order, once triggered, becomes a market order. A market order guarantees execution, but not price. Therefore, a triggered stop guarantees that you get out, and guarantees nothing whatever about the price you get out at. Your stop loss is a request, not a promise. If a share gaps, meaning it falls straight through your level with no trading in between, which is exactly what happens on bad news, on an overnight move, or in a fast market, then your order triggers and fills at whatever the next available bid happens to be. That can be far below the number you chose. The intuition to keep. A stop loss protects you from walking down the stairs. It does not protect you from falling out of the window. There is a fourth type, the stop limit, which once triggered becomes a limit order rather than a market order. I should tell you that I could not verify a regulator's own wording for that one, so treat the mechanism as standard market practice rather than as a quotation. And understand the trade you are making. A plain stop will almost certainly get you out at an unknown price. A stop limit controls your price but may leave you not out at all, sitting unfilled while the position keeps falling. You have swapped price risk for the risk of still owning the thing. There is no order type that gives you both. That is my opinion, and it is falsifiable, so test it. Anybody who implies otherwise is selling you something. Now the distinction that matters more than any of this, and that almost never gets explained to retail investors. There are two completely different architectures for trading, and which one you are in determines what protections you actually have. The first is an exchange, sometimes called an order-driven market. Many buyers and sellers post their orders into a central book, and the exchange matches them by price and by time. Prices are public. The rules are uniform. You are usually trading against another investor, and a commission, if any, is charged to you separately and visibly. The second is an over-the-counter market, also called a dealer market or a quote-driven market. There is no central book. You trade with a dealer, who quotes you a price and takes the other side of your trade onto their own balance sheet. Their profit is the spread. There is no public price to check the quote against. Most bond trading works this way. Most foreign exchange works this way. Most structured product trading works this way. Between them, that is a very large share of what will ever be sold to an individual. Here is the consequence, and I want to state it as bluntly as I can. In a dealer market, the spread is the fee. There is usually no commission at all, which means that if somebody tells you bond trading is commission-free, they have told you the opposite of cheap. Retail bond buyers are, in my judgment, the most exposed group in this entire series, because they typically cannot see the spread, pay no visible commission, and hold to maturity, so they never discover what the round trip cost them. The scale of the largest dealer market is worth hearing. The Bank for International Settlements runs a survey of central banks every 3 years. In April of 2025, turnover in over-the-counter foreign exchange reached $9.6 trillion a day, up 28% from $7.5 trillion a day 3 years earlier. In that ocean, non-financial customers, which is to say ordinary businesses and people, account for just 5% of turnover, and they are charged the widest spread of anyone in it. Price discrimination by segment is not an abuse of the retail currency business. It is the retail currency business. The firms that quote those two-sided prices are called market makers. A market maker stands ready to buy and to sell continuously and takes the risk of holding inventory in between. A market maker is not doing you a favor and is not cheating you. They are selling you immediacy, and the spread is the price of it. Which raises the question of where your order actually goes, not, as most people assume, to the market. Your broker chooses a destination. The regulator lists the options plainly. Route it to an exchange. Route it to a market maker. Route it to an electronic communications network, which automatically matches buy and sell orders. Or, in the regulator's own words, send your order to another division of your broker's firm to be filled out of the firm's own inventory. That last one is called internalization, and it means your counterparty is your broker. And some market makers, again quoting the regulator, will pay your broker for routing your order to them, perhaps a penny or more per share. That is called payment for order flow. It is the answer to how a broker can be free. It is not free. The revenue comes from a payment made by the firm that ends up on the other side of your trade. Why would anyone pay for the privilege? Because retail orders are, in the trade's own language, uninformed. Somebody buying 40 shares is very unlikely to know something the market maker does not. Trading against that is far safer than trading against an institution halfway through a large, informed order. You are not the customer in that arrangement. You are the safe side of somebody else's trade. The fair counter-argument, which I will give because the chapter is worthless without it. Defenders point out that wholesale market makers often execute retail orders inside the publicly quoted spread, giving you a slightly better price than the exchange would, and that this practice funded the collapse of retail commissions to zero. Critics point out that the improvement is measured against a benchmark the customer cannot audit, and that routing to whoever pays most is a structural conflict. Both of those can be true at once, and I think they are. You got a real benefit, zero commission, paid for in a currency you cannot measure, execution quality. So what does best execution actually oblige? In the United States, the brokerage industry's self-regulatory body has a best execution rule, and its core duty is that a firm must use reasonable diligence to ascertain the best market for the security and buy or sell in such market, so that the resultant price to the customer is as favorable as possible. Firms must conduct regular and rigorous reviews of execution quality, security by security, at minimum quarterly, and the duty cannot be handed off to somebody else. Now read the words again: reasonable diligence, reasonably available, periodically assess, in the aggregate. Best execution is a process standard, not an outcome guarantee. It obliges a firm to run a defensible process across all its customers. It does not promise that your particular order got the best price available anywhere at that instant. And on price improvement, the regulator is explicit. It is the opportunity, but not the guarantee, for an order to be executed at a better price. It even warns that the extra time some venues take may result in you getting a worse price than the current quote. Then there is settlement, which is when the trade actually becomes yours. The trade date is when you agree the price. The settlement date is when cash and securities genuinely change hands. In between, you hold a contract, not the asset. The European Securities and Markets Authority has recommended the fourth quarter of 2027, and specifically the 11th of October, as the optimal date for the European Union to move to settlement 1 business day after the trade. The United States has already shortened to a 1 business day cycle, though I could not verify the exact date and rule reference against the regulator's own site, so I am not going to give you one. Why care at all? Because settlement timing determines when cash from a sale is actually spendable, whether you are the holder of record for a dividend or a vote, and whether you trip the rules against spending money that has not yet arrived. Last piece of plumbing, because it explains a great deal later. Short selling, the regulator's definition. A short sale occurs when you sell stock you do not own. If the price drops, you buy it back lower and profit. If it rises, you buy it back higher and lose. Mechanically, you borrow the share, typically from a lending pool. You sell it and receive cash. You post collateral and pay a borrow fee for every day you hold the position. To close, you buy the share back and return it. 4 asymmetries make this a different animal from buying. If you buy, the worst case is 0 and you lose everything you put in. If you short, there is no ceiling on the price, so there is no arithmetic limit on the loss. Second, waiting costs money, because the borrow fee accrues daily and hard-to-borrow shares are expensive. Being right eventually can still lose. Third, you can be forced out, because the lender can recall the shares and your broker will buy them back on your behalf at whatever the price then is. Fourth, any dividend paid while you are short is your liability to the lender. A short squeeze is those asymmetries meeting a rising price. Losses force short sellers to close. Closing a short means buying. That buying pushes the price higher, which forces more shorts to close. The fuel is that short covering is price-insensitive buying. Nobody is buying because it looks cheap. They are buying because they must. You now know how the machinery works. Chapter 3 is about the one cost that is not hidden anywhere, that you can compute in advance, and that almost everybody still gets wrong by a factor of 10. The fee. Chapter 3, the fee drag. This is the highest value chapter in the series, and there is nothing clever in it. It is arithmetic. Every number I am about to give you is reproducible on the back of an envelope, and none of it depends on a forecast, a market view, or anything I believe. Start with a piece of vocabulary you will hear constantly and that nobody ever bothers to define. A basis point is 1/100th of 1%. So 100 basis points is 1%, 20 basis points is 1/5 of 1%, and 5 basis points is 1/20th of 1%. The reason the industry talks in basis points is that it is a precise unit. The effect, whether intended or not, is that costs get discussed in a scale that sounds tiny. Second piece of vocabulary. The ongoing charge, sometimes called the expense ratio, sometimes the total expense ratio, sometimes the ongoing charges figure. Different names, same idea. It is the annual percentage the fund deducts from its own assets to cover the manager's fee plus the fund's running costs. And here is the thing to remember about it. It is charged on your balance, not on your gain. The manager is paid exactly the same in a year the fund loses 30% as in a year it gains 30%. In a rising market, the manager's revenue rises automatically, with no additional skill and no additional work. One more. Net asset value, usually shortened to NAV, it is the total value of everything the fund holds, divided by the number of units in issue. That is what one slice of the pot is worth. Fees are deducted before that number is struck, which is exactly why the deduction never appears on your statement as a loss. Now the arithmetic. I am going to be explicit about the assumptions, because that is the difference between a demonstration and a sales pitch. 10,000 invested as a single lump sum. a gross return of 7% a year. The fee taken out of that return each year. No tax, no inflation, no further contributions. The currency does not matter because the result is proportional, so read it in whatever you like. And the 7% is a round, illustrative figure. It is not a forecast, it is not sourced to any dataset, and the shape of the answer does not depend on it. Over 20 years, at a fee of 0.1% a year, 10,000 becomes 37,980. At 1% a year, it becomes 32,071. Sit with that. The difference between those two fees is 0.9%, which sounds like nothing. Over 20 years, it is 5,909. You have lost 15.6% of the cheap outcome. The cheap investor's pot is 1.18 times the expensive investor's pot, and both of them own the same market and took the same risk. Extend it. Over 30 years, the same two fees give you 74,017 against 57,435. A gap of 16,582, or 22.4% of the cheap pot. Over 40 years, 144,247 against 102,857. A gap of 41,390, or 28.7%. Notice what happens as the horizon stretches. The gap is not growing steadily. It is accelerating. The fee is charged on the balance, which grows and charged every single year, so you also lose all future growth on every unit previously taken. Fees compound exactly like returns, just in the wrong direction, and unlike returns, they are guaranteed. Now here is the framing that I think actually lands, because most people cannot feel a percentage of a pot, but everybody can feel a share of what they made. Express the fee as a share of the gain rather than of the balance. 20 years, 7% gross, 10,000 in. At 0.1% a year, you end with 37,980. Your gain is 27,980. Fees took 717, which is 2.5% of the gross gain. At 1% a year, you end with 32,071. Your gain is 22,071. Fees took 6,625, which is 23.1% of the gross gain. At 2% a year, you end with 26,533. Your gain is 16,533. Fees took 12,164, which is 42.4% of the gross gain. That is the sentence to keep. 2% a year does not sound like much. Over 20 years, it is not 2% of your money. It is roughly 42% of everything you made, taken by somebody who put up none of the capital and bore none of the risk. That is not opinion. It is my own arithmetic, and you have the assumptions, so you can check it. Now, what is the 2% actually made of? The mistake almost everyone makes is to look at one number and think they have found the cost. Here is the stack you will really pay, layer by layer. Layer 1, the initial charge, also called a sales charge or a front-end load. A percentage taken off the top before anything is invested. Layer 2, the ongoing charge or expense ratio, deducted annually from the fund's assets. Layer 3, the platform or custody fee charged by the intermediary that holds the account. That is separate from the fund and is not in the fund's number. Layer 4, the transaction spread. In a dual-priced fund, you buy at the higher offer price and sell at the lower bid price, and the gap is retained in favor of the fund. In an exchange-traded product, you cross a bid-ask spread every time you deal. Either way, nothing on your statement calls it a fee. Layer 5, the fund's own dealing costs, incurred when the manager buys and sells inside the fund. Those are borne by you and are not in the headline number. Layer 6, foreign exchange conversion, taken every time money crosses a currency, including on every foreign dividend that arrives. Invisible, because it simply makes the return slightly lower than it should have been. And Layer 7, which is the one I want to spend real time on. Trailer commission, also called a retrocession. This is a slice of the annual management fee that is paid onward every year to whoever sold you the fund. For this, I am going to use Singapore's figures, because the National Financial Education Program, run by the Monetary Authority of Singapore, publishes the whole stack openly, more openly than most regulators do. Everything in the next paragraph is the regulator's own published range, and it applies to Singapore, as at 2026. The initial sales charge ranges from 1.5% to 5% of your investment. The redemption fee ranges from 1% to 5%. A switching fee is typically about 1%. The management fee is 1% to 2% a year for an actively managed fund and below 1% for a passive one. The platform fee runs from nothing to 0.3% a year. A wrap account adds 2% to 3% upfront and about 1% a year on top. And the total expense ratio, the regulator says, is usually between 1% and 2.5% of the fund's net asset value. Now the trailer. The regulator states plainly that the trailer fee paid to the distributor is 20% to 60% of the management fee. Run that through. On a 1% management fee, the bank or advisor that sold you the fund receives between 0.2% and 0.6% of your assets every year. On a 2% management fee, they receive between 0.4% and 1.2% of your assets every year. That arithmetic is mine on the regulator's published ranges. Every year, for as long as you hold it, whether or not they ever speak to you again. That is the mechanism that determines which funds get recommended. Nobody has to be dishonest. If one product pays the person in front of you 0.6% a year forever and another pays them nothing, you do not need a conspiracy to predict which one gets mentioned. Jurisdiction changes this completely, which is why I keep naming it. In the United Kingdom, the Retail Distribution Review removed commission from providers to advisors, in force from the 31st of December 2012. In the European Union, the Second Markets in Financial Instruments Directive, in force from the 3rd of January 2018, prohibits inducements for independent advice and for portfolio management. Note the limit on that. It is not a blanket ban, which is why retrocessions persist for non-independent advice in much of continental Europe. Singapore has not banned trailers. Same product, same manager, radically different incentives depending on which side of a border you buy it. For the United States, the best fee data comes from the fund industry's own trade association, and I want you to hold that in mind while you hear the numbers, because the framing of their reports is relentlessly favorable to their members. The numbers themselves are built on solid data. Use the numbers, discard the spin. On that source, for 2025, weighted by assets, actively managed equity mutual funds averaged 0.64% a year. Index equity mutual funds averaged 0.05%. Index equity exchange-traded funds, 0.14. Index bond exchange-traded funds, 0.09. But averages weighted by assets flatter the picture, because money concentrates in the cheap funds. The spread across funds is the number that matters if you are choosing one. Among United States equity mutual funds that year, the cheapest 10th charged 0.51%, the median charged 0.99, and the most expensive 10th charged 1.84%. And here is the most useful defensive fact in this chapter. Among index equity mutual funds, the cheapest 10th charged 0.04%, and the most expensive 10th charged 1.49%. Index funds charging 1.5% exist, and they are sold. The word index on the label is not a guarantee of low cost. An expensive index fund is, in my opinion, the worst product in retail finance, because you get index returns at active prices with no possibility of a manager's skill making up the difference. 2 more pieces of arithmetic, and then the habit I actually want you to take away. The first will contradict your instincts. Entry charges are less damaging than they feel, and ongoing charges are far more damaging than they feel. A 5% front-end load on 10,000 costs you $1,604 over 20 years at 6% net. It is recovered at 6% in under 11 months. Meanwhile, 1% a year for 20 years costs $5,909. The scary-looking one-off number is the smaller problem. Most people have this exactly backwards. The second stacks the whole thing up. 20 years, 7% gross, 10,000 in. A bank-sold active fund at the top of the published Singapore ranges, 5% initial charge and a 2.5% total expense ratio, leaves you with 22,911. The cheapest broad index tracker, all in at about 0.05%, leaves you with 38,337. The cheap one ends with 1.67 times the expensive one. Over 30 years, that ratio widens to 2.11 times. Identical exposure, identical risk, identical markets. I should say clearly what I am not claiming. You will hear a very widely quoted statistic about the share of active funds that lag their benchmark over 20 years. I could not verify that figure against its original source, so I am not going to repeat it. Be skeptical of anyone who quotes it without naming the scorecard and the year. So here is the habit, and it is one question. Ask what the all-in annual cost is in money, not in percentages. Say it exactly like that. On the amount I am investing in currency per year, what is the total, including the fund's charge, the platform's charge, any advisor payment, and anything paid to you or your firm by the product provider? Percentages are designed to sound small. Money is not. 0.05% on 100,000 is 50 a year. 1% is 1,000 a year. 2.5% is 2,500 a year. Same portfolio, same risk, same market. You cannot control returns. You can control costs, and costs compound just as ruthlessly as returns do, but with certainty. Nothing here is advice. It is arithmetic, and the assumptions are on the table. Next, we turn that arithmetic on the most widely sold investment product in the world, the unit trust and the mutual fund, and look at who is paid a share of what you are charged. Chapter 4: Unit Trusts and Mutual Funds. If you live in London, Singapore, Sydney, or Johannesburg, sooner or later somebody will offer you a unit trust. If you live in Chicago, somebody will offer you a mutual fund. You could be forgiven for assuming these are two different products. They are not. Underneath the names there is one mechanism, and it fits in a sentence. Many people put money into one pot. A professional manager buys securities with the pot. Each person owns a proportional slice of whatever the pot holds. The value of your slice is the value of everything in the pot divided by the number of slices. That number has a name you will meet constantly. Net asset value, usually shortened to NAV, nothing more mysterious than that. So why the different names? Legal history, tax law, and above all, distribution economics. Not because one is better for you. In Britain, there was a mature law of trusts, so pooled investment was built as a trust. A trust has a trustee who is the legal owner of the assets, a manager appointed under a document called the trust deed who decides what to buy, and unit holders, you, who are the beneficial owners. The manager does not hold your assets. The trustee does. If the manager fails, the assets are not the manager's to lose. That is a real structural safety feature. The United States built its regime around a statute, the Investment Company Act of 1940, and around the corporate form. So an American meets a mutual fund, which the Securities and Exchange Commission defines as a registered open-end investment company that pools money from many investors. Legally, it is a company, and you are a shareholder rather than a unit holder. Britain has since largely migrated to its own corporate version, the open-ended investment company, with an independent depositary, usually a bank, holding legal title in place of the trustee. Same economics, different skin. There is also a European regime called UCITS, which is a passport rather than a legal form. A fund authorized in one member state can be sold across the others. I will be straight with you. The specific UCITS rules that get widely quoted, the diversification limits, and the derivative counterparty caps, I could not verify against the directive text, so I am not going to recite them to you as fact. Now, how you actually buy one. You do not trade a unit trust or a mutual fund on an exchange. You place an order with a distributor, a bank, an insurer, an independent advisor, an online platform, and it is executed at the next valuation point, typically once a day at market close. This is called forward pricing, and the consequence is blunt. You do not know the price when you place the order. You are agreeing to buy at a number that has not been calculated yet. That is not a scandal. It is how a fund that must issue and cancel units fairly has to work. But it is the sharpest practical difference from an exchange-traded fund, and nobody explains it at the point of sale. There is a second pricing quirk in traditional unit trusts, and it is a fee that does not look like a fee: dual pricing. The fund quotes two prices. You buy at the higher offer price and sell at the lower bid price. The gap is retained in favor of the fund. Reference material puts these spreads at anything from a few hundredths of a percent on liquid government bonds to 5% or more on assets that are hard to trade, such as property. Treat that 5% as illustrative rather than regulator confirmed. The takeaway stands. In a dual-priced fund, you can be down several percent the instant you buy, before the market has moved at all, and nothing on your statement is labeled as a charge. Which brings us to the fee stack. There is not one fee. There is a stack of them, charged by different parties, disclosed in different documents, and some never appear as a line item anywhere you will look. The most complete published set I found comes from Money Sense, which is Singapore's national financial education program, led by the Monetary Authority of Singapore. That is a regulator source and unusually candid. These figures are Singapore, as at August 2026. The subscription or initial sales charge ranges from 1.5 to 5% of your investment, and it goes to the distributor. The redemption fee ranges from 1 to 5%. A switching fee, for moving between funds from the same manager, is typically about 1%. A wrap account charges about 2 to 3% upfront. Annually, the management fee for an actively managed fund runs 1 to 2% a year, and below 1% for a passive one. The platform fee runs from nothing to 0.3% a year. A wrap fee is about 1% a year. And the total expense ratio, the aggregate annual cost figure, usually sits between 1 and 2.5% of net asset value. A word on units. A basis point is 1/100th of 1%, so 100 basis points is 1%. Fund people speak in basis points because it makes large charges sound small. Now the number that is the heart of this chapter. Money Sense states plainly that the trailer fee paid to the distributor is 20 to 60% of the management fee, not 20 to 60% of the first year. Every year, for as long as you hold it. Run the arithmetic. On a management fee of 1%, the person who sold you the fund receives between 0.2 and 0.6% of your assets annually. On a 2% fee, between 0.4 and 1.2% annually. On $100,000 at the top of that range, that is $1,200 a year going to the seller. Every year, whether or not they ever speak to you again. Sit with the incentive that creates. A fund with a 2% management fee pays the seller roughly twice what a fund with a 1% management fee pays. So the person recommending a fund to you is, structurally, paid more for recommending the expensive one. That is not fraud. It is disclosed in the prospectus. It is the standard business model across much of Asia and continental Europe. But you cannot evaluate advice without knowing it, and it is almost never mentioned in the conversation where it matters. 2 jurisdictions decided this was intolerable. In the United Kingdom, the Retail Distribution Review took effect on the 31st of December 2012, removing commission from providers to advisors and requiring advisors to charge clients explicitly. In the European Union, MiFID II, effective the 3rd of January 2018, prohibited inducements for independent advice and portfolio management. Note the scope limit. It was not a blanket ban for non-independent advice, which is why these payments persist in much of Europe. The honest counterpoint. Banning commission makes advice something you must pay for out of pocket, which prices smaller investors out of getting any. Whether that trade was net good for ordinary savers is genuinely contested, and I could not obtain the regulator's own evidence, so I will not pretend to settle it. The United States took a third path. Data from the Investment Company Institute, weigh this correctly, the ICI is the American Fund Industry's own trade association, so use its numbers and discard its framing, shows the load model dying. In 2025, 92% of gross sales of long-term mutual funds went to no-load funds without distribution fees, against 46% in the year 2000. But the money did not go away. It moved sideways. The ICI itself says compensation shifted toward asset-based fees, paid either through the fund's distribution fee or directly out of pocket to the financial professional, in which case, in their words, it is not included in the fund's expense ratio. Read that clause again. A growing share of what American investors pay their advisor is now invisible in every fee statistic anyone quotes at you. Here are the American cost levels, asset-weighted, for 2025. Equity mutual funds overall, 0.40%. Actively managed equity mutual funds, 0.64%. Index equity mutual funds, 0.05%, 5 basis points. But averages conceal what will actually happen to you because money concentrates in the cheap funds. The dispersion is what matters. Among American equity mutual funds, the cheapest 10th charged 0.51%, the median 0.99%, and the most expensive 10th 1.84%. Among index equity mutual funds, supposedly the cheap ones, the most expensive 10th charged 1.49%. Index funds charging nearly 1.5% exist, and they are sold. The word index on a label is not a guarantee of low cost. One more American peculiarity worth knowing: share classes. The identical portfolio is sold as Class A with a front-end load, Class B with a charge that bites if you leave early, Class C with a high ongoing distribution fee, and Class I for institutions, cheap with high minimums. Same investments, 4 costumes, 4 prices. The fee is a function of the sales channel, not of the investment. So, is active management worth paying for? Before any data, there is an argument that is a proof rather than a finding, generally attributed to the economist William Sharpe. All investors collectively own the whole market, so their combined return before costs must equal the market return. Passive investors get the market return by construction. Therefore, active investors, in aggregate, before costs, must also get exactly the market return. Active management costs more. Therefore, active investors in aggregate must underperform passive investors after costs. Necessarily. Always. That is arithmetic about averages. It does not say no manager can beat the market, some obviously do. It says every pound of outperformance is matched by a pound of underperformance held by another active investor, and the whole group pays more for the privilege. On the empirical side, I am going to be careful, because you have probably heard a very famous number that I could not verify. You will be told that around 90% of active funds underperform over 20 years. I could not confirm that figure against its primary source, so I am not going to assert it. What I can tell you is verified. In the first half of 2025, 54% of actively managed large-cap United States equity funds lagged their benchmark index. A 2021 academic study by Barras and colleagues found the average active manager earns a positive gross return above benchmark of 0.71%, which becomes minus 0.4% after costs. That is a more interesting story than managers being useless. It says some do add value and then hand all of it and more to themselves. Morningstar, a research firm, reported in October 2025 that one-year outperformance is a poor predictor of future outperformance. And there is a 60-year academic chain, Jensen in 1968, Malkiel in 1995, Elton, Gruber and Blake in 1996, Fama and French in 2010, different authors, different data, no commercial stake, all pointing the same way. Name the conflicts. The most cited evidence that indexing wins is published by an index provider that licenses indices to index funds and is paid by them. That does not make it wrong. Its method is public and independent academics corroborate it. but you deserve to know who signs the check. And learn one mechanism that makes every performance table you will ever see lie upward: survivorship bias. A fund company launches many funds. Some do well, some badly. The bad ones are quietly closed or merged into better-performing siblings, and their records vanish from the database. Anyone who later asks how this company's funds performed sees only the survivors. That is not fraud. It is how product ranges and databases work. It means the average performance of funds that still exist is systematically better than the average experience of the people who invested. Look for the phrase, corrected for survivorship bias. Its absence tells you something. The genuine upside, stated fairly. For a small sum, you get real diversification, professional custody, audited record keeping, segregated assets held by a trustee or depositary, fractional units so a monthly standing order works cleanly, and access to markets you could not practically reach alone. For many people, the alternative is not a cheap tracker. It is nothing at all. How to decide whether one belongs near you. What is the total annual cost? Expense ratio plus platform fee plus any entry charge, not the headline management fee. Is there a cheaper index version of the same exposure, and what argument justifies the difference? Do you know what it holds, or is it a closet tracker charging active prices for index-shaped holdings? Does its daily dealing match the liquidity of what it owns? A daily dealing property fund promises something it cannot always deliver, and such funds have historically been suspended. And finally, who is recommending this and how are they paid? Ask it out loud. None of this is financial advice. Next, the wrapper the industry earns least from, and why that is not a coincidence. Chapter 5: ETFs and Index Funds. The spine of this book is, follow the money, find out who profits from you holding a thing. Almost everywhere, that leads somewhere uncomfortable. Here it does not. This is the product the financial industry earns least from, and the reason it earns least is precisely the reason it works. Start with the words because two of them get conflated constantly. An exchange-traded fund, ETF, is a pooled fund whose shares are listed and traded on a stock exchange, like a share. That describes the wrapper, the container, and how you get in and out. An index fund is something else. It describes the strategy inside the container. A fund that tries to replicate the return of a specified index by holding all or a representative sample of the securities in it. You can have an index unit trust, an index mutual fund, an index ETF, and equally an actively managed ETF. Those were about 11% of United States ETF assets at the end of 2025, on the fund industry's own figures. Wrapper and strategy are separate choices, and conflating them is the commonest beginner error. Legally, a United States ETF is usually the same animal as a mutual fund, registered under the Investment Company Act of 1940. In Europe, it is typically a UCITS fund. What differs is not the law. It is the plumbing, and that plumbing is what makes the price you see trustworthy. With a unit trust, when you buy, the fund issues new units and takes your cash. With an ETF, you do not deal with the fund at all. You buy existing shares on an exchange from whoever is selling. So how does the price stay tethered to the value of what the fund owns? Through creation and redemption. Large broker-dealers called authorized participants go directly to the fund issuer and create or redeem ETF shares in large blocks, generally 50,000 shares, called a creation unit, and crucially they do it in kind, swapping the actual underlying securities for ETF shares rather than using cash. Here is why that matters. Suppose the ETF starts trading above the value of the securities it holds. An authorized participant buys the underlying securities, hands them to the fund, receives new ETF shares, and sells them at the higher price. That selling pushes the price back down. Now suppose the ETF trades below the value of its holdings. The participant buys cheap ETF shares, redeems them with the fund for the more valuable underlying securities, and sells those. That buying pushes the price back up. Nobody is doing you a favor. A profit-seeking firm is arbitraging a gap, and the byproduct is that the market price stays close to net asset value. net asset value being the value of everything the fund owns, divided by the number of shares. Note the hedge in that sentence. Close to, not equal to. The source describes the mechanism as designed to keep the fund trading close to net asset value, although deviations can occur. The arbitrage depends entirely on the participants being able and willing to trade the underlying. When the underlying market is closed, you are trading a Japanese equity fund in New York at 2 in the afternoon, or when it is seizing up, as bond markets periodically do, the gap can widen materially. That is called trading at a premium or a discount. It is not a defect being hidden from you. It is a known property of the design. But it means an ETF of illiquid assets deserves far more skepticism than one holding blue-chip shares. There is a second consequence of the in-kind mechanism, and it is jurisdiction-specific. Because redemptions happen in kind, the fund can pass out its lowest-cost holdings without triggering a taxable sale inside the fund. In the United States, that makes ETFs meaningfully more tax-efficient than mutual funds. In a British tax-sheltered account, or in Singapore where there is no capital gains tax, the advantage ranges from muted to irrelevant. Do not let an American framing leak into a claim about your own situation. Now, physical versus synthetic. This is where an ETF can contain a risk you did not think you were taking. The regulator source here is MoneySense, the monetary authority of Singapore's education program, and these rules are Singapore as at August 2026. The structures are the same in Europe, where synthetic funds are common, and rarer in the United States. A physical ETF actually owns the assets in the index, either all of them or a sample. A synthetic ETF does not own them. It uses derivatives to replicate the index return. In an unfunded swap structure, the fund holds a basket of securities. And here is the sentence to remember. That basket is potentially unrelated to the index it tracks, and swaps that basket's return with a counterparty in exchange for the index return. In a funded swap structure, the fund passes its cash to a swap counterparty, which pays the index return and posts collateral. In both, the Monetary Authority of Singapore states that net exposure to the counterparty is capped at 10% of net asset value. A third form, access products, uses instruments such as participatory notes for restricted markets like China or India. The risks, in the regulator's own words. Counterparty risk. The counterparty's default can cause losses regardless of index performance. Read that again. In a synthetic fund, you are exposed not only to the market you chose, but to the solvency of a bank you never chose and cannot name. Collateral risk. The composition of the collateral held may have no bearing to the investment objective. You may believe you own Asian equities and discover, at the worst moment, that what secures your position is an unrelated basket of something else. And concentration risk, with a systemic wrinkle, the swap counterparty is very often a bank affiliated with the fund's own sponsor. Synthetic structures are not sinister by nature. Swaps can track certain indices more tightly and cheaply than physical holdings, particularly where a market is hard to access or where withholding tax on dividends is punitive. A genuine engineering solution with a genuine new risk attached. But note this. On the Singapore Exchange, synthetic ETFs are tagged with an X beside the trading name. A regulator considered this material enough to mandate a letter in the ticker. That is the strongest possible evidence that the distinction is not a technicality. For a mainstream liquid market, there is rarely a good reason to accept counterparty risk, and where a fund is synthetic, that is a signal to ask why. 2 more terms, and they will make you better than most retail investors at reading a fact sheet. Tracking difference is the actual performance gap, how far behind or ahead the fund finished. Tracking error is how much the fund wobbles around the index. Tracking difference is what you get. Tracking error is how reliably you get it. A fund can have tiny tracking error and still lag by 0.5% every year. That is a beautifully run tracker of an expensive fund. Look at tracking difference over 3 to 5 years. Then there is the cost a unit trust does not have. Because you buy an ETF on an exchange, You pay a broker commission and you cross the bid-ask spread, the gap between the price at which you can immediately sell and the price at which you can immediately buy. You buy at the higher and sell at the lower, so the instant you buy you are already down by the spread. Nobody itemizes it. I could not source reliable figures for typical ETF spreads, so I will not invent one. What I can give you is the direction. On a vast fund tracking a major index, the spread is negligible. On a thinly traded niche fund it is not, and it can dwarf the annual charge for anyone who trades often. So an ETF has a friction a unit trust does not, and it is still usually far cheaper because the ongoing charge is dramatically lower. Here is the thesis of this whole book in one comparison, using the fund industry's own trade body figures for the United States in 2025. Index equity mutual funds, 0.05% a year, asset-weighted. That is 5 basis points, a basis point being 1/100th of 1%. Index equity ETFs, 14 basis points. Index bond ETFs, 9. Now the comparison. The simple average expense ratio across all United States equity mutual funds was about 1.08%, 108 basis points, with the most expensive 10th at 1.84%. On $100,000, 5 basis points is $50 a year. 108 basis points is $1,080 a year. For roughly the same market exposure. Why is the good product the cheap one? 2 reasons, and the second is the one nobody says aloud. First, transparency and competition. An index is a published rule set. Anyone can replicate it. There is nothing to be clever about, so the only competitive dimension left is price, and price has been ground down toward the cost of operations. Second, and structurally decisive. The trade body itself states that an ETF's expense ratio provides no compensation to financial professionals. There is no trailer fee, no share of the management charge flowing back to whoever sold it to you. Nobody has a commission-driven reason to recommend one, which is precisely why, for decades, they were underrecommended. The product that pays no one to sell it is the product that does not get sold. That is the pattern to carry through the rest of this book. The industry earns least from the products that serve customers best, and most from the products that are hardest to price. So how does the provider still earn? 4 ways. 1. The expense ratio itself, tiny in percentage terms, enormous in absolute terms, because this is a volume business, not a margin business. Running a very large fund costs little more than running a small one. 2. Securities lending. The fund lends the shares it owns to borrowers, typically hedge funds and bank trading desks who want to sell short. The borrower posts collateral worth more than the loaned securities, standard margins around 2% in the United States, 5% in Europe, and pays a fee quoted as an annual percentage of the value lent. Where the collateral is cash, the fund earns interest on it and pays an agreed rebate back to the borrower. When a bank acts as lending agent, the remaining income is split between the fund and that agent bank. The critical question is how much comes back to you, and I have to flag this honestly. Typical split percentages for retail index funds and ETFs were not verifiable in the research behind this book. It varies by provider and is disclosed only in the annual report. Meanwhile, the risks, borrower default, and reinvested cash collateral losing value, which is what turned lending programs toxic in 2008, sit with the fund. That is with you. 3. Cash management. The fund's uninvested cash earns something, and how that is handled is the provider's choice. 4. For the largest sponsors, the strategic value of the flows, custody relationships, market-making ties, index licensing inside the group, and the voting power that comes with owning a slice of every listed company. The risks, plainly, an ETF is not safer than what it holds. A fund tracking a market that falls 40% will fall about 40%. A single country, single sector, or leveraged fund is a concentrated bet wearing a diversified-sounding name. A market capitalization-weighted index automatically puts most of your money in whatever has already risen most. You are not buying the economy, you are buying a weighted bet on current valuations. Small, unpopular funds get liquidated, forcing a disposal at a time you did not choose. And the wrapper's greatest technical virtue, tradability, is its greatest practical hazard. Something you can trade all day invites you to trade it all day. Treat that last one as a mechanism, not a measured number. How to decide? Which index, and does it contain what you actually want? Total cost of ownership, charge plus spread plus commission plus platform fee, not the headline. Physical or synthetic, and if synthetic, why? Size and volume, since bigger and busier means tighter spreads and less closure risk. Tracking difference over several years. And whether it lends securities, and who keeps the revenue. One last warning, and it applies to index funds in any wrapper. The word index is not a promise of cheapness. Among United States index equity mutual funds, the most expensive 10th charged 1.49% in 2025. An expensive index fund is the worst product in this chapter. Index returns at active fees, without even the possibility of a manager's skill making up the difference. None of this is financial advice. Next, we leave funds behind for individual shares, starting with the most persistent misconception in retail investing. Chapter 6: Dividend Stocks. A dividend is not free money. I lead with that because it is the most common misconception in retail investing, and because almost everything sold to you under the word income depends on you not noticing it. Start with what a share actually is. A share of common stock is a residual claim on a business. Residual means last in line. Employees, suppliers, lenders, and the tax authority are all paid before shareholders get anything. What is left over is yours. You eat last, and your portion is uncapped. There are exactly two ways the leftovers reach you. The company hands you cash, a dividend, or somebody pays you more for your claim than you paid, a capital gain. Dividend stocks and growth stocks are not two asset classes. They are the same asset class, with the cash arriving on different timetables. Now the arithmetic. A company is a box with cash in it. You own a share of the box. A dividend takes cash out of the box and puts it in your pocket. Your total wealth is the box plus your pocket. Moving money between them does not change the sum. So when the dividend is paid, the box is worth less, by roughly the amount that left it. The market implements that mechanically on a day called the ex-dividend date. The definition, from the American Tax Authority, is the first date following the declaration of a dividend on which the purchaser of a stock is not entitled to receive the next dividend payment. From that morning, a buyer is buying a company that no longer contains that cash, so a buyer will not pay for it. Reference material puts it this way. The opening price on the ex-dividend date can be expected to decrease by the amount of the dividend, although this change may be obscured by other influences on the stock's value. That last clause matters, and I want to be fair to you. You have almost certainly never seen this happen, and you may be about to tell me it does not. Your disbelief is rational, not stupid. On any given day, the whole market also moved, the company also released news, and the dividend is often a fraction of a % of the price. The effect is real, and it is buried in noise. The academic literature generally finds the fall is somewhat less than the full dividend and argues about why taxes, transaction costs, and traders who buy purely to capture the payout are the leading suspects. I will not give you a number for that ratio. The commonly repeated figure was not verifiable. There is a second cost on the way. In most jurisdictions, a dividend is taxed on receipt, with no choice about the timing, while an unrealized capital gain is taxed only when you decide to sell. So, for a taxable investor, the dividend is money moved from one of your pockets to another with the tax authority taking a slice as it passes. That is jurisdiction dependent, and none of this is tax advice. The mirror image is called a homemade dividend. If you hold a company that pays nothing and you want cash, sell a small slice. Under the idealized assumptions that is identical to receiving a dividend, cash in hand, a slightly smaller claim, which gives the sharpest version of the argument. A dividend is a forced partial liquidation of your position on a schedule you did not choose. The formal result behind this is a 1961 paper by Merton Miller and Franco Modigliani, both of whom later won Nobel Prizes in economics, Modigliani in 1985, Miller in 1990. Their proposition, in an idealized market with no taxes, no transaction costs, and, crucially, with the firm's investment policy held fixed, a firm's value is unaffected by how much of its earnings it pays out. That last clause is the one everyone drops, and it is load-bearing. The theorem does not say cash does not matter. It says that given the company will make the same investments either way, routing $1 to you now, rather than retaining it, changes the timing and the label, not the total. Now the fair counterargument, because dividend investors have several, and several are recognized exceptions rather than folklore. Each is a friction the theorem assumes away. Signaling, managers know more about the business than you do. Raising a dividend is expensive to fake because you have to keep paying it. So an increase credibly signals confidence and a cut signals distress. The dividend does not create value, but it transmits information, and information moves prices. Discipline. The economist John Lintner observed that companies keep dividend rates relatively constant even as earnings fluctuate. They smooth. Because cutting is publicly humiliating, a committed dividend becomes a standing constraint on management. Cash paid out cannot be spent on an ego-driven acquisition. That is a governance tool, and it exists because managers do not always act in shareholders' interests. The bird in the hand. Associated with Myron Gordon and Lintner, investors prefer a certain dividend today to an uncertain gain tomorrow, so a paying stock deserves a higher valuation. You will hear this constantly, so here is the counter. It confuses the riskiness of the dividend with the riskiness of the business. Paying out cash does not make the earnings safer. If anything, it removes a buffer. This is the rebuttal most repeated by financial media and the one with the least theoretical support. And the behavioral one, the most honest of the lot. If receiving cash is what stops you panic selling in a crash, the dividend has genuinely improved your realized return, not because the arithmetic changed, but because your behavior did. A strategy that is mathematically neutral but behaviorally superior is, for a real human being, superior. So the verdict, narrower than either camp's slogan. Prefer a dividend for what it tells you about a company's discipline and confidence. Never treat the yield itself as a return you are being given for free. The mechanics, briefly, 4 dates. Declaration, the board announces the amount and the dividend becomes a legal liability. Ex-dividend, buy on or after it and the dividend goes to the seller. This is when the price adjusts. Record date, a back-office snapshot of who is on the register. Payment date, the cash lands typically a week or more later. Ex-date and record date differ because trades take time to settle, so the exchange sets a cutoff earlier than the snapshot. The United States moved to settlement 1 business day after the trade on the 28th of May 2024. Most other developed markets have been at 2 days and several are moving. It is plumbing, not strategy, and the dividend capture schemes sold to retail investors try to arbitrage plumbing the market has already priced. 2 ratios worth knowing. The payout ratio is dividends divided by net income, the share of profit handed out. Its reciprocal is dividend cover, how many times earnings cover the dividend. Cover of 2 means the company earned twice what it paid. Cover below 1 means it paid out more than it earned, funding the difference from reserves, asset sales, or borrowing. I will not give you a safe threshold. Sustainable levels are wildly industry dependent and no such rule was verifiable. Take the direction instead. Cover comfortably above 1 and stable is reassuring. Persistently below 1 means the dividend is funded from something other than profits, and that is finite. Better still, compare the dividend against free cash flow. Earnings are an accounting opinion. The dividend is paid in cash. For scale, S&P 500 payout ratios have fallen from roughly 90% in the 1940s to about 30% recently, and for smaller growth companies, the average can be as low as 10%. Now the warning that matters most in practice. Yield traps. Dividend yield is the annual dividend per share divided by the current share price. The entire trap is in the denominator. The yield can rise for two opposite reasons. The company raised the dividend, which is good, or the share price collapsed, which is not. A screen that ranks stocks by yield ranks them largely by how much bad news is already priced in. A yield dramatically above its sectors is not a bargain signal. It is the market's estimate of the probability that the dividend will be cut. The sequence runs like this. The price falls, the yield mechanically rises, yield screening investors buy, the deterioration continues. The board cuts the dividend. The yield collapses and the price falls again because the cut is itself a negative signal. You lose on both legs. Notice that dividend cut risk and price risk are not independent. Beginners model them as if they were. They arrive together. Two other risks. Sector concentration. High-yield portfolios cluster in utilities, telecoms, financials, staples, energy, and property. Even the famous dividend growth indices show it. In the American Dividend Aristocrats Index, consumer staples and industrials each account for about 21.7%, and communications is unrepresented. A diversified dividend portfolio is often a concentrated bet on interest rates and regulated industries in a diversification costume. And the value trap that is not about dividends at all. A mature, high-payout company may simply be a declining business paying out its own liquidation in installments. It feels like income. It is partly the sale of the company to itself. Then there is the leak almost nobody explains: withholding tax on foreign dividends. Here is a verified figure, jurisdiction named. The United States Internal Revenue Service states that most types of United States source income received by a foreign person are subject to United States tax of 30%, and dividends are explicitly within that category. 30% taken at source automatically before the cash reaches your account. No invoice, no line item you agreed to. It can be reduced by filing the form known as W-8B-EN with your broker and by a tax treaty between your country of residence and the United States. But I will not quote a treaty rate because the commonly cited number was not verified and it differs by country. And here is the cruel wrinkle. Whether you can recover it depends on your own tax position. An investor holding foreign shares inside a tax-sheltered domestic account often cannot claim a foreign tax credit because there is no domestic tax liability to credit it against. The shelter that protects you from local tax destroys your ability to reclaim the foreign one. Other countries withhold at their own rates, and some do not withhold at all. The principle: a foreign government may tax your dividend before you ever see it, and you may not get it back. Which brings us to how the broker earns. Commission is the visible one. A verified example, offered as one platform's published schedule and not an industry norm. The United Kingdom Platform Interactive Investor charges £3.99 per United Kingdom or United States share trade on its core plan, plus £5.99 a month in platform fees. Then the spread, you buy at the higher price and sell at the lower, and the gap is revenue for whoever makes the market. It is never itemized. Studying American retail accounts in the mid-1990s, the academics Barber and Odeon measured the average round-trip trade above $1,000 at 3% in commissions and 1% in bid-ask spread. Commissions have since collapsed toward zero at many brokers. The spread never went away. And now the number I most want you to remember from this book. That same published schedule charges 0.75% to convert currency on its core plan. Buy £10,000 of a foreign share and the conversion costs £75 against a £3.99 commission. The invisible cost is roughly 19 times the visible one. Then you pay it again when you sell and convert back. And on many platforms, you pay it again on every single dividend, converted as it arrives. So a foreign dividend can be hit by withholding tax and then a currency margin before it reaches you, neither appearing as a charge you agreed to. You could hold a foreign dividend payer for a decade and never once see a line item for either. Be precise about that evidence. One named platform's published schedule as at August 2026. Rates vary enormously and some brokers charge a fraction of it. Look up your own. Brokers also earn from lending your shares out. usually to someone betting they will fall, with the revenue split generally undisclosed. In some jurisdictions, they sell your order to a wholesale market maker, and they earn interest on anything you borrow. So, how to decide whether dividend stocks belong near you? Start with the business, not the yield. If you would not own the company at a zero dividend, the dividend is not a reason to own it. Read the cover, not the yield. Ask why the yield is high. An outlier yield is a question, never an answer. Locate the tax leak before you buy. And be honest about one thing. If your dividends are automatically reinvested, you are paying tax on money you never touched to buy back the exposure you just sold. The dividend is then pure friction. That is the most actionable sentence in this chapter. None of this is financial advice. Next, the other timetable, companies that pay nothing at all, and the most counterintuitive fact in this book. Chapter 7, Growth Stocks. There is a fact about the stock market that almost nobody is told, and once you know it, most of what you hear about picking stocks stops making sense. I will get to it. First, vocabulary, because the word growth is used to mean two completely different things. The practitioner definition, the one you meet in a brochure. A growth stock is a company whose revenues and earnings are expected to increase faster than the average company, generating substantial and sustainable positive cash flow. Such companies usually pay small dividends or none because they reinvest what they earn. You will hear rules of thumb attached, a return on equity of 15% or higher, or the investor Peter Lynch's interest in companies growing at 20% or more. Those are practitioners' heuristics, not definitions. The academic definition is entirely different. In the framework built by the economists Eugene Fama and Kenneth French, a growth stock is simply a company with a low ratio of accounting book value to market price, and a value stock has a high ratio, the top and bottom 30% respectively. Notice what that contains, nothing whatsoever about the business growing. It says the market has priced the company at a large premium to what its books say it is worth. In the academic sense, a growth stock is defined by its price, not its growth. That distinction is the hinge of the whole value versus growth argument. Warren Buffett's dissent is worth repeating. He called the distinction fuzzy thinking, on the grounds that growth is an input to value, not its opposite. Now to the most useful mental model in this chapter, and it needs no jargon. Price equals earnings times multiple. The price of a share is what the company earns per share, multiplied by how many years of those earnings people will pay for. That second number is the multiple, the price-to-earnings ratio. So a share price can rise for exactly two reasons, and they could not be more different. The first is earnings growth. The company genuinely earns more. That is the company doing work. The second is multiple expansion. The company earns exactly the same, but people decide to pay more for each dollar of it. That is other people changing their minds. Work it through. A company earns $1 per share and the market pays 20 times earnings, so the share costs $20. 2 years later, it earns $2 per share. The business has genuinely doubled. If the market still pays 20 times, the share is worth $40 and you have doubled your money. But suppose by then the market has cooled and pays only 10 times. $2 times 10 is $20. The share is exactly where you bought it. The company doubled its profits and you made nothing. Run it the other way, earnings stay flat at $1, but enthusiasm lifts the multiple from 20 to 40. The share doubles and the business has done nothing at all. Both feel identical in your account. They are not the same thing at all. Multiple expansion is not repeatable, it is not owned by you, and it reverses. So a stock bought at a high multiple carries a hidden second bet. Not only must the company grow as expected, the market must still be willing to pay the same premium for that growth when you sell. You can be entirely right about the company and still lose money, because you were also, without noticing, betting on other people's mood. Which gives the honest framing. Buying a growth stock is making 3 bets at once, and most beginners think they are making one. 1, the company will grow. 2, the one they did not know they made, it will grow more than the market already expects, because expected growth is already in the price. 3. The one nobody mentions, the market will still pay a high multiple when you sell. Bet 2 is the killer. In a liquid market, a widely admired company's future is not a secret. Everyone can see it. It is priced. Buying the obviously excellent company at any price is not an edge, it is paying for a consensus. A high multiple is, quite literally, an embedded forecast. The higher it is, the more of the good news you have already paid for. That is why reference material describes growth stocks as trading at higher multiples than the broad market, being more volatile, and having projections that are often overly optimistic. Now the fact I promised, the most counterintuitive thing in this book. It comes from a peer-reviewed paper by Hendrik Bessembinder, published in the Journal of Financial Economics in 2018, titled Do Stocks Outperform Treasury Bills? The wording matters, so here it is. The majority of common stocks that have appeared in the main American academic price database since 1926 have lifetime buy and hold returns less than 1-month treasuries. And stated in terms of lifetime dollar wealth creation, the best-performing 4% of listed companies explain the net gain for the entire United States stock market since 1926, as other stocks collectively matched treasury bills. There are 3 separate claims in that, and each is astonishing. First, the majority of individual American stocks over their entire lifetimes returned less than 1-month government bills. Not less than the index, less than cash. The median stock is a bad investment. Second, the best 4% of listed companies account for the entire net dollar wealth creation of the American stock market since 1926, and the other 96%, collectively, merely matched treasury bills. Third, the cause is positive skewness. A small number of enormous winners drag the average far above the median, and long holding periods compound the effect. The caveats honestly stated: United States data, 1 database, 1 very long sample. And lifetime buy and hold includes companies listed only briefly, which is part of why so many underperform, a real feature of owning shares, not a data artifact. There are later extensions to global markets, but those were not verified in the research behind this book. Here is what it implies, and it is not what most people take from it. The usual case for diversification is defensive. Do not put all your eggs in one basket, or you might pick a disaster. Besembinder's result gives a completely different and much stronger argument. If nearly all the gain comes from a tiny minority of companies, the danger in a concentrated portfolio is not primarily that you pick a loser. It is that you fail to own the handful that produced everything. You do not need to be unlucky to underperform. You only need to be normal, because the typical stock, on this evidence, is worse than cash. The paper's closing line makes the point. These results help explain why poorly diversified active strategies most often underperform market averages. The right analogy is not horse racing, where you might reasonably be a bit above average. It is venture capital, where the whole portfolio's arithmetic is decided by 1 or 2 positions and everything else roughly breaks even. Professional venture investors respond by making many bets and expecting most to fail. A retail investor holding 6 familiar companies is playing a venture game with a portfolio built for a coin flip. Notice the symmetry, because this cuts both ways. The same extreme skew is why concentrated bets occasionally work spectacularly. Somebody does own the 4%, enormous fortunes are built that way, and those are the stories that get told. What you never hear are the identical stories, told with identical conviction, about companies that went to zero. Every argument for growth investing is illustrated with a survivor. The other risks, plainly. Multiple compression, you can be right about the business and lose. Forecast error compounding. A high multiple encodes many years of assumed growth, so a small change in the assumed rate changes the justified price a great deal. No cash return to cushion the weight, so your holding period is exposed to sentiment for its entire length. Concentration twice over, by stock, because of the skew, and by sector, because growth cohorts cluster in whatever industry is currently ascendant. Both are usually invisible to the holder, because each purchase felt like a separate decision. Higher volatility. And dilution. Growth companies frequently issue new shares for capital or to pay employees, so your ownership can shrink even as the company succeeds. A word on what the value versus growth evidence does and does not support. Fama and French's 1993 model explains returns with three components: the market, the outperformance of small companies over large, and the outperformance of high book-to-market over low. They found positive historical returns from both the size and value factors, and the model explains over 90% of diversified portfolio returns against about 70% for the model it replaced. But there is genuine academic debate about the factors they added in 2015, research suggesting they are country-specific rather than universal, and mixed results in emerging markets. I am deliberately not giving you a number for how much value beat growth by. No such figure was verified. It is extremely sensitive to period and construction, and quoting one would be exactly the error this book exists to avoid. Note also who has a stake. The value factor is the foundation of a large industry selling factor funds. Which brings us to you. The best evidence on how retail investors actually do comes from a paper by Brad Barber and Terrence Odian, both then at the University of California, published in the Journal of Finance in April 2000 as Trading is Hazardous to Your Wealth. They obtained position statements and trading records for 66,465 households at a large American discount brokerage between 1991 and 1996. Academic authors, no commercial stake, unlike most trading education you will encounter, which is produced by firms that earn when you trade. The numbers: over that period, the market index returned 17.9% a year. The average household, before costs, returned 18.7%. Read that carefully. Before costs, they beat the market. After commissions and the bid-ask spread, the average household returned 16.4%. And here is the part that matters most. The households that traded most frequently earned 11.4% net, while those that traded least earned 18.5%. 7 percentage points a year, separating the busiest from the calmest. The authors are explicit that there is very little difference in the gross performance of households that trade frequently and those that do not. So the gap is not stock selection. It is friction. The average household turned over more than 75% of its portfolio every year, the most active more than 250%. And in that era, the average round-trip trade above $1,000 cost 3% in commissions and 1% in spread. The authors attribute the excessive trading to overconfidence. Retail investors in that sample were not bad at picking. They were bad at paying. That is a far more humane finding than the usual sneer, and it is what the data says. Buying a growth stock is mechanically identical to buying any other share, same account, same order types, same settlement. Commission is the visible cost, and at many brokers it has fallen toward zero. The spread is the invisible one, and it never went away. But for growth stocks specifically, there is a third, because the companies people most want to own are very often listed in a foreign market. Here is the concrete case, offered as one platform's published schedule rather than an industry norm. The United Kingdom platform Interactive Investor charges £3.99 per share trade on its core plan and 0.75% to convert currency. Buy £10,000 of a foreign share, and the conversion costs £75 against a £3.99 commission. The invisible cost is roughly 19 times the visible one. You pay it again when you sell and convert back. Neither appears as a fee you agreed to. It is embedded in the rate. That figure is verified as at August 2026. Rates vary enormously, and some brokers charge a fraction of it. Check your own. So, how to decide whether growth stocks belong near you? Work out which definition of growth you mean. Split your thesis into the 3 bets and ask whether you have a view on the second and third, or only the first. Ask what is already in the price. If you cannot articulate what the market expects, you cannot know whether you disagree with it. And size the position against the skew. If the base rate is that the typical stock underperforms cash, position sizing is not a detail, it is the strategy. The genuine upside, stated fairly. A dollar retained and reinvested inside a good business compounds without being taxed on the way, a real advantage over the dividend route for a taxable investor. No forced distributions means no forced tax events. And the same skew that punishes concentration rewards breadth. Owning the whole market is the only reliable way to guarantee you hold the 4%. None of this is financial advice. Two papers from completely different directions, one measuring what retail investors actually earned, one measuring how stock returns are distributed, point at the same conclusion. Next, the market almost everyone forgets, and it is the largest one there is: bonds. Chapter 8: Bonds and Fixed Income. Let me begin with an admission, because it is more useful to you than a smooth opening. When this series was commissioned, I was handed a list of things to explain: unit trusts, dividend stocks, growth stocks, hedge funds, options, money market, gold, commodities, structured products, a good list. Bonds were not on it, and that is the single biggest gap in it, which I would rather name out loud than quietly fill. Here is why. The Capital Markets Factbook is published by SIFMA, the American Securities Industries Trade Body, funded by the broker-dealers it represents, so weigh it accordingly. On its figures, global fixed income outstanding stood at $145.1 trillion in 2024. Global equity market capitalization, same source, $126.7 trillion. Global fixed income is larger than global equities. Those are the most recent full-year figures I could source. The issuance comparison is starker. In 2024, in the United States alone, borrowers raised $10.4 trillion of long-term debt. American companies raised $222.9 billion of equity. Roughly $47 of borrowing for every dollar of share issuance. To be fair, the totals are not perfectly comparable. Debt is principal that must be repaid. Equity value is a valuation of claims that never mature. But on any measure, fixed income is at least as large. And several things on that list are bonds in costume. A money market fund holds short-term debt, a mortgage-backed security is a bond, a structured note is a bond with a derivative bolted on. So, from zero, a bond is a loan you can sell. It is a loan. You hand over money, the borrower promises interest on a schedule, and your money back on a stated date. Unlike a share, there is no upside beyond what was promised, and you can sell it. It is chopped into standard tradable units, so it has a market price that moves even though the promised payments never change. 4 terms define any bond. Face value, also called par, is the amount repaid at the end. The coupon is the interest rate printed on the bond as a percentage of face value. A 4% coupon on 1,000 of face value pays $40 a year, fixed for life. The maturity date is when the principal comes back. The issuer is who owes you the money, and that is the credit risk. One more word, because bond people speak in it. A basis point is 1/100th of 1 percentage point. Now the idea beginners most reliably get wrong. Why does a bond's price fall when interest rates rise? Start by noticing the payments are frozen. You lend the government $1,000 for 10 years at a 4% coupon, $40 a year, then $1,000 back. Those numbers are printed on the contract, and the government pays $40 a year whether rates go to 0 or to 20%. Now change the world around the frozen contract. A year later, the central bank has raised rates, and new 10-year bonds are being issued with a 5% coupon, $50 a year on the same $1,000. Here is the question that makes it click. You need to sell. A buyer can walk into the market and buy a brand new bond paying $50 a year for $1,000, or he can buy yours paying $40. Would he pay $1,000 for yours? Obviously not. He will buy yours only if the price falls far enough that the smaller income, plus the full $1,000 at maturity, adds up to the same return he could have had elsewhere. That is the entire mechanism. The payments cannot adjust, they are printed on the contract, so the price has to adjust instead. It is the only free variable. Rates up, price down. Rates down, price up. It is a seesaw, and it is not an opinion, it is arithmetic. Now the honest other half. If you hold to maturity and the issuer does not default, the price fall costs you nothing. You still collect 40 a year and 1,000 at the end. But it is real in opportunity terms. You are locked into 40 while everyone else gets 50, and the market price is the market putting a number on that regret. And it is fully real if you own a bond fund, because a fund does not hold to maturity the way you would. It runs a rolling portfolio, other investors redeem, and the fund's published price is the market price. That is why people who believed bond funds were the safe part of their portfolio got a shock in 2022. So how badly does a rate rise hurt you? That is what duration measures. Formally, it is the weighted average time until you get your money back in years. Usefully, duration is roughly the percentage a bond's price moves for each 1 percentage point change in interest rates. Work it out loud. A bond fund reports a duration of 7. Rates rise a percentage point, 100 basis points. 7 times 1% is a fall of about 7%. Rates fall a point instead, expect a gain of about 7. Rates rise 2 points, roughly 14% down. As illustrative orders of magnitude, a 3-month Treasury bill has a duration near a quarter, a 5-year government bond around 4.5, a 30-year bond between 17 and 19, so a 2-point rise costs that long bond well over a third of its value. 2 caveats. The relationship is slightly curved rather than straight, and that curvature is called convexity. Gains when rates fall run a little bigger than duration predicts, losses a little smaller. And duration measures interest rate risk only, it says nothing about whether the borrower pays you back. Then the instruction almost nobody follows. Every bond fund publishes its duration on the fact sheet. Find it, multiply by the rate move you fear, and you have your downside. Next, the word yield, which the press uses for 3 different numbers. Take a bond with face value of 1,000, a 5% coupon paying 50 a year, 10 years to run, trading at 900. The coupon yield is 5%, printed on the bond, never changes, tells you nothing about your return. The current yield is income divided by what you pay. 50 divided by 900, 5.56%. Better, but it ignores that you paid 900 for something that repays 1,000. The yield to maturity is the total annualized return if you buy today, hold to the end, and get paid everything. Here it is somewhat above 5.5%, because on top of 50 a year, you collect 100 of capital gain across 10 years. Below par, yield to maturity beats current yield beats coupon. Above par, that order reverses. So when someone sells you a bond by quoting a big attractive income number, ask which yield he means. Current yield always flatters a bond trading above face value, and such a bond drifts down toward par as it matures, a capital loss the income number does not show you. Plot government yields against time to maturity and you get the yield curve, the price of time. On Federal Reserve data as of the 31st of July, 2026, in the United States, the 3-month bill yielded 3.69%, the 2-year 4.28%, the 10-year 4.75%, the 30-year 5.27%. Upward sloping, about 1.5 percentage points more for lending 30 years than 3 months. Say the date every time these move. An inverted curve is one where short yields exceed long ones, implying the market expects rates to be much lower later, usually because it expects weakness. It is a much-cited recession indicator. I am deliberately not giving you a batting average, because the honest answer depends on which spread you use, which recession dating, and how long a lead you allow. The lead time has been long and inconsistent, so it is not a trading signal. And a handful of recessions makes a suggestive regularity, not a law. Then the separate question, will you be paid back at all? 3 agencies dominate ratings: Moody's, Standard & Poor's, and Fitch. Above the line sits investment grade, AAA down to BBB. Below it sits high yield, whose older and more honest name is junk. That boundary is a cliff, not a gradient, because pension funds, insurers, and index funds are often contractually forbidden from holding below investment grade debt. A downgrade across the line triggers forced selling by people with no view on the company at all. The market calls such a bond a fallen angel. The price falls not because the news is that bad, but because a rule in somebody else's mandate says they must sell. Say the conflict plainly. Rating agencies are paid by the issuers they rate. The borrower who wants a good rating writes the check. That issuer pays model was the documented central conflict of the 2008 crisis, when mortgage securities carried AAA ratings and defaulted in bulk. It still stands today. The extra yield a corporate bond pays over a government bond of the same maturity is the spread. The market's price for the risk of not being paid. An academic dataset compiled at New York University from traded bonds, as of January 2026, puts default spreads by rating from 0.40% at the top of the scale to 19% at the bottom. Same instrument, same mechanics, a 40-fold difference in the price of the promise. I will not quote you default or recovery rates because I could not verify them from primary sources. What follows from structure rather than statistics is this: default rates rise as ratings fall and accelerate at the bottom. Default is not total loss. Bondholders rank above shareholders, and secured beats senior, unsecured beats subordinated beats equity. So rank the claim, do not merely rate the borrower. Defaults cluster, quiet for years then spiking together in a recession, so the average badly describes any actual year. And high yield behaves far more like equities than like government bonds in a crisis. Now, how the bank earns. Shares trade on exchanges. Most bonds do not. Buy a share and there is a central order book, a visible last price, and a commission printed on your contract note. Bonds, outside a handful of listed retail issues, trade over the counter in a dealer market. You ring a broker or click a screen and you are not matched with another investor. You buy from a dealer's own inventory and sell into his own book. He quotes two prices, the bid, what he will pay you, and the offer, what he will sell to you for. The offer is higher. That difference is his revenue, embedded in the price rather than charged as a fee. Your statement can say commission, 0, and be truthful, while the dealer has still been paid. There is often no reference price to check against. A large company has one share, but may have dozens of bonds, most of which did not trade today, so the price is a model output rather than a fact. The spread widens exactly when you need liquidity, because dealers step back in stress. And retail gets the worst of it. A small odd lot trade costs the dealer roughly what a large one does and faces less competition. I could not source reliable spread figures, so I will not invent any. There is one genuinely useful protection. In the United States, since the 14th of May, 2018, under a rule made by FINRA, the American brokerage regulator, a broker dealing as principal in a corporate or agency bond with a retail customer must disclose his markup on the confirmation, in dollars and as a percentage of the prevailing market price. That confirmation also links to TRACE, the trade reporting system, so you can see where else the bond traded that day. Most people have never looked. Look, the limits, corporate and agency debt, not treasuries, retail customers, United States only. The third earning line is underwriting. Banks run new bond deals and take a percentage deducted from the proceeds rather than billed. Against $10.4 trillion of American issuance in 1 year, that is an enormous pool. I could not verify a reliable average fee, and anyone quoting one number across sovereign, investment grade, and high-yield deals is oversimplifying. Note, too, that the same bank often underwrites the bond, makes the market in it afterwards, sells it to its own wealth clients, and holds it in its own funds, a separate fee at every step on one security. So how do you decide? The upside is contractual. You know the payments, you rank ahead of shareholders, and a high-quality bond held to maturity gives you what was promised. The risks are that rates move against you, that the borrower does not pay, and that the round trip through a dealer costs more than you can see. 4 questions expose a bad version. What is the duration? What is the yield to maturity rather than the headline income? Who is the issuer? And what was the dealer's markup? None of this is financial advice, and I recommend no product. Next, the shortest end of this market, the cash you are not thinking about, and the largest, least visible way a bank earns from you. Chapter 9. money market and cash. This chapter is about the money you are not thinking about, the balance in the current account, the cash parked in the brokerage account between trades, the emergency fund. Most people treat it as a resting place rather than a decision. It is the largest decision an ordinary saver makes. Start with the product. A money market fund is a mutual fund that owns only very short-term, very high-quality debt. Nothing exotic. Treasury bills, government debt maturing in under a year. Short government agency paper. Repurchase agreements, called repo, which are very short secured loans usually backed by government bonds. Some funds add commercial paper, a short unsecured corporate IOU, and certificates of deposit issued by banks. Some hold short municipal paper for tax reasons. Because everything in it matures in weeks or months, its duration is near zero. Duration, to restate it, is roughly the percentage a bond's price moves for each 1 percentage point change in interest rates. A duration of a quarter means a 1-point rate rise costs about 0.25%. That is why these funds barely move. The safety comes from the shortness, not from any guarantee. There are 3 types, and the distinction matters more than anything else here. Government or treasury funds hold government paper and government repo. In a crisis, money flows into them. Prime funds add commercial paper and bank paper, and in a crisis, money flows out. Tax-exempt funds hold short municipal paper and are a small American product. Both historical accidents in this product happened in prime funds, never in government funds. That single sentence is the most useful thing you can know here. Scale from the Investment Company Institute, the American Fund Industries Trade Association, funded by fund managers. Note the conflict, though asset totals are among the least contestable things it publishes. In the week ended the 29th of July, 2026, total United States money market fund assets stood at $7.853 trillion. Government funds held $6.472 trillion, prime funds $1.231 trillion, tax-exempt funds $150.14 billion. 2 things fall out. Government funds are about 82% of the total. After the accidents, the money moved to where accidents do not happen. And institutional money, at $4.776 trillion, is about 61%. This is not a retail backwater. It is where corporate treasuries park operating cash, which is why a run on it becomes a systemic event rather than a consumer complaint. Now the difference that actually matters. A money market fund is not a bank deposit, and the two are not close relatives. A bank deposit is a claim on the bank. The bank owes you the money. It has lent your money out, mortgages, business loans, and if it fails, a government insurance scheme pays you up to a cap. The price is always what you put in. A money market fund is not a promise from anyone. You own shares in a pool of securities, a slice of the assets disclosed in the fund's holdings. There is no deposit insurance. Its safety is real, but it comes from what it holds, not from a guarantee. The yield of those holdings passes through to you, less a disclosed management fee. Deposit insurance, then, with the jurisdiction stated every time, because it changes completely across borders. In the United States, the FDIC, the Federal Deposit Insurance Corporation, covers $250,000 per depositor, per insured bank, per ownership category. That last phrase is the least known and most useful feature. Single, joint, and certain trust and retirement categories are separately insured at the same bank. In the United Kingdom, the Financial Services Compensation Scheme covers £120,000 per eligible person per banking license, raised on the 1st of December, 2025, with temporary high balances of up to £1.4 million covered for 6 months from first deposit. In Singapore, the Deposit Insurance Scheme covers 100,000 Singapore dollars per depositor per scheme member, with a separate 100,000 for Central Provident Fund monies. For the European Union, I did not retrieve a primary source, so I state no number. One trap inside that, it is per banking license, not per brand. In the United Kingdom, several familiar high street names share a single license, so a saver who believes he has spread money across 3 banks may have one limit across all 3. Check the license, not the logo. Now the point I most want you to hold on to. Deposit insurance protects you against the bank failing. It does not protect you against an investment falling in value. The FDIC explicitly lists as not insured mutual funds, money market mutual funds, stocks and bonds, annuities, life insurance, crypto, and municipal securities. Buying a money market fund through your bank does not make it a deposit. There is a separate protection, investor compensation, covering custody failure and fraud if a broker collapses, but no scheme anywhere compensates you for an investment going down. I could not verify those limits, so I will not quote one. So has a money market fund ever actually lost money? Yes, this is not hypothetical. The convention is that the share price sits at exactly $1. Income is paid out as dividends. The price does not move. Breaking the buck means the price falls below $1 and investors get back less than they put in. The famous case is the Reserve Primary Fund in September 2008. It held short-term debt issued by Lehman Brothers. When Lehman filed for bankruptcy on the 15th of September, that paper became close to worthless, and the fund could no longer hold $1. It was the first major American money market fund to break the buck in decades, and it triggered a rapid run on prime funds, which in turn froze the commercial paper market ordinary companies rely on to make payroll. I could not retrieve primary source figures for how far the price fell or how large the redemptions were, so I will not give you numbers I cannot stand behind. The interpretive point needs no statistic. A money market fund had been treated for decades as the same thing as cash. In September 2008, that assumption broke in a single week because of one bankruptcy in one set of holdings. The product had not changed. The belief about it had never been true. The second episode was March 2020. As the pandemic hit, investors ran for cash. Prime funds saw heavy redemptions as institutions pulled money simultaneously. Government funds took money in. To stop the commercial paper freeze recurring, the Federal Reserve announced the Money Market Mutual Fund Liquidity Facility on the 18th of March, 2020. The Federal Reserve Bank of Boston lent to eligible institutions against high-quality assets they bought from money market funds, in effect a buyer of last resort, so funds could meet redemptions without dumping assets. It terminated on the 31st of March, 2021. The Fed's own page does not state how much was lent, so nor will I. Name the pattern. Twice in 12 years, a product marketed as a cash equivalent needed a central bank to step in so it could go on behaving like one. Both times it was prime funds, the ones holding corporate paper. Both times government funds were fine. That is not an argument against money market funds. It is an argument for knowing which one you own. Why do these funds run at all? A mismatch. Investors can redeem instantly at a fixed price. The assets take days to sell at whatever price a dealer offers. So if you think others might redeem, redeeming first is rational. The early leavers get the fixed price and the stragglers hold whatever is left. That is a bank run on something that is not a bank and has no deposit insurance to stop it. What exists now? Regulatory limits on holdings, minimum liquid assets, maximum maturities, credit quality floors, though I could not retrieve the current thresholds, so I am not quoting them. Liquidity fee tools, which American reform after 2020 moved toward for institutional prime funds, replacing the earlier redemption gates because the gates themselves encouraged preemptive runs. Floating prices for institutional prime funds, so there is no fixed price to race for. And central bank facilities, which are precedent rather than promise. The last was created, then terminated. Do not assume a rescue. Now the payoff, and one of the clearest answers this series has to its central question: who profits from your cash? The mechanism is almost embarrassingly simple. A bank takes your deposit. It can place that money essentially risk-free at around the central bank's policy rate. It pays you a different, much lower rate. The difference is the bank's income, and it requires no skill, no research, and very little risk. The technical name is net interest margin. Quantify it, United States, and note the dates. On Federal Reserve data as of the 31st of July, 2026, the overnight rate at which American banks lend to one another was 3.63%. On the FDIC's own published national rates, as of the 20th of July, 2026, the average rate an American bank paid on a savings account was 0.38%. Interest-bearing checking averaged 0.07%, and a 12-month certificate of deposit 1.68. Meanwhile, a 3-month Treasury bill, the risk-free short paper the bank itself can buy, yielded 3.69%. Do the subtraction. 3.63 minus 0.38 is 3.25 percentage points. On $10,000 of savings, that gap is about $325 a year. Not a fee you were charged, a return you were never shown. And the ratio is more arresting than the difference. 0.38 is roughly 1/10 of 3.63. The depositor receives about 1/10 of the risk-free rate. The bank retains about 9/10. Set that beside the fees this series has spent chapters on. A retail fund management fee runs from 0.1% up to perhaps 1.5%. This gap is 3.25 percentage points, larger than almost any explicit fee the same customer will ever pay. And unlike a fee, it has no line item, appears on no statement, and is never disclosed as a cost. The audited accounts confirm the scale. J.P. Morgan Chase, in its annual report for the financial year 2025, reported total net revenue of $182.4 billion, of which net interest income was $95.4 billion, 52.3% of the firm. Every fee, commission, and trading line combined came to $87 billion. It earned $193.3 billion of interest income, paid $97.9 billion of interest expense, and only $45.1 billion of that went to depositors. More than half the revenue of the largest American bank came from the spread on money, not from anything itemized on a customer statement. And it is not only banks. Charles Schwab, which most customers think of as a stockbroker, reported net interest revenue of $11.75 billion in the financial year 2025, 49.1% of its entire revenue. Robinhood's audited accounts carry a line literally labeled cash sweep, worth $229 million in the same year. Idle cash in a brokerage account is swept into deposits. The intermediary earns the short rate, you are paid much less, and the difference is the business. When a firm names that line in its audited accounts, the practice is not a secret. It is simply unread. 4 honesty caveats, and the segment is unfair without them. These are national averages, and averages hide an enormous range. Large branch banks pay near zero, while online banks, credit unions, and government money market funds pay far more. The gap is therefore substantially a measure of customer inertia, not a law of nature. The bank is not purely arbitraging, either. Branches, payments, fraud handling, insurance premiums, capital held against losses, and the genuinely risky business of turning instant access deposits into long-term loans all come out of that margin. 3.63% is not literally what the bank earns on your money, it is the policy rate, a proxy for the risk-free alternative, and these figures are United States, July 2026. Equivalent gaps exist elsewhere. I did not source those numbers, so I will not state them. So how do you decide? If you want certainty and the money is below the insurance limit, a deposit is genuinely safer, you are simply paying about 3 percentage points a year for that certainty. If you want the yield, a government money market fund holds much the same short government paper the bank buys with your deposit and passes most of it through. What you give up is the guarantee. What you should not do is hold a large balance in a low-paying account by accident, which is what most people do. This is education, not financial advice, and I recommend no product. But of everything in this series, this is the leak you can close this afternoon. Next, the opposite end of the risk spectrum, the funds you are probably not allowed to buy, and the arithmetic of what their managers keep. Chapter 10, Hedge Funds. Let me start with the most useful sentence in this chapter. You almost certainly cannot buy a hedge fund. That is a legal fact, not a failure on your part, and by the end you may find it a relief. There is no legal definition of a hedge fund in most jurisdictions. It is a regulatory category by exclusion, a pooled fund exempt from the rules that constrain an ordinary mutual fund, which pays itself a share of the profits. The cleanest description comes from Burton Malkiel of Princeton and Atanu Saha, published in the Financial Analyst's Journal in 2005. Hedge funds tend to employ substantial leverage, usually hold both long and short positions, and often use complex instruments such as derivatives. 3 things follow. Because it is exempt, it can borrow heavily, sell short, concentrate, and hold illiquid assets. Because it is exempt, it may be sold only to a restricted class of investor. And because it is exempt, it need report nothing publicly. That third point causes the measurement problem we will come to, which is the most important idea here. Who can access one? In the United States, the Securities and Exchange Commission requires a natural person to be an accredited investor. Earned income above $200,000 or $300,000 jointly with a spouse in each of the 2 prior years and expected again this year. Or a net worth over $1 million excluding the primary residence. Since the 2020 amendments, holding a Series 7, 65, or 82 license qualifies you regardless of wealth. Larger funds rely on a higher bar still, called qualified purchaser. I could not confirm that threshold from a regulator source, so I will not quote a figure. Notice what those tests measure: how much money you have, not whether you understand what you are buying. Then there are non-legal barriers, minimums that exclude ordinary savers, and capacity. Renaissance Technologies Medallion Fund has been shut to outsiders since 1993. The Renaissance funds you could buy did far worse. My inference, offered as reasoning rather than law. Strategies that genuinely work are capacity-constrained, and capacity-constrained strategies are kept by the people who run them. What is offered to outside money is what is left over. Now the fees, which matter more than the strategy. The canonical structure is 2 and 20, 2% of assets every year, plus 20% of profits. Published ranges run from 1 to 4% on assets and 10 to 50% of profits. I could not source a reliable current average because the credible surveys sit behind paywalls and the free ones are marketing. It barely matters. Here is why. Do the arithmetic with me. 2 and 20, the performance fee charged on profits after the management fee, no hurdle. Gross return 10%. Take off 2% management, leaves 8. He takes 20% of that 8, which is 1.6. You keep 6.4. He took 3.6 of the 10 points, 36% of everything the strategy produced. Run it across outcomes and the picture sharpens. At a 20% gross return, he keeps 28% of it. At 10%, 36. At 5% gross, he takes 52%, more than half. And at 0, you are down 2% and he is up 2%. The worse the fund does, the bigger the manager's slice. The headline, 20%, is deeply misleading about the economics. Warren Buffett's version, from his 2017 shareholder letter: performance comes, performance goes, fees never falter. He is the most famous advocate of index funds alive, so weigh the source, but the arithmetic above is mine, and you can check it. One more fee term. A high water mark means the performance fee applies only to genuinely new profits. A fund that falls back and then recovers earns no second fee on the recovery. That sounds like protection, and it is. But the same authors name the perverse consequence. A manager far below his high watermark is incented to close the fund and start again, leaving you with the loss and him with a clean slate. The strategies in plain language. Long-short equity, the largest category. Buy the shares you think are good, borrow and sell the ones you think are bad. Equity market neutral is the strict version, sized so the fund has roughly no exposure to the market's direction. Global macro takes big directional bets on whole economies, few positions, large size. Event-driven and merger arbitrage trade around announced deals. When one company agrees to buy another, the target trades slightly below the offer price. and the fund collects that gap when the deal closes, really selling insurance against the deal breaking. Relative value buys the cheap one of two things that should be priced in a fixed relationship and shorts the rich one. Because each mispricing is tiny, the return is manufactured almost entirely by borrowing. Managed futures buys what is rising and sells what is falling, on rules. And multi-strategy, pod shops run many small independent teams on tight risk budgets, cutting a team's capital fast when it loses. Now the intellectual center. Why are reported hedge fund returns systematically overstated? Because nobody audits the scoreboard. Hedge fund indices are built from returns managers choose to send to a commercial database, and no regulator forces a bad month into it. 3 biases all push the published number the same way, up. First, backfill bias. In the author's description, managers often establish a fund with seed capital and begin reporting at some later date, and only if the initial results are favorable and the most favorable early results are then backfilled into the database. In plain terms, you quietly start 10 funds. 3 do well. You enroll those 3, and the database accepts their entire past record, including the incubation period you would have buried had it gone badly. The 7 failures never existed as far as the index is concerned. On data from 1994 to 2003, backfilled returns are over 500 basis points higher than contemporaneously reported ones. A basis point is 1/100th of a percentage point, so that is more than 5 percentage points a year. Second, survivorship bias. Databases show the funds still alive, dead funds are removed, and they died mostly because they lost money. Same paper, same data. The difference between the returns of all hedge funds and of only surviving funds averages 374 basis points, nearly 4 percentage points a year. Be honest about the range. The authors say theirs sits at the high end and cite others whose estimates run from 60 to 360 basis points. Third, and least known, end-of-life reporting bias. Funds tend to stop reporting before they die, so the worst months never enter the database. The most quotable line in this literature. Long-term capital management lost 92% of its capital between October 1997 and October 1998, and none of those negative returns were reported to the database providers. Put it plainly, the index quietly deletes its failures. The average you are shown is an average of survivors, with their good early years pasted in and their final catastrophic months missing. It is not a biased estimate of a real number, it is a number that never existed. And the failures are not rare. On the same dataset, well over 10% of all hedge funds die each year. Of 604 funds reporting in 1996, fewer than 25% were still in existence in 2004. The author's conclusion, verbatim, hedge funds are far riskier and provide much lower returns than is commonly supposed. 2 caveats. Those figures cover 1994 to 2003 on one database, so they are not a statement about 2026. Index providers have since introduced partial corrections, and lacking a current quantification, I claim neither that the bias is unchanged nor that it is fixed. And Malkiel is a committed indexing advocate, a stated prior, not a hidden one. There is one head-to-head test a lay listener can weigh directly, because it was contractual, registered in advance, 10 years long, net of all fees, and settled on audited numbers. In 2008, Buffett bet that over the 10 years to the end of 2017, a Standard & Poor's 500 index fund would beat a portfolio of funds of hedge funds after all costs. His counterparty, a specialist hedge fund advisory firm, picked 5 funds of funds owning interests in more than 200 hedge funds, and could and did drop managers who lost their touch. The result, the index fund gained 125.8%, an average of 8.5% a year. The 5 funds of funds averaged 2.0, 3.6, 6.5, 0.3, and 2.4% a year. One was liquidated in 2017, survivorship bias happening live inside the scoreboard of the bet itself. All 5 beat the index in 2008, and in every one of the 9 years that followed, the funds of funds as a whole trailed it. Be fair. One bet, 1 decade, testing the packaged fund of funds version rather than the median direct fund. But the terms were public, the counterparty chose the funds, and the numbers were audited. That second fee layer has its own arithmetic. Underlying fund charges 2 and 20, the fund of funds charges 1 and 10 on top, gross return 10%. Run it through both layers and 4.86% reaches you. 5.14 points of fees out of 10, the 2 layers took 51% of the gross return. And the research finds funds of funds underperform the hedge fund universe whether or not dead funds are counted. They are, in the author's words, clearly not able to select the best performing hedge funds. So how does the bank earn from all this? Not by picking managers. By prime brokerage, the most underdiscussed bank revenue line in popular finance. A prime broker sells a hedge fund a bundle. Financing, so the fund can hold more than its own capital. Securities lending, sourcing the shares it must borrow to sell short. Custody and clearing, execution, and capital introduction, where the bank introduces the fund to investors and then earns financing revenue on the money they bring. Financing spreads are the dominant revenue source, and the line that tells you whom the bank wants as a client. Clients who sell short or obtain leverage are a more lucrative opportunity than clients who do not borrow. There is a further piece almost nobody explains, called rehypothecation. The bank may reuse the fund's own collateral as security for its own borrowing and lend the fund's own shares to somebody else. The same securities do work for 2 or 3 parties at once, which is why prime brokerage is a credit business wearing a service business's clothes. The cautionary case is Archegos Capital Management, a family office founded in 2013 by Bill H. Wang, reaching over $36 billion at its peak. It held positions through total return swaps, in which the banks hold the underlying shares, so Archegos did not have to disclose its holdings, and it used several prime brokers likely unaware of its positions elsewhere. On the 26th of March, 2021, it defaulted on margin calls. The banks liquidated, and Viacom CBS fell 27%. Credit Suisse lost $5.5 billion, Nomura $2.85 billion, Morgan Stanley $911 million, UBS $774 million, Mitsubishi UFJ $300 million, roughly $10 billion in total. That one event shows the whole model. The banks earned fees for years lending balance sheet to a client whose true leverage none of them could see because the structure hid it from the market and from each other. The revenue was certain, the risk was invisible and catastrophic. Major banks reported over $2 billion a year each in prime brokerage revenue as far back as 2006. Lacking a current figure, treat that as a floor. 3 more terms decide what happens in bad times. A lockup is a period in which you cannot remove money. A gate caps how much can be withdrawn at once. A side pocket suspends your redemption rights over illiquid holdings, as many funds did in 2008. Each has a legitimate purpose, but everyone activates at exactly the moment you most want your money back. The genuine upside, stated fairly. These funds reach return sources a long-only portfolio cannot: short selling, merger risk premia, trend following, relative value convergence. Those are real economic activities with real compensation. The problem is not that skill does not exist. Some managers are exceptional. It is that skill is scarce, capacity constrained, identifiable mostly in hindsight, and largely unavailable to you. So, how to decide? Ask whether you are legally eligible. For most listeners, that settles it. Get the entire fee schedule and run the arithmetic above on your own return assumption, not theirs. Ask for the source of the return in one sentence you can repeat. If the sentence is really, "We are long the market with extra steps," you are paying alpha prices for beta. And ask, in writing, under what circumstances can you refuse to give me my money back, and who decides? None of this is financial advice, and I recommend no fund. Next, the machines, what quantitative trading actually is, and why the largest quant firms are not betting on direction at all. Chapter 11, Quants. The word quant carries more mystique than it deserves, so let me strip it. Quantitative trading replaces the judgment of a person with a rule derived from data. Instead of "I met the chief executive and I liked her," it is across 4,000 stocks and 30 years, securities with these characteristics have outperformed by this much, so hold a portfolio tilted that way and rebalance constantly. That is the whole idea. A hypothesis, tested against history, executed without emotion, at a scale no human could manage by hand. Amir Khandani and Andrew Lowe of the Massachusetts Institute of Technology note that at scale this is a necessity rather than a style. A market-neutral equity fund of more than 100 securities is virtually impossible to run on human judgment, and the funds they studied typically held over 1,000 positions a day. The leading firms were founded by computer scientists, mathematicians, and engineers, not by economists or stock pickers. 3 families sit under the label. The first is statistical arbitrage, mean reversion models across broadly diversified portfolios, hundreds to thousands of securities held for short periods. It grew out of pairs trading, where 2 historically correlated shares drift apart, so you buy the laggard, short the leader, and wait for the gap to close. The modern version has 2 phases: a scoring phase, in which stocks that have underperformed recently score high as buy signals and strong performers score low as shorts. Then a risk reduction phase, combining those positions into carefully proportioned portfolios to greatly reduce market and factor risk. Notice what that means. The strategy is not trying to be right about any one company. It is trying to be very slightly right, thousands of times, while neutralizing everything else. And because the edge on a single trade is minuscule, the return must be manufactured by borrowing. The second family is factor models. Commercial risk models, those named in this literature include MSCI Barra, Apt, Northfield, and Axioma, decompose every stock's movement into common drivers: the overall market, industry, size, valuation, momentum, volatility, country, currency, plus a residual specific to that company. A quant fund neutralizes the factors it does not want to bet on and keeps only the exposure it believes in. Read any fund the same way. If its return can be reproduced by cheap, buyable exposures, you are paying a performance fee for index fund returns. The third family is market making, and this is where the beginner's picture is most wrong. The largest and most consistently profitable quantitative firms in the world are, for the most part, not betting on direction at all. They are making markets, standing ready to buy from anyone who wants to sell and to sell to anyone who wants to buy, collecting the difference between those 2 prices millions of times a day. That difference is the bid-ask spread, the price of immediacy. Take Citadel Securities as the documented example. It provides liquidity and trade execution to retail and institutional clients across futures, equities, credit, options, currencies, and treasuries. As of 2022, it executed more than 20% of all United States equity trades, and it is the largest designated market maker on the New York Exchange. Its revenues were $4 billion in 2020, $7.5 billion in 2022, and $9.7 billion in 2024, with $4.2 billion of net income in that last year. It earns primarily through the bid-ask spread, and also takes payment for order flow from brokers routing retail trades to it. One precision: it is a separate entity from the hedge fund Citadel, though both were founded and are majority owned by Kenneth Griffin. Sit with that. Those revenues do not come from predicting where the market goes. They scale with volume and volatility, with how much trading happens, not with who is right. A firm earning nearly $10 billion a year as counterparty to everyone else's trades has no need of a view. And you personally pay it. Every time you buy a share, the price you pay is slightly above the price at which you could simultaneously sell it. That gap is the spread. A market maker collects it. It appears on no contract note, and across a lifetime it will cost a frequent trader more than commissions ever did. Even a buy-and-hold index investor pays it once, going in. This is also the honest answer to why your trading app is free. When a retail broker routes your order to a wholesale market maker rather than a public exchange, the market maker pays for the right to execute it. That is payment for order flow. Why pay for orders? Because retail orders are, in the trade's own language, uninformed. Someone buying 40 shares is unlikely to know something the market maker does not. So trading against that flow is far safer than trading against an institution halfway through a large, informed order. You are not the customer. You are the safe side of somebody else's trade. The audited accounts show the shape of it. Robinhood reported transaction-based revenues of $2.628 billion for the financial year 2025, 58.8% of its total net revenues. Within that, options produced $1.123 billion and equities $302 million, roughly 3.5 times as much from options. That is the commercial explanation for why a zero-commission app pushes options so hard. No conspiracy required, just an income statement. To be fair, defenders say wholesale market makers execute retail orders inside the publicly quoted spread, so you get price improvement, and that this is what drove commissions to zero. Critics say the improvement is measured against a benchmark the broker does not control, and that routing to whoever pays most is a structural conflict. Both are true at once. The customer got a real benefit, paid for in a currency he cannot measure. The banks earn from the same flow in the same way. Goldman Sachs reported market-making revenue of $17.993 billion in the financial year 2025, 30.9% of the firm's revenue, and its largest single line. Note the stability across 3 very different market years: $18.238 billion, then $18.39, then $17.993. That steadiness is a toll, not a prediction. Now the failure mode, the most instructive event in quantitative investing, which took 3 days. August 2007. The account comes from Kandani and Lowe, first drafted that September. Note the conflict. Lowe was chief scientific officer of a quantitative investment firm at the time, so he was an industry participant as well as an academic, and the authors describe the paper as an evolving case study rather than formal research. In their words, during the week of the 6th of August, 2007, a number of high-profile and highly successful quantitative long-short equity hedge funds experienced unprecedented losses. And the uncanny detail, with laser-like precision, model-driven funds were hit hard on Tuesday the 7th and Wednesday the 8th, despite little movement in fixed income and equity markets, and no major losses in any other hedge fund sector. The magnitudes, on their simulated version of the strategy without borrowing, minus 1.16% on the 7th, minus 2.83 on the 8th, minus 2.86 on the 9th, a cumulative 3-day loss of 6.85%. Now the context that makes that extraordinary. The strategy's daily standard deviation in 2006 had been 0.52%, standard deviation being simply a measure of a typical day's wobble. So that 3-day loss was 12 daily standard deviations. In the language of the models these funds ran, an event which should essentially never occur. Then leverage, which is where the real money went. The strategy's raw profitability had decayed enormously. Average daily return fell from 1.38% in 1995 to 0.44% in 2000 to 0.13% by 2007. To produce the returns investors expected, leverage of almost 9-to-1 was needed by then. Applying the 2006 leverage of roughly 8-to-1, the simulated strategy would have lost 4.64% on the 7th, then 11.33% and 11.43%. By the close on the 9th, it would have lost a little over a quarter of the assets it started with 3 days earlier. That is roughly what happened to real funds, as reported at the time in the financial press. One Renaissance fund was reported down 8.7% that August, a hybrid statistical fund down 18% as of the 8th. Goldman Sachs Global Equity Opportunities Fund reported to have lost more than 30% of its value in the week. Press surveys of month-to-date losses ran from -5 to -30%. Goldman's chief financial officer said, as reported in the Financial Times, that they were seeing 25 standard deviation moves several days in a row, the perfect description of a model whose probabilities had stopped meaning anything. Then, on Friday, the 10th of August, the price moves that caused the losses reversed, rebounding significantly, though not completely. The simulated strategy gained 5.92% that day, another extreme outlier at 11.4 standard deviations. And here is the best teaching point in the episode. The cumulative return for the whole week was -0.43%, which the authors note is not an unusual weekly return in any respect. The week was ordinary. The path through it was not. Why did it happen? Their hypothesis. The losses were initiated by the price impact of a large, rapid unwinding of one or more quantitative market-neutral portfolios, likely the sudden liquidation of a multi-strategy fund or a proprietary desk responding to margin calls from a deteriorating credit portfolio. The trigger was somewhere else entirely: subprime mortgages. They cite the collapse of two Bear Stearns credit funds in June 2007, and the sale of Sode Capital's portfolio to Citadel after losses exceeding 50% in July. Their framing of the moral. The quantitative nature of the losing strategies was incidental. The driver was the fire sale liquidation of similar portfolios that happened to be quantitatively constructed. State the lesson precisely, because it is easy to get wrong. The models were not wrong. The problem was that too many people were running the same model with borrowed money. When one large holder was forced to sell, everyone's positions moved against them at once, and their own risk rules then forced them to sell too, moving the positions further. The authors name the ingredients: enormous asset growth into the strategy, declining raw profitability, the extra leverage needed to maintain the returns investors demanded, and a lack of awareness of how crowded the category had become. Diversification is an illusion when everybody's diversification is the same trade. That has a direct implication for the backtist, the historical simulation behind every systematic strategy ever sold to you. A backtist tells you what a rule would have earned. It cannot tell you how many other people will be running that rule when you own it, how much borrowed money will be attached to it, or who will be forced to sell first. Those three facts determine whether the strategy survives, and none are in the data. Worse, a strategy that looks reliable in history and better still as capital pours in is displaying exactly the pattern that precedes a crowded unwind. Reliability here is partly a measure of how many people have not yet noticed. The earlier version of the same lesson is long-term capital management. I will give you only what peer-reviewed work supports. It lost 92% of its capital between October 1997 and October 1998. The balance sheet figures widely quoted for that episode come from secondary compilations I could not check against the primary report, so I will not recite them. The structural point does not need them. It was a relative value fund whose bets were small-edge convergence trades that were mostly, eventually, correct. It died anyway, because heavy borrowing means a modest adverse move erases you, and because in a panic, every supposedly unrelated position moves the same way at once. So where does this leave you? The genuine upside is real. Discipline, breadth across thousands of positions, no emotion, and, for market makers, income that scales with volume rather than with being right. The risks are that model decay is relentless, that the leverage used to compensate turns a bad week into a terminal one, and that crowded strategies fail together. As for access, the very best firms are closed to outside money. How to decide, then? For the systematic products you can actually buy, factor funds, smart beta, trend-following funds, ask whether you are paying a cheap price or an expensive one for a rules-based exposure you could describe in one sentence, and ask what happened to it in a crowded unwind, because that exposure never shows in the smooth part of a track record. For everything else, understand your position in this market. You are the flow. The reasonable response is not to outrun it, it is to trade less. None of this is financial advice, and I recommend no product. Next, the private markets, where prices are not observed at all, and where the smoothness of the reported line is itself the thing to interrogate. Chapter 12, Private Equity and Venture Capital. When this series was commissioned, the list of subjects did not include private equity or venture capital, and it did not include private credit or property, the next chapter. Those are real gaps, and I name them without criticism, because these are exactly the products now marketed hardest to people who are not institutions. The institutional money that used to fund them is largely spoken for. You are the next pool of capital. That does not make the products bad. It does mean the enthusiasm you meet is a sales function. A buyout works like this. A private equity firm raises a fund and uses it with a large amount of borrowed money to buy whole companies outright, hold them for several years, make them more valuable, and sell them. The vehicle is almost always a limited partnership lasting roughly a decade. The general partner is the manager. It makes every decision and charges every fee. The limited partners are the investors. They supply capital, have essentially no say, and cannot get out early. And you do not hand over money on day one. You make a commitment, a legally binding promise to provide capital when asked. The manager calls it down over several years as it finds deals and returns money as it sells. The manager, not you, controls the timing of both. Now the borrowing, the word leveraged in leveraged buyout. The debt is borrowed by the company being bought, not by the fund. The company's own assets and cash flows secure the loan and pay the interest. If it fails, lenders pursue the company, and the fund loses only the equity it put in. Here is the arithmetic with invented round numbers. This is not a real deal. Buy a company for 100 using 40 of the fund's money and 60 borrowed. 5 years later, sell it for 130 with the company's own cash flow having paid the debt down to 40. Proceeds to the equity are 90. The fund turned 40 into 90. 2.25 times its money, out of a company whose value rose 30%. Now run it backwards, which the sales presentation will not. The company is worth 70 at exit, and the debt is still 60. Proceeds to the equity are 10. 40 became 10, 3/4 of the money lost on a company whose value fell 30%. Leverage does not create returns. It enlarges whatever return was already there in both directions. It is the same mathematics as a mortgage. 3 things make a buyout work: improving the business, selling at a higher valuation than you paid, and that debt arithmetic. Ask which did the work. Now fees. The cleanest evidence is academic work by Robinson and Sense, circulated by the National Bureau of Economic Research in March 2012, covering 837 funds with vintages from 1984 to 2009. Those are contract terms up to that year, not as of August 2026. The convention is a 2% management fee, 20% of profits, and 1% of the fund's money from the manager itself. What matters is what the fee is charged on. In 92% of those funds, the basis is committed capital, the money you promised, not the money invested. In the early years, while much of your commitment sits in your own bank account, you pay a fee on capital the manager is not yet managing. No retail fund works this way. For buyout funds, the initial fee averaged 1.78%, for venture funds, 2.24%, and then the number to sit with. The average lifetime fee was 14.49% of committed capital for buyout funds and 20.37% for venture funds. Before any share of profits, and before a single investment has been made or sold, roughly $1.07 of a buyout commitment and $1.05 of a venture commitment is expected to go to the manager in fixed fees. The profit share was 20% in 97% of buyout funds, and it comes after a waterfall. Investors get back all contributed capital plus an 8% preferred return before the manager earns anything. That hurdle is a genuine protection. Managers also commit their own money, a median of 1%. And in fairness, the same study found no evidence that higher fee funds underperformed net of fees, a striking contrast with mutual funds. The exception was high-carry venture funds. Now the intellectual center of this chapter. Private returns are not measured the way public ones are. When someone says an index fund returned 8% a year, that is a time-weighted return. It answers one question: what happened to $1 left in the fund for the whole period? It ignores when you put money in because you controlled that. A private fund cannot be measured that way because the manager controls the timing. So the headline measure is the internal rate of return, which is money-weighted and rewards getting money back early. That and an index fund's annual return are not the same unit of measurement, and putting them side by side flatters the private fund. 3 things can lift that number without the investments being any better. First, the early win effect. Double your money in 1 year and the rate on that deal is 100%. Double it over 5 years and it is about 14.9%. Same multiple, wildly different headline. Second, and this is the big one, subscription credit lines. The fund borrows from a bank to pay for an investment instead of calling capital from you. Your money is called later, sometimes many months later, and the loan is cheap because it is secured against your unfunded commitment. Your cash goes out later, so the clock starts later, so the internal rate of return rises with no change whatsoever in the underlying investment. The multiple barely moves. It falls slightly because the fund pays interest on the facility. The convention that emerged is to report both with and without that effect, so the question is short. Does that number include a subscription line, and what is the multiple of invested capital? A manager who cannot answer briskly has told you something. Third, the unsold assets. A reported return includes the manager's valuation of everything not yet sold. For a young fund, most of the reported return is an unrealized mark made by the party being paid on it. The fairer comparison has a name: the public market equivalent. Imagine a shadow account. Every time the private fund calls $1 from you, your shadow self buys $1 of an index fund the same day. Every time the fund pays $1 back, your shadow self sells $1 of the index fund the same day. At the end, compare the piles. Above 1 means the private fund beat the index, having faced exactly the same timing. Below 1 means you would have done better in the index. Academic work by Harris, Jenkinson, and Kaplan from February 2012 benchmarked nearly 1,400 American private equity funds against the S&P 500. Buyout funds came out above 1 for most vintages, an average of 1.27, a median of 1.11, and above 1 in 20 of 25 vintages from 1984 to 2008. 4 caveats travel with that, all in the paper. It ends at 2008, so it does not describe today. The authors assume the risk level equals the index, while citing contrary estimates that buyout is about a third riskier and venture more than twice as risky. One author discloses having consulted to private equity managers and investors. And averages hide dispersion. You do not get the industry, you get one fund. The finding is contested too, and I will not quote a figure from the skeptical side because I could not verify one. Now the second measurement problem, valuation smoothing. A listed share is repriced every second the market is open. A private company is revalued perhaps quarterly by the manager using models and comparables. 2 consequences follow, and both are arithmetic rather than allegation. Reported volatility is understated because the marks are infrequent and partly anchored to the previous mark. And measured correlation with public markets is understated because the private mark lags the public move, so the asset looks like a better diversifier than it is. 2 people own identical houses on the same street. One checks an online estimate daily and watches it lurch about. The other has the house valued every 3 years by a surveyor who knows what the last valuation was. The second will tell you sincerely that their house has been the steadier investment. It has not. They just looked less often. Say it plainly, lower reported volatility is not lower risk. It is less frequent measurement. That matters because volatility sits in the denominator of every risk-adjusted return measure, and correlation is the whole input to a diversification claim. Understate both, and you manufacture an attractive-looking asset class. The best-known name for this is volatility laundering, a phrase associated with Cliff Asness of the quantitative manager AQR, and name that conflict too. AQR runs liquid strategies and competes for the same money. The mechanism is not disputed. In fairness, a quarterly appraisal may be a more considered estimate than a sentiment-driven daily price. What is not defensible is using the smoothed number as evidence the asset is safe. If an investment cannot fall in price on a screen, that does not mean it cannot fall in value. It means nobody is telling you when it does. Venture capital shares the plumbing and inverts the business. Buyouts buy whole mature companies using heavy debt. Venture buys minority stakes in young companies using almost none because a startup has no cash flow to service debt. The defining fact is the power law. Returns are dominated by a handful of extreme winners, and most investments return little or nothing. Academic work by Hall and Woodward from April 2007, tracking most American venture-backed companies from 1987 to 2005, found that about 68% of companies yielded no meaningful exit value to entrepreneurs, and that a large fraction of total value came from the tiny fraction delivering hundreds of millions. Be precise about that number. It measures founder outcomes in a sample ending 2005, not the share of investor capital lost, because investors hold preferred stock paid ahead of founders. It is directional evidence about the shape of the distribution. The lesson inverts every intuition you brought here. In a savings account or an index fund, most of it worked out is what success looks like. In venture capital, most of it went to zero is also what success looks like, provided one went up 100-fold. If you cannot hold enough separate bets for that one to be statistically likely to be among them, you are not running a venture strategy. You are gambling. Which is why access matters more here than anywhere else. A survey of 885 people at 681 venture firms found the average firm screens 200 companies a year and makes 4 investments, an acceptance rate of 2%, and that only about 1 deal in 10 arrives unsolicited from management. The chain runs like this. Returns are dominated by a few extreme winners. There are only a few such companies in any period. The best founders choose their investors on reputation. So the strongest reputations get first look, and winning begets access. The corollary is uncomfortable. In public equities, being average is a perfectly good outcome. Buy the market cheaply and get the market return. In venture capital, the average is not what is being sold, and it has not always been good. That same public market equivalent work found American venture funds beat public equities in the 1990s and underperformed in the 2000s, with vintages from 1999 to 2002 at 9/10 or below. So the real question is whether you are being offered a fund that turns companies down, or a fund that will take your money because the funds you actually wanted did not need it. Where the top slice is everything, easy access is itself a warning sign. One risk is specific to venture: dilution. Each funding round issues new shares, so your slice shrinks unless you invest again, which is why the contractual right to invest again is among the most valuable things a venture investor holds, and one a retail wrapper may not give you. On fees, venture is worse than buyout on every axis, including that the 8% hurdle is described in the research as a buyout feature, not a venture one. How to decide? Can you access it at all, or only through a wrapper that changes the economics? What is the multiple, not just the rate of return, and does that rate include a subscription line? What is the public market equivalent, and if nobody will produce one, that is information. Can you be locked up for a decade in a personal emergency? And the comparison is not private equity versus cash. It is a cheap global index fund held the same period with no lockup. None of this is advice. Next, the 2 private markets being sold to ordinary investors even faster: lending outside the banking system and property. Chapter 13, private credit and property. Like private equity, neither subject here appeared on the original commissioning list. Both are real gaps. Lending outside the banking system barely existed as a retail proposition 20 years ago, and property is the asset most people assume they already understand because they own a home. Start with private credit. The cleanest definition comes from staff at the Federal Reserve Board in a note published in February 2024. Private credit means debt-like, non-publicly traded instruments provided by non-bank entities to fund private businesses. Terms are negotiated bilaterally between one borrower and one lender, which is why it is called direct lending. The loans are typically senior secured, and almost all are floating rate. And the Fed staff add the phrase that matters. This happens without the need to comply with traditional regulatory requirements. In plain English, a fund raises money from investors and lends it directly to medium-sized companies. It is doing what a bank does, but it is not a bank, it has no depositors, and it is not regulated like one. Why did it grow? Banks retreated after the 2008 crisis as capital requirements rose. Borrowers paid a premium for speed and certainty, and some were too indebted for a bank anyway. And investors wanted yield through a decade of very low rates, attracted by promises of diversification and low correlation to public markets. Hold that phrase. Low correlation in a privately valued asset is often the measurement artifact from the last chapter, not a property of the asset. On scale, the Fed note cites commercial data putting total private credit at nearly $1.7 trillion as of June 2023. And as of the end of 2021, individual investors already held about 9% of private credit fund assets. This is not a hypothetical retail question. Floating rate is the strongest technical argument for the asset class, and it cuts both ways. It means the interest the borrower pays is a margin over a benchmark rate that resets periodically. A fixed-rate bond falls in price when rates rise. A floating-rate loan's coupon simply goes up, so its price barely moves. That is genuinely an advantage. But the borrower's bill rises automatically too, and these are, by construction, borrowers who could not get bank funding. The Fed staff say it directly. Higher payments on floating-rate debt could stress borrowers' balance sheets, leading to a significant increase in defaults in an economic downturn. Interest coverage, meaning how many times earnings cover the interest bill, had fallen to a mean of around 2 times, against roughly 2.7 for leveraged loan borrowers. So, plainly, floating rate means you do not lose money when rates rise. You lose money when rates rise so far that the borrower cannot pay. The risk moved from interest rate risk to credit risk, and credit risk arrives all at once. Here is the most underappreciated number. Despite that senior secured label, the Fed staff put post-default value on a direct loan at around 33%, against 52% for syndicated loans and 39% for high-yield bonds. The reason? More than half of private credit by value goes to sectors with few tangible assets, such as software and healthcare services. Senior secured sounds like a mortgage on a building. Increasingly, it is a first claim on a software company, and if a software company fails, there is not much to repossess. What regulators are saying as of August 2026 is consistent across 2 continents. Default rates have been low, but the Fed staff attribute that partly to a decade of low rates and add the sentence that should stay with you. The industry has yet to go through a prolonged recession. The Bank of England's Financial Policy Committee said the same of private markets as a whole in December 2025, and its July report named the vulnerabilities: high leverage, opacity, potential conflicts of interest around valuations, and strong interconnections with riskier credit markets. On valuation specifically, the American Securities and Exchange Commission's Examinations Division, in its priorities for financial year 2025, named valuation of illiquid assets, fees charged after the commitment period, fund-level lines of credit, and advisor-led secondary transactions. That is almost exactly the list from the previous chapter, arrived at independently by the regulator. One current practice deserves naming. With exits hard to come by, the Bank of England documents funds borrowing against their own portfolios and paying out the proceeds. You receive cash, which lifts the reported return, but nothing was sold and the fund is now borrowed at fund level 2. Now the part that most directly affects you. A classic private fund solves the liquidity problem brutally, no money back for a decade. That lockup is not a defect. It is what lets a manager hold through a downturn instead of selling into it. Individuals will not accept that in size, so the industry built evergreen and semi-liquid vehicles. Perpetual funds with no end date, holding illiquid assets, offering a limited right to redeem at intervals at a value the manager calculates. The mismatch is simple. The assets take years to sell. The redemption promise is measured in months. It works in normal conditions because redemptions are modest and can be met from cash, new inflows, and credit lines. The question is what happens when many investors want out at once, which is by definition the moment the assets are hardest to sell. Imagine a club that owns 20 houses and has 100 members, any of whom can ask for their share back each quarter. It works beautifully until the property market turns, everyone asks at once, and the club finds that selling 20 houses at speed means selling them cheaply. The promise of liquidity was never backed by liquid assets. It was backed by the assumption that you would not all ask at once. The American Interval Fund is the clearest example because its rules are written into federal regulation under the Investment Company Act of 1940. The redemption window is periodic, not continuous, an interval of 3, 6, or 12 months. Only a slice can be repurchased each time, and the rule says that slice shall not be less than 5% nor more than 25% of shares outstanding. If holders offer more than that, the company repurchases on a pro rata basis. The fund must also disclose when it may suspend a repurchase altogether. Work that as arithmetic rather than as a warning. If a fund offers a 5% quarterly repurchase and everyone tries to leave at once, you get 5% of your money back this quarter, and the pro rata rule means the queue does not clear, it repeats. Getting out entirely takes many quarters, during which the value of what remains can keep falling. That is the shape of your exit, and none of it is deceptive. It is disclosed in law. The protection is not that someone stops you, it is that you read the rule before you signed. 2 questions, then, for any such product. What share can be redeemed in one window, and who sets the price you redeem at? Now property. A real estate investment trust is a company that owns, and usually operates, income-producing property. The American Securities and Exchange Commission explains the bargain at its heart. Congress created them in 1960 so individuals could own a share of large-scale commercial property. To qualify, a company must hold most of its assets and income in real estate, and must distribute at least 90% of its taxable income to shareholders each year as dividends. In exchange, it deducts those dividends from its taxable income, so most such trusts pay out everything and owe no corporate tax. 90% is the American rule. Other countries set different thresholds. The consequence explains almost everything else. A company that must pay out nearly all its profit cannot retain earnings to fund growth. To buy more property, it must go back to the capital markets, issuing shares or borrowing. That makes these companies structurally dependent on access to capital, which is why they are so sensitive to interest rates and to their own share price. There are 3 types. Equity trusts own and operate buildings and are the majority. Mortgage trusts lend to property owners or buy mortgage-backed securities, and the regulator notes they tend to be far more leveraged. A mortgage trust is a leveraged bond portfolio wearing the same name, and someone buying one for its yield is taking a different risk from the one they intended. Now the critical distinction, listed versus non-traded. Listed shares trade on an exchange at real-time public prices for the cost of any other share with a minimum of 1 share. Non-traded shares trade nowhere. Redemption programs are, in the regulator's words, typically very limited and may be discontinued at the company's discretion. There is no independent information about share value. The company may provide an estimate 18 months after the offering closes. And typically it has no employees, being run by a third party under a management contract. Then the number. The Securities and Exchange Commission states that non-traded property trusts generally have high upfront fees that lower the value of the investment by a significant amount, and that they usually charge sales commissions and upfront offering fees of approximately 9 to 10%. The amount actually invested is reduced by those commissions. Work the arithmetic. If 10% goes to commissions and offering costs, then of every $100 you hand over, about 90 is put to work. To get back to 100, the property portfolio must first gain about 11% before any ongoing management fee, acquisition fee, or exit fee. You start a lap behind, and the person who sold it to you is already paid. The next warning is the one most likely to be missed. Unlike listed trusts, non-traded trusts frequently pay distributions in excess of their funds from operations, and to do so they may use offering proceeds and borrowings. In plain words, the product can pay you an attractive yield out of the money you and other new investors just put in and out of borrowed money. You can receive a check every quarter and be getting poorer the whole time. The defense is simple, and the regulator states it. Look at total return, not the headline yield, and check the source of the distribution. One more point from the same source. An external manager may be paid fees based on the amount of property acquisitions. A fee for buying pays the manager to buy, whether or not buying is a good idea. And that 9 to 10% covers broker-dealer commissions. On products the regulator notes are typically sold by financial advisors. The principle travels everywhere. The size of the commission predicts how enthusiastically a product will be recommended to you. A fairness note. That bulletin is dated December 2011. The market has changed, and I could not verify current terms. Treat those warnings as the documented record of what went wrong, not as a claim about any product on sale today. Interest rate sensitivity runs through 4 channels, usually blurred into one. Future rental income is worth less today when the risk-free rate rises. Income buyers get better paying alternatives, so the price adjusts until the yield competes. The distribution rule makes these companies habitual borrowers, so refinancing costs rise directly. And property is itself valued using rates, so higher rates cut valuations and strain loan covenants at once. For balance, they are not pure bond proxies. Rents can rise with inflation. Finally, the comparison with buying a building yourself. Direct property is one building, one street, one tenant, one country, sold over months at high transaction cost, at a price you only ever estimate. A listed trust is hundreds of properties, sold in seconds at a public price for the cost of one share. People say property is a great investment because you can borrow against it. What they mean is that leverage magnified their gains in both directions. But a trust's borrowing is not recourse to you personally. Your mortgage is. And here is the counterintuitive part. The two can hold similar assets and feel completely different to own because one has a visible price and one does not. In a downturn, the trust's price falls immediately and publicly, and you feel it. The direct owner sees nothing and feels fine. That is last chapter's valuation smoothing from the other direction. The difference in experience is real. The difference in economics is far smaller. The listed trust tells you the truth faster, which is at once its greatest practical disadvantage and its greatest analytical advantage. And if you already own a home, you already hold a concentrated, leveraged, single-country property position. How the manager earns. In private credit, a management fee plus a performance share, often above a hurdle. I will not quote levels. I could not source figures specific to private credit. Add fund-level borrowing, which magnifies both your return and their fee base. With internal management, the managers are employees, and their pay is a visible expense shareholders vote on. In externally managed and non-traded vehicles, the manager is a separate business selling services to the company you own, paid on acquisitions and on assets, with 9 to 10% leaving up front. One question separates the two worlds. Is the person managing this an employee of the company I own or a separate business selling to it? None of this is advice. Next, the oldest asset in the book, and the one with the most promotional literature written about it, metals. Chapter 14, Gold, Silver, and Copper. Buying gold is not one decision. It is two. First, do you want gold exposure at all? Second, through which of four legally and economically different instruments? The second question decides what you own, what it costs you every year, and what happens to you if the institution in the middle fails. One honesty note first. Bullion dealers earn the gap between the price they sell at and the price they buy at, so every article on a dealer's website explaining why you should own gold is a solicitation to cross that gap. Fund issuers earn a percentage of your money every year the fund exists, so their research explains why you should hold, never why you should not. And the World Gold Council, which produces much of the demand data everyone quotes, is funded by gold mining companies. I could not verify current dealer spreads, storage fees, or fund charges in this research pass, so I will describe the structure of each cost and refuse to invent a level. The first way is physical bullion, coins and bars you can hold. Legally, this is the cleanest ownership there is. No counterparty stands between you and the metal. First comes the dealer spread, which is the big one because it is charged immediately and in full at purchase. The day after you buy, your holding is worth less than you paid, at a price the market has not moved to justify. Spreads are wider on small units than on large bars. They are far wider on collectible and semi-numismatic coins, which is where the worst retail outcomes cluster, because a dealer with a large margin has every incentive to steer you toward the product with the largest margin and to dress that steer up as advice about rarity or confiscation. And spreads widen in a panic, exactly when you most want to transact. Then storage, a safe at home with the obvious security implications, or a vault charging an annual percentage of value, which rises with the gold price though the physical burden has not changed by a gram. Then insurance, because household policies commonly cap cover for valuables far below a meaningful holding. And then the cost nobody mentions, assay. Gold that leaves professional custody breaks the chain of integrity and may need testing or refining before the wholesale market takes it back. Taking delivery of your gold can permanently reduce what you can sell it for, which contradicts the take possession or you do not really own it advice that dominates retail gold marketing. The second way is an unallocated account. You give a bank or dealer money. They credit your account with a number of ounces. Your statement says you own, say, 200 ounces of gold. What you actually own is nothing made of gold. You own a claim on the institution for the value of 200 ounces. No bar carries your name. The obligation is a general liability on its balance sheet, identical in character to a customer deposit. Therefore, you are an unsecured creditor of that institution. Hear what that means, because it sounds procedural and is catastrophic. If the institution becomes insolvent, you do not get your gold, because there is no such thing as your gold. You take a place in the queue of general creditors, behind secured creditors who are paid first out of assets pledged to them, and you receive whatever the administration eventually distributes, years later, in currency rather than metal. And here is the cruel irony. You are exposed to precisely the event most people buy gold to protect against. Someone who bought gold because they feared a banking crisis and bought it unallocated holds a bank's promise that pays off worst exactly when a banking crisis happens. The hedge and the hazard are the same institution. These accounts are cheap and frictionless, with typically no storage fee. That is the tell. If you're not being charged storage, ask what is being stored. Free storage and allocated metal are close to mutually exclusive because real metal occupies space that costs real money. The third form, the allocated account, is the fix. Specific, serial numbered bars are identified as yours on a wait list. The metal is your property held in bailment. The custodian holds it for you, it is not on their balance sheet, and in insolvency it is segregated rather than distributed to creditors. You pay an explicit annual storage and insurance charge. So, allocated means you own metal and pay rent on it. Unallocated means you own a promise and get the storage free. Ask in writing which you have, and what happens to the metal if they enter administration. The fourth way is a physically backed fund, an exchange-traded fund, an ETF, whose only asset is bullion held by a custodian. You get institutional vault pricing rather than retail coin pricing, and you can trade in seconds. But the annual charge is deducted continuously, and the mechanism is rarely explained. The trust has no income because gold pays nothing, so the fee is paid by selling gold. The metal behind each share declines every day forever. You generally cannot redeem for metal, since redemption in kind is available only to large institutions. And the labels confuse. A trust holding allocated metal is one thing, while a note issued as a debt security may reintroduce issuer credit risk. A fifth route, futures, is the whole of the next chapter. What you own there is an obligation, not a substance. The cheapest exposure per dollar, the only one with leverage built in, and the only one that can force you out before you are proved right. So why does gold behave as it does? Gold produces nothing and has produced nothing for 5,000 years. An ounce today is an ounce in a century. Every valuation method needs cash flows to discount, so gold cannot be cheap or expensive the way a share can be. There is no denominator, and anyone quoting a fair value for gold is doing something other than valuation. If gold pays nothing, the cost of owning it is the yield you gave up. That opportunity cost is measured by the real interest rate, meaning the yield on a safe government bond minus expected inflation. When real rates are high, a bond pays you well after inflation and gold's zero is expensive. When real rates are negative, the safe alternative is guaranteed to lose purchasing power, and zero beats negative. But it is a tendency, not a law, and it has broken down for long stretches, including episodes when gold rose alongside rising real yields. Gold is also quoted in dollars, so a non-American holder of a dollar-denominated gold fund is running a currency position too, whether or not they meant to. Then central banks. Government Geological Survey figures published in January 2025, which take their demand data from the World Gold Council, and therefore inherit that conflict, put global gold consumption excluding funds at roughly 45% jewelry, 21% central banks and other institutions, 19% bars, 7% coins, and 6% electronics. Central banks matter more than that share suggests because they are price insensitive. Reserves held as another country's bonds are a claim on that government and can be frozen. Gold in your own vault cannot be. Gold is the only major reserve asset that is nobody else's liability, and that is a far stronger argument than anything in retail gold marketing. Now the corrective this chapter must not soften. Gold is sold as an inflation hedge, and the evidence over a human lifetime is weaker than the marketing claims. The best academic work here is Erb and Harvey's paper The Golden Dilemma, circulated by the National Bureau of Economic Research. Their conclusion is that gold may be an effective hedge if the investment horizon is measured in centuries, but that over practical investment horizons gold is an unreliable inflation hedge. They also find that when gold's real price has been above its historical average, subsequent real returns have been disappointing. So if your horizon is shorter than the Renaissance, the honest reasons to hold gold are diversification and the fact that it is nobody's promise, not an expectation that it tracks next year's inflation. Silver has a split personality, and the structural fact behind it is that silver is mostly not mined on purpose. The Geological Survey reports it is obtained primarily as a byproduct from lead zinc, copper, and gold mines, with polymetallic ores accounting for more than 2/3 of world silver resources. So supply barely responds to the silver price. A zinc mine does not dig faster because silver rallied. Combine price-insensitive supply with demand that swings between industrial buyers and speculators, and you get silver's defining behavior. It moves further and faster than gold in both directions. The demand split is the other half. On that survey's estimates of American uses in 2024, investment bars were 30%, electrical and electronics 29%, coins 12%, solar photovoltaics 12%, jewelry 6, brazing 4, and other industrial uses 7. Group those and investment demand is about 42%, industrial about 52%. Silver is half monetary and half industrial, pulled by the Firandreal rate story and by the manufacturing cycle at once, and those two do not always pull together. The volatility is not an adjective, it is arithmetic. In 2024, silver averaged $27.70 an ounce, 18% above the year before. Within the first 10 months of that year, it began at $24, fell to $22 on the 22nd of January, and reached $34.60 on the 22nd of October. The high was 57% above the low, inside 10 months. Which brings us to the gold-silver ratio, the gold price divided by the silver price. From those official annual averages, it ran between roughly 71 and roughly 87 over the 5 years to 2024. The trading claim is that it reverts to a mean, so when it is high, you sell gold and buy silver. I could not find independent peer-reviewed evidence that it predicts anything, so I leave it open rather than assert it either way. What can be said from reasoning is that the ratio has no stable anchor. People cite a historical ratio of about 15 or 16 to 1, but that came from an era when governments legally fixed it under bimetallic monetary standards. Reverting to a level set by a monetary regime that no longer exists is not mean reversion. It is nostalgia. And note who repeats it loudest: people who sell silver. Copper has no monetary role at all. No central bank holds copper reserves. Its price is a demand-for-things price. On official figures for American end uses, building construction is 42%, electrical and electronic products 23%, transportation 18%, consumer goods 10%, and industrial machinery 7%. Read that carefully. The largest single use of copper is buildings, and anyone sold copper as an energy transition play should know it. Does the Dr. Copper claim hold up, that copper diagnoses the world economy in real time? Partly. Construction, electrical, transport, and machinery together are 90% of American end use, and copper cannot be re-rated by sentiment the way a share can. But it is largely diagnosing one patient. A single country refines about 44% of the world's copper, so the price often reads that country's property policy rather than the world's health. And supply shocks masquerade as demand signals, since a strike or falling ore grades move the price while saying nothing about the economy. Use it as one input, never as an oracle, and note that the nickname is repeated most enthusiastically by people selling copper. The structural point is concentration. The top 3 mining countries, Chile, the Democratic Republic of Congo, and Peru, account for about 49% of world mine supply, and Chile alone holds roughly 19% of reserves. But refining is concentrated in a single country at about 44%. Mining copper is concentrated in 3 countries, refining it is concentrated in 1. The West worries about where metals are dug up. The harder problem is where they are refined. On electrification, the strongest part of the case is supply lead times. New deposits take many years from discovery to production, while grids, vehicles, and data centers are copper-intensive in ways the last century was not. But construction is still the largest and most cyclical block of demand. Recycling contributes about 35% of American copper supply and grows when prices rise. And aluminum in power cable becomes economic precisely when copper is expensive. High prices contain their own antidote. How do banks and dealers earn? 5 places, and only one is itemized. The bullion dealer's two-way price is their revenue, charged in full at purchase and again at sale, never shown as a fee. Vaults charge an annual percentage of value for storage and insurance paid out of capital because the asset yields nothing. A fund's annual charge is paid in metal, so gold physically leaves the vault to pay the sponsor. On unallocated accounts, the absence of a fee is itself the revenue model. And on futures and margin accounts, brokers earn commissions and, quietly, the interest on pooled client cash. None of this is advice. Decide why you want this, diversification, inflation, or distrust of institutions, because the reason dictates the form and distrust of banks rules out unallocated. Set the size in advance rather than after a rally. Then ask 3 questions of any metals product. What is the spread? What is the annual percentage? And what happens to my money if the institution fails? Next, the chapter that explains why the commodity went up and your commodity fund went down. Chapter 15, Commodities and Futures. This is the most technical chapter in the series. If you take one idea from it, take the role. It explains why an enormous number of people have bought a commodity fund, watched the commodity price rise, and watched their investment fall. That is the normal behavior of these products, and it is not a scam. It is arithmetic that almost nobody explains at the point of sale. Start with what a futures contract is. It is a standardized, exchange-traded, legally binding agreement to buy or sell a fixed quantity of a specified grade of something, at a price agreed now, for delivery at a stated future date. Standardized because the exchange fixes the quantity, grade, and date, which is why the market is liquid. Every March gold contract is identical to every other, so you can close a position by trading with anyone. Exchange-traded because once a trade is matched, the clearinghouse steps between the two sides and becomes buyer to every seller and seller to every buyer, which is why futures do not carry the counterparty risk a private forward does. And binding because unless you close before expiry, you are obliged to deliver or receive physical goods. Almost nobody does, but the obligation is real, and in April 2020, it became very real for some people. A bakery agreeing in September to buy wheat at a fixed price for March is not speculating, it is buying certainty about its input cost. Speculators take the other side and are paid, sometimes, for absorbing the risk it shed. Futures markets were built for hedgers, and the retail investor is a guest in someone else's house. Every contract is defined by a specification the exchange publishes, and 4 numbers matter. The contract unit, meaning how much stuff one contract represents, the price quotation, the minimum price movement, called the tick, and the expiry calendar. A caution before any figure. The exchange's specification pages blocked automated retrieval during this research, so I give the long-standing published contract sizes and will not state tick sizes or current margin levels. One gold contract is 100 troy ounces. One silver contract is 5,000 troy ounces. One copper contract is 25,000 pounds. One American crude oil contract is 1,000 barrels. Now the arithmetic that matters more than any market view, using a round illustrative number rather than a real price. Suppose gold were $3,000 an ounce. One contract of 100 ounces represents $300,000 of gold. That is the notional value, and it is what you control. A 1% move in gold is a $3,000 change in your position. If you posted $15,000 of margin, that 1% move is a 20% move in your equity, and a 5% move in gold would be a 100% move in your equity. That is leverage, built in by default, with no switch to leave it off. Most people who blow up in futures did not misjudge the market. They misjudged the size of their own position. Size by notional, never by margin. Margin itself is misunderstood. Buying shares on margin means borrowing money and paying interest. Futures margin is not a loan. It is a performance bond, a good faith deposit lodged with the clearinghouse to show you can absorb a day's adverse move, so no interest is charged on the notional. There are 3 margin numbers. Initial margin, what you post to open. Maintenance margin, the threshold your equity must stay above. And variation margin, the cash moved each day between winners and losers. That daily movement is called marking to market, and it is what makes futures unforgiving. At the end of every session, the clearinghouse sets a settlement price, every open position is revalued at it, and losses are collected in cash and paid to the winners the next morning. Your paper loss is not a paper loss. It is a real cash debit every day. Compare shares. If a share falls 30%, nothing happens operationally and nobody asks you for money. In futures, if your equity drops below the maintenance level, you get a margin call. Post more cash, usually within one business day, or the broker closes your position at whatever price the market offers. The cruelty has 3 parts. It arrives when you are already losing. Its deadline is measured in hours. And being right eventually is worthless if you are liquidated first. A position can be closed at a loss on the way to a price that would have vindicated you. Solvency is a constraint that operates independently of correctness. 2 more things, and the first must be unmistakable. Your loss is not capped at the margin you posted. With shares, the worst case is that the investment goes to 0. With futures, the price can move further than your deposit covers, and you owe the difference. You can lose more than you put in, and brokers will pursue the balance. Second, exchanges raise margin requirements without notice when volatility rises, forcing liquidation precisely when prices are worst. Now the heart of it. Because a futures contract has a date attached, there is not one price for a commodity but a whole curve, one price for each delivery month. Contango means later contracts are priced higher than nearer ones, so the curve slopes upward. This is the normal state for storable commodities. Whoever holds physical oil or metal until March must pay for storage, insurance, and the financing cost of the money tied up in it. That is the cost of carry, and the March price embeds it. Backwardation means later contracts are priced lower than nearer ones. That happens when there is a shortage now, and people will pay a premium to have the commodity in hand today. That premium is the convenience yield. Backwardation is a market shouting that it is short of the physical good right now. The analogy: Contango is the umbrella that costs more for November delivery than today because the shop has to store it for you. Backwardation is the umbrella that costs more today because it is raining now. Here is the pivotal fact. A futures contract expires, so a fund wanting continuous exposure must, before each expiry, sell what it holds and buy a later-dated contract. That is rolling. It is not optional, not occasional, and not free. The gain or loss from that swap is roll yield. In Contango, the fund sells the cheap near contract and buys the more expensive far one, systematically selling low and buying high every roll forever. In backwardation, it does the reverse and is paid to hold. Let me work it slowly, with illustrative round numbers rather than market prices. Take a fund with $1,200 that always holds the front-month contract, in a market where each next month trades $10 above the one before. And here is the key assumption, stated openly: the spot price never moves. The commodity is at $100 on day 1 and $100 a year later, so you expect to have made nothing. Month 0, spot is 100. The 1-month contract trades at 100, the 2-month at 110. The fund buys 12 contracts at $100, which is $1,200. Month 1, spot is still 100. At expiry, the front contract has converged to spot, so it is worth 100 and the fund made nothing on it. The fund sells at 100 and buys the next month at 110. Its $1,200 now buys only 10.91 contracts. Month 2, spot is still 100. The contract it holds converges towards spot and is worth 100. The fund is now worth 10.91 times 100, which is $1,091. It has lost 9% while the commodity did not move at all. It rolls again into the 110 contract, buying 9.92 contracts. Month 3, it is worth $992. Each roll multiplies the fund's value by 100 over 110. After 12 monthly rolls, $1,200 has become $382. Sit with that. The commodity is at exactly the price it started at. The fund has lost 68% of its value. Nothing went wrong. Nobody was defrauded. The fund tracked its stated benchmark faithfully. The loss is the structural cost of continuously renting exposure to something that costs money to store. 2 qualifications. Real contango is usually much shallower than $10 a month, so real bleed is slower. The direction is the lesson, not the magnitude, and it compounds. And in backwardation, this runs in reverse, and the fund gains relative to spot, which is much of why long-run studies of commodity returns looked more flattering than the recent experience of fund holders. So, honestly, your return is spot return, plus roll yield, plus interest on the collateral minus fees. Only the first is the one you thought you were buying. That is why holders of commodity funds feel cheated and are not being cheated. They compared the fund's chart with a spot price chart, saw a gap, and inferred incompetence. The gap is the roll. A front-month futures fund is not a way to own a commodity. It is a way to own a rolling series of short-dated bets, plus a cash deposit. Some issuers now spread holdings across the curve, which mitigates but does not abolish it, and note the conflict. The funds most eager to explain roll yield are selling the improved roll product. Then the episode that made all this vivid. On the 20th of April 2020, the American crude oil futures contract for May delivery settled at minus $37.63 a barrel, the first negative settlement in the contract's 37-year history. That date and figure come from the interim staff report of the Commodity Futures Trading Commission, published that November. The report identified contributing factors: a market already oversupplied, a severe collapse in demand, concerns about the availability of storage, and unusually high open interest going into expiration. The regulator was explicit that a root cause analysis was beyond the report's scope, and I will not go further than it did. A futures contract is a promise to take delivery of physical barrels at a specific place. With storage full, holders approaching expiry faced receiving oil they had nowhere to put, so rather than take delivery, they paid others to take the contracts away. The price went below zero because the obligation had become a liability rather than an asset. Storage capacity, not the value of oil, set the price. 3 lessons follow. A futures price is the price of an obligation, not of a substance. Substances cannot be worth less than nothing. Obligations can, and any product deriving its value from front-month futures inherits that. Front-month exposure is the most fragile point on the curve, where liquidity thins into expiry and where the roll happens, and retail products congregated there because it looks the most spot-like. And it cannot go below zero was a widely held belief that was wrong. Retail traders were reported to have been left owing more than they deposited, but I could not verify that from a named regulatory or court source, so treat it as unverified. So how do banks and brokers earn? Commissions, exchange fees, and clearing fees are the itemized and usually smallest cost, charged per contract on entry and exit. The level is not the point, the interaction with leverage is. Compute the fee as a percentage of the margin you posted, not of the notional, because a broker's marketing computes it the other way. That is why futures brokers are happy to see active trading. Then the quiet lines. Client cash sitting at the broker as margin earns interest, and the client typically receives little or none of it. Spread bets, contracts for difference, and margin loans genuinely lend you money and charge a daily financing rate that compounds into a silent drag on anything held for months. And the roll itself is revenue for the market makers taking the other side. None of those 3 appear on a fee schedule. The largest and best hidden margin is in commodity-linked notes. Such a note is a bond issued by a bank whose redemption value is linked by formula to a commodity, often with a capital protection feature and a cap. The bank builds the payoff from a zero-coupon bond plus options and sells the package above the cost of assembling it. That difference is the structuring margin. It is taken on day one, and you are almost never shown it. Because the components are bespoke and not separately quoted, you cannot price check it, and that opacity is why the margin can be as large as it is. The note is also an unsecured obligation of the issuing bank, so if the bank fails, the capital protection fails with it, the same defect as the unallocated gold account in a better costume. I could not source figures for typical structuring margins, so I name the mechanism, not a number. None of this is advice, and this chapter covers products that can lose you more than they cost. If you want commodity exposure, understand that you are buying spot return plus roll yield plus collateral interest minus fees, and be explicit about whether your view is a cyclical trade or a multi-year structural one, because a multi-year view expressed through a front-month fund will likely be defeated by roll cost first. Next, the largest market in the world, and the fee you are never shown. Chapter 16, Foreign Exchange. You will probably never decide to trade a currency. You will pay for currency trading anyway, several times a year, for the rest of your investing life, and in most cases, nobody will ever tell you how much. Here is when it happens. You buy a share listed in New York while you hold pounds, or euros, or Singapore dollars. A conversion happens on the way in and a second one on the way out when you sell. You hold a fund that invests around the world. Conversions happen inside that fund every time the manager buys or sells, and they are paid by the fund, which means paid by you, and they generally do not appear in the headline charge figure. A dividend arrives from an overseas company. It arrives in a foreign currency, and something converts it into yours. You tap your card in a shop abroad or on a foreign website. You send money to a child studying overseas. Every one of those is a currency trade, and at every one of them a price is set by the institution rather than by the market, and the difference is kept. This is, in my opinion, the clearest answer in this entire series to the question, how do banks earn the most from ordinary people? Not because the margin is large. It is often well under 1%. Because the volume is colossal, the pricing is invisible, and you have no reference price to compare it against unless somebody tells you one exists. So let me tell you, the reference price is called the mid-market rate. It is also called the interbank rate, or just the mid. Every quoted exchange rate has two sides. A dealer will buy euros from you at one price and sell euros to you at a higher one. The mid is the midpoint between those two. It is the rate you see on a financial news site, and it is very close to the real price of the currency, because it is roughly where large institutions trade with each other. It is almost never the rate you receive, and here is the mechanism which I want you to hold on to for the rest of the chapter. When you convert money, your bank usually does not charge you a fee. It gives you a rate. Suppose the mid is £1 to $1.25 and your bank gives you 1.225. You have not been charged anything. There is no line on your statement, there is nothing to object to, but 2% of your money has just become the bank's revenue. Check the arithmetic with me. The gap is 0.025 divided by 1.25 is 0.02. 2%. On a £10,000 transfer, £200. That gap has a name, the spread, or the foreign exchange margin, and the gap is the fee. There is no other fee. The two features that make it the ideal revenue line are worth naming out loud. First, enormous volume. It touches every cross-border transaction of every kind. Second, invisible pricing. Because it is embedded in a rate rather than itemized, there is nothing to compare, nothing to query, and nothing that shows up when you add up what a year of investing cost you. Now let me show you a firm that tells you, because the honest example teaches better than the villainous one. The British investment platform Hargreaves Lansdown publishes its overseas dealing charges plainly. As published in August 2026, its foreign exchange charge is 0.99% on the first £10,000 of a trade, 0.50% on the next £15,000, and 0.20% above £25,000. Those are the firm's own published numbers, not an estimate. And the wording matters as much as the tiers. The firm states that the share price is converted into pounds at the prevailing interbank exchange rate. On foreign dividends, it goes further, and I will quote it. The conversion rate used will be based on the prevailing interbank exchange rate, to which we add an additional spread of 1% as our charge. Read that again. The provider names the interbank rate. It knows exactly what the mid is. It starts from the mid and adds a margin. That is the mechanism I described a minute ago, admitted in writing by a large reputable firm. Three things follow. The first is the tiering. A small investor pays 0.99%, a large one pays 0.20%, roughly 5 times the rate per pound for an identical operation. That is not a scandal. It reflects fixed costs, but it is happening to you at the higher tier by default. The second is the dividend line, which is the quiet one. A portfolio yielding 3% in foreign dividends charged 1% on the conversion, loses 0.03% of its value every year forever, and no statement will ever name it. Small, but it is pure leakage and it recurs. The third is the one that should genuinely unsettle you. This is a firm that tells you. Now go and find out what your own provider charges. Notice how hard that is. And if you think I am overstating the invisibility, consider what the world's financial authorities have committed to. The Financial Stability Board, the international body that coordinates financial regulation for the largest economies, published targets in October 2021 under the Group of 20 Roadmap for Cross-Border Payments. One of those targets is that, by the end of 2027, all payment service providers should give customers, at minimum, the total transaction cost, showing all relevant charges, including the exchange rate and currency conversion charges. Sit with that for a moment. A target has been set for the year 2027 that providers should tell customers what the currency conversion charge is. A target implies it is not happening now. That is not a consumer blogger's complaint. That is the Financial Stability Board, in a published final report, treating customers cannot see the foreign exchange margin as a problem serious enough to need a multi-year international program. The same document records the global average cost of sending a $200 remittance at 6.38% as at the first quarter of 2021 on the World Bank's measure. I cannot give you the current figure, I could not verify it, so I will not invent one. So here is your tool, and it takes 30 seconds and works everywhere forever. Before you convert, look up the mid-market rate for the pair. Look at the rate you are being offered. Subtract, divide by the mid, multiply by 100. That number is the fee. It does not matter what the provider calls it or whether they call it anything at all. And treat the words no fee and zero commission on a currency service as information. They almost always mean the charge is in the rate. Free conversion is not a thing. Somebody is being paid. One related rule. When a card machine or a foreign website offers to charge you in your home currency, that is dynamic currency conversion, and the conversion is then done by the merchant's processor at a rate it chooses rather than by your own card network. Always choose the local currency. I have seen no regulator-published figure for the typical margin, so I am giving you the rule and not a number. Now the market itself, briefly, because it explains why the pricing works this way. The authoritative measurement is the Bank for International Settlements Triennial Survey, published in September 2025 and covering trading in April 2025. Average turnover in over-the-counter foreign exchange markets was 9.6 trillion United States dollars per day, up 28% from 7.5 trillion 3 years earlier. Per day. World merchandise trade is measured in the low tens of trillions per year. The overwhelming majority of currency trading is not people buying goods from other countries, it is financial. The largest single instrument is not even buying a currency, it is the foreign exchange swap, an agreement to exchange currencies now and reverse it later, which is in substance short-term borrowing. Roughly 2/5 of the world's largest market is plumbing. The phrase over-the-counter is the whole story. There is no foreign exchange, there is no building. Currencies are traded bilaterally. You ask a dealer for a price and the dealer quotes 3 consequences. There is no single official price. The dealer can show different prices to different customers, which is legal, normal, and the mechanism by which retail pays more than institutions for the identical trade. And the dealer's compensation is the spread, not a commission line. Even the European Central Bank, which publishes daily euro reference rates, states that they are published for information purposes only and that using them for transaction purposes is strongly discouraged. That is honest, and it makes your position clear. There is no official price you are entitled to. One more number worth carrying. The United States dollar is on one side of just under 90% of all foreign exchange trades in the world. Not 90% of trades involving America, 90% of all of them. Which brings us to people who trade currency deliberately. Currencies move far less than shares. A major pair moving 1% in a day is a notable day. That is precisely why retail foreign exchange is sold with enormous leverage, meaning borrowed exposure. Without it, there is nothing exciting to sell. At 30 to 1, a 1% move in the pair becomes a 30% move in your money. The product is not dangerous despite currencies being stable. It is dangerous because they are stable and the industry compensated with leverage. The outcome data is published by regulators who have no revenue interest in it. The European Securities and Markets Authority, supporting its 2018 intervention, cited national regulator data indicating that 74 to 89% of retail accounts typically lose money, with average losses per client ranging from €1,600 to €29,000. The Australian Securities and Investments Commission, reviewing 5 weeks in March and April of 2020 across 13 providers, found retail clients had a net loss of $774 million Australian dollars, over 1.1 million positions closed out by margin rules, and more than 15,000 accounts pushed into negative balance, owing money to the broker, having already lost everything they deposited. And consider what regulators did about it. In Europe, the United Kingdom, and Australia, every advertisement for these products must state the percentage of that provider's own retail accounts that lose money. There is no other consumer product where the law requires the seller to print its own failure rate on the advertisement. Not cigarettes, not gambling. Go and read the small line at the bottom of the next one you see. That is more persuasive than anything I can read to you. To be fair to the market, it is genuinely deep and liquid. It runs around the clock 5 days a week. It is not driven by company earnings, so it offers a genuinely different return stream. And for a business or a person with income in one currency and obligations in another, hedging is real risk management, not speculation. None of that is an argument that a leveraged retail account will make money. The published outcome data is the argument against that. So how do they earn? 6 ways. The conversion spread, largest by far and invisible. The spread on leveraged trades, quoted commission-free and paid in the price. Overnight financing on positions held past the daily cutoff, charged every day. Explicit commission, which is the smallest and most honest line. Interest on the cash sitting in your account, mostly kept. And in some models, the broker simply takes the other side of your trade, in which case your loss is its revenue. For scale, one audited figure. Morgan Stanley's 2025 annual report discloses foreign exchange trading revenue of about $1.7 billion for the year in one division of one bank. Decide with questions, not rules. What is the mid right now, and what am I being offered? How many conversions does this actually involve? Does my platform publish its charge at all? And if it takes more than 2 minutes to find, that is the answer. Am I paying the retail tier when I could aggregate into fewer, larger conversions? And do I actually want currency exposure, or am I merely tolerating it? Because currency risk is two-sided and may partly wash out over decades. Currency cost never washes out. It is paid every time in the same direction. None of this is advice. It is a cost you are already paying and can measure in 30 seconds. Next, a product where the cost is not hidden in a rate but in the shape of the payoff itself. Options. Chapter 17. Options, the mechanics. An option is a contract about a future transaction that one side can walk away from. One party pays money today for the right, not the obligation, to buy or sell something at an agreed price, up to an agreed date. The other takes that money and accepts the obligation to be on the other side if the first decides to go ahead. The asymmetry is not a quirk of the product. It is the product. Take a house listed at £500,000. You are not ready to buy, but you want to lock the price, so you pay the owner £5,000 for a written agreement. For 6 months, you may buy the house for $500,000 if you want to. If it rises to $560,000, you go ahead and you are $60,000 better off, less the $5,000 you paid. If it falls to $450,000, you walk away, having lost exactly £5,000 and not a penny more. The owner banked $5,000, and that is all they can ever make. If the house goes to 700,000, they must hand you a 700,000 pound house for 500. The buyer's downside is capped and their upside is open. The seller's upside is capped and their downside is open. That deal is a call, the right to buy. The mirror image is a put, the right to sell at a fixed price, which gains value when the thing falls. A put is insurance, not a metaphor, structurally what it is. Every listed option is specified by 5 facts, and the intimidating grid on a broker's screen, the option chain, is just a table of every combination of them with prices. The underlying, usually a share, an index, or a fund. Call or put. The strike, the fixed price at which the buying or selling would happen. The expiry, the date after which the right vanishes, set by the exchange, not chosen by you. And the premium, what it costs. 4 of the 5 are fixed when the contract is created. Only the premium moves. That turns the chain from a wall of numbers into a price list for a catalog of fixed products. One arithmetic trap, because it catches everybody. In the United States, one standard equity option contract covers 100 shares. A quoted premium of $2.50 does not cost $2.50, it costs $250. Sizes differ elsewhere, so carry the principle. A contract is a bundle, and you must check the bundle. Next, moneyness, the answer to, if this expired right now, would it be worth anything? A call is in the money when the share is above the strike, at the money when it is level, out of the money when it is below. For a put, reverse that. Plainly, in the money means you would use it, out of the money means you would not bother. Now the 2 halves of the premium, which is where the losses come from. Premium equals intrinsic value plus time value. Intrinsic value is what the option would be worth if it expired this instant. For a call, the share price minus the strike, and never below 0, because you would simply not exercise. Time value is everything else. The market's price for the possibility of favorable movement before expiry. Treat this as arithmetic, not a market quote. A share trades at $105. A call struck at 100, expiring in 3 months, costs $8. Intrinsic value is 5. Time value is 3. You are paying 5 for value that exists today and 3 for the chance of more. 2 consequences. An out-of-the-money option is entirely time value, nothing solid in it at all, purely a bet on movement. And time value only ever goes to 0. At expiry it is nil, and the option is worth its intrinsic value and nothing else. One way. Now the part that has to land. Long an option means you bought it. You hold the right, and your maximum loss is the premium you paid, exactly that, and it cannot exceed it. Short an option means you sold it, also called writing it. You hold the obligation, and your maximum gain is the premium you received, fixed on day 1, and nothing can make you more. The same thing in money. A share trades at $100. A call struck at 100, 3 months out, is priced at $5 per share, so $500 for one contract. The buyer paid $500. If the share finishes at 80, the option is worthless and the buyer loses $500. At 95, worthless minus $500. At 100, worthless minus $500. At 105, it is worth $500 and the buyer breaks even. At 120, up $1,500. At 200, up $9,500. At 400, up $29,500. Read the loss side downward and notice what matters. It stops at minus $500 and stays there forever, whether the share falls to 80, to 40, or to 0. The buyer's worst case was fixed the moment they paid. The seller's table is the same numbers with every sign flipped. Plus $500 at 80, at 95 and at 100, 0 at 105, minus $1,500 at 120, minus $9,500 at 200, minus $29,500 at 400. Now read the gain side downward. It stops at plus $500 and stays there forever. The loss side does not stop. The buyer of that option risked $500 to make an unlimited amount. The seller risked an unlimited amount to make $500. Those are the 2 seats at this table, and before you sit down, you should be very clear which one you are in. One precision, so I do not overstate it. Unlimited is literally true for a sold call. while a sold puts loss stops when the share hits zero, $10,000 on that 100-strike put against 500 received. Note the buyer's break-even, 105, not 100. The share had to rise 5% before the buyer made a cent. Being right about direction is not enough. Which brings us to the four forces acting on your position, known as the Greeks. They are usually introduced as calculus. They do not need to be. A Greek is a sensitivity. If this one thing changes, how much does my position change? You already think that way about a mortgage and an interest rate. Delta answers. If the share rises by $1, how much does my option rise? A call with a delta of 0.4 gains about $40 on a 100-share contract. Better still, delta is roughly how many shares you are effectively holding. That call behaves for small moves like owning 40 shares. Which explains the leverage. $500 bought something that moves like $4,000 of stock. Delta is also, roughly, the market's estimate of the probability the option finishes in the money, which kills the phrase cheap option for good. An option costing 15 cents is not cheap. It is priced. It is inexpensive because it is unlikely. Gamma answers. How fast does that exposure change? It is how quickly your position turns into something else, and it is highest for at-the-money options close to expiry. An option at the money on expiry morning is the most unstable instrument in the market. Its delta can swing between almost nothing and almost fully exposed, repeatedly, within hours. Theta answers. If nothing else changes and one day passes, how much do I lose? This is where most retail option losses come from. An option is a melting ice cube. Every day removes a little of what you paid for and never puts any back. Theta is negative for the buyer and positive for the seller. The buyer pays rent every day, the seller collects it. That is the entire economic content of option selling. The seller is paid to wait. Two things about theta surprise people. It is not linear. It accelerates, so the last week costs proportionally far more than the first month, and it does not take weekends off. The contract expires on a calendar date. Friday afternoon to Monday morning is 3 days closer to expiry and priced accordingly. You pay for 3 days and receive no trading sessions of opportunity. Markets close, the clock does not. So, if you own an option and absolutely nothing happens, you lose money. Every day. That is not bad luck. That is the product working as designed. You bought time, and time is the one thing you are guaranteed to run out of. Vega answers. What happens if the market gets more nervous? Every option, call and put alike, is worth more when the market expects bigger moves, because the possibility of a large favorable move is what the buyer pays for. Buyers gain when expected volatility rises, sellers gain when it falls. And it holds regardless of direction, which needs saying plainly, volatility is not direction. It is how far things are expected to move, not which way. There is a fourth Greek, rho, for interest rates. Over the horizons here it is small, and I am leaving it out rather than skipping it quietly. You do not have to calculate any of these. Your broker displays them. Read them as a sentence about your own position. I am effectively long about 40 shares. My exposure will change quickly if the stock moves. I am paying about $11 a day to hold this, and I will lose money if the market calms down even if I am right about direction. If you cannot say that sentence, you do not know what you own. That last clause needs explaining because it produces the outcome beginners find most bewildering. Options are priced by a model taking several inputs: share price, strike, time, interest rate, and how much the share is expected to move. 4 are observable facts. The 5th is not. Nobody knows future movement. So the market runs the model backwards. Feed in the price people are paying and solve for the missing input. What falls out is implied volatility, not a forecast somebody made, but a forecast reverse-engineered out of the price. Most usefully, implied volatility is the options price, restated in different units. Now the trap. Buy an option when the market expects a big move and you have paid for a big move. Take company results. Beforehand, uncertainty is high, so implied volatility rises and options get expensive. The results come out, the uncertainty is resolved, regardless of the answer, and implied volatility collapses. That is not a malfunction, it is the removal of an uncertainty that no longer exists. So, you buy a call before results, the company beats expectations, the share opens up 4%, and your call is worth less than you paid. You were right, and you still lost. Because the share goes up was never the bet you made. The bet was the share goes up more than everybody already expects. Only one of those was on the ticket. Finally, the end of the contract. 2 words describe one event from opposite sides. Exercise is what the holder does. Assignment is what happens to the writer they are told to perform. The clearinghouse randomly assigns exercise notices to brokers holding matching short positions who allocate to customers by their own disclosed method. So if you are short and in the money, you do not choose to be assigned and cannot predict it. It arrives. One genuine comfort. The clearinghouse stands between the 2 sides, so you are not relying on whoever sold you the option. Contracts also differ in when the right can be used. American-style options can be exercised any day up to expiry, European-style only at expiry. Nothing to do with geography. The clearinghouse states that all standardized equity options are American-style, and most, though not all, index options are European-style. Early assignment is possible only on the American-style ones, and it arrives without warning. And if the holder does nothing at expiry, out of the money, it expires worthless and vanishes, and the loss is the premium. In the money, doing nothing is not the same as nothing happening. The clearinghouse operates a procedure called exercise by exception, and the published threshold is 1 cent. An equity option 1 cent in the money at the close is exercised by default. Exercising a call means buying 100 shares per contract. So 10 forgotten contracts on a $100 share become $100,000 of stock arriving in an account that may hold a fraction of that, and on Monday your broker wants the money. The clearinghouse's own guidance to customers is printed in capital letters. Give your broker explicit instructions to exercise or not exercise any expiring contract. Doing nothing is not the safe option. It is a decision somebody else executes on your behalf. That is how the machine works, and none of it is advice. Next, who wins on each side of it, what the evidence says about how retail investors do, and how the money is made on the other side of your trade. Chapter 18, Options, Risk, and Who Profits. Start with the most important empirical fact about options. The amount of movement priced into an option, its implied volatility, tends, on average and over time, to exceed the movement that actually turns up afterwards. Options are, in aggregate, priced above what subsequent movement would justify. The gap has a name, the volatility risk premium. This is not folklore. Bakshi and Kapadia, in the Review of Financial Studies in 2003, showed that portfolios which own options and hedge away the directional bet lose money on average. Strip out the direction, and what remains is a loss for the buyer and a gain for the seller. Carr and Wu, in the same journal in 2009, found the premium strongly and consistently negative for stock indices. Koval and Shumway, in the Journal of Finance in 2001, found that buying index options, calls and puts alike, produced large negative average returns. 3 peer-reviewed papers, pointing one way. Why does it exist? Options are insurance, and insurance costs more than its expected payout. Someone selling protection against a crash takes on the risk that hurts most, because it hurts at the same moment everything else they own is falling. They demand to be paid extra for that. So this is not a market inefficiency and not free money. It is a fee for bearing risk at the worst possible moment. Now the consequence, which is the most dangerous true fact in retail finance. Systematic sellers of options have historically been paid, and here is the shape of it. A short volatility strategy produces a long, smooth, steady upward line, month after month of small gains, a track record that, over any ordinary period, looks like genuine skill. And then, punctuating it, rare near-vertical drops that erase a large multiple of everything accumulated in days or hours. The old trading floor phrase is picking up pennies in front of a steamroller. I prefer a more honest one, selling earthquake insurance. The seller genuinely provides a service and is genuinely paid for it. The premiums are real income. The business is entirely viable, right up until the earthquake, and the earthquake is not a failure of the business model. It is the business model. Better still, a short volatility track record is a track record that has not yet had the event it is being paid to insure against. The absence of the disaster is not evidence of safety. It is the product. Which exposes the metric that misleads people most. A strategy that wins 95% of months looks, to every human instinct, like a good strategy. Win rate is the number retail investors reach for, and here it is worthless. The question is never how often something wins, but the ratio of the typical win to the atypical loss. Recall the options seller from the last chapter. Profitable at every finishing price below $105 and down $29,500 at $400. Every few years, a strategy that had quietly made money for years stops existing over a lunch break, as a set of inverse volatility products did in early 2018. Put the halves together and the conclusion is awkward. Buying options is, on average and over time, a losing proposition because you pay the volatility risk premium. Selling options is, on average, a winning proposition because you collect it. And selling is also the thing that can take more money from you than you have, while buying cannot. The market does not offer a side of this trade that is both profitable on average and safe. There is no third door. So to the strategies people are sold. The covered call: you own 100 shares, sell one call against them, and collect the premium. If the share stays below the strike, you keep both. If it rises above, your shares are called away at the strike. It is genuinely less dangerous than selling a call you cannot deliver on, which is why brokers approve it at a lower permission level. But it is marketed as generating income from shares you already own, and the accurate description is different. You swapped an unknown, potentially large gain for a known, small payment. If the share doubles, somebody else gets the double, and you sold it to them. Your downside is unchanged, cushioned only by the premium. Full participation in the falls, partial participation in the rises, over a long horizon in a market that rises more than it falls. That is a structural cost, not free income. There is also a dated, foreseeable way it goes wrong, documented by the clearinghouse's own education body. A call holder becomes entitled to a dividend if they exercise before the ex-dividend date, so a writer's chance of assignment rises as that date approaches. And in their words, an assigned call writer, covered or not, is obliged to deliver the stock plus the dividend. You lose the upside above the strike and the dividend. Early assignment is not random noise. It clusters before ex-dividend dates, which you can look up in advance. The cash-secured put. You sell a put and fence off enough cash to buy the shares if assigned, paid to commit to buying at a price you named. Maximum loss is the strike minus the premium, times 100. On a $100 strike sold for $5, $9,500. Not unlimited, not small. And the framing to puncture is, I was going to buy at that price anyway. You do not get assigned when a share drifts gently to your strike. You get assigned when it falls through it, in a market where you may not want it. Spreads: buy one option and sell another against it on different strikes or expiries. The sold one pays for part of the bought one, which caps both ends. This is the sensible structure for defined risk speculation. Maximum loss known, less rent paid to time decay, far less damage when implied volatility collapses. Two costs are underweighted. You cross the buy-sell gap 4 times in a round trip, 2 legs, in and out, which in options is frequently larger than the edge being sought. And your defined risk is only defined if both legs survive. If the short leg is assigned early, the offset you relied on is not there. Asked whether a broker will exercise your long leg to cover, the clearinghouse's education body answers. They may, if you have discussed it with them. It is not automatic. Then the genuinely dangerous ones. Naked short options, selling an obligation with no shares and no offsetting contract. Unbounded loss on a call and margin financed, so the broker lends against the position, revalues it continuously, and if you cannot meet a call on it, liquidates at the worst prices without asking you. Brokers gate this behind their highest permission level, a trade the broker's own risk department worries about more than you do, which should tell you something. And very short-dated options, including those expiring the same day. Everything from the last chapter compounded. The rate at which exposure flips is at its maximum, time decay is at its maximum, and all remaining value goes to zero by the close. There is no tomorrow in which to be right. A 3-month option that is wrong today can be right in 6 weeks. One expiring at 4 o'clock cannot. The payoff, small stake, high probability of total loss, small probability of a large multiple, is structurally the payoff of a lottery ticket. That is the mathematics, not a moral judgment. And I will not tell you what share of trading these represent because I could not verify a figure. What can be verified is the scale. Cboe Global Markets, in its annual report filed with the Securities and Exchange Commission in February 2026, reports United States listed options volume averaging 60.8 million contracts a day in 2025, against 48.5 million the year before, up about 25% in a single year. Who is doing it? A 2023 study in the Journal of Finance by Bryzgalova, Pavlova, and Sikorskaya documents that retail trading recently reached over 60% of total market volume. The majority of activity in the most complex retail product is retail. The same paper finds retail investors prefer cheaper, weekly options with an average bid-ask spread of 12.6%, and, in the author's own 5 words, lose money on average. Sit on that spread figure because it is where most of the money goes. At any moment, there are 2 prices, the lower one you can sell at and the higher one you can buy at. The gap is not a fee on your statement. It is a loss you take instantly and invisibly the moment you transact. On a large liquid share, it is often a single cent on a $100 share, 1/100th of 1%. On the options ordinary investors actually buy, it averages 12.5%. That is not a different price. That is a different sport. An option quoted around $1 has a bid near 94 cents and an offer near $1.06. You buy at the offer and can only leave at the bid, so it must rise about 12.6% before you are level, before commission, before time decay, before anything else at all. It is wide for real reasons, liquidity fragmented across thousands of separate contracts, a hedge the market maker must adjust continuously, and buyers who sometimes know something. Those justify a wide spread. They do not make it costless. Then payment for order flow. When you press buy in an app, your order usually does not go to an exchange. It is routed to a wholesale market maker that executes it in-house and pays your broker for the privilege. The same paper finds nearly 90% of those payments come from 3 firms and identifies the practice as the facilitator of retail options growth. Your order flow is worth paying for because it is, on average, uninformed. Commission-free does not mean free. It means the fee moved somewhere you cannot see. I will not quote a per-contract rate. My research marks those unverified. But the audited figures exist, and this is the strongest follow-the-money evidence in the series. Robinhood's annual report for 2025, filed with the Securities and Exchange Commission, shows options revenue of just over $1.1 billion, 25% of all net revenues, and the firm's single largest line, larger than crypto, than equities, than margin interest. Equities transaction revenue was $302 million, so options produced roughly 3.7 times as much. Now the customer side of the same filing. At the end of 2025, customers held $212 billion of equities and $2.8 billion of options and futures. Customers hold roughly 75 times as much money in shares as in options, and the options make the broker nearly 4 times as much revenue. Say the caveat aloud. Options are short-dated and turn over constantly, so a small standing balance supports an enormous flow of transactions. That is why the ratio is extreme, and it is not a hidden annual charge. The comparison is still legitimate, and it answers the question of why a free app is so keen to help you learn about options. Nothing illegal is happening, it is all in a public filing, but it tells you whose interests the design is optimized for. And note the fourth line, margin interest of $573 million, 13% of revenue, on customer borrowings that more than doubled in a year. Even the exchange earns more here. Cboe's own disclosure shows it capturing about 1.5 cents per 100 shares of equities, about 6.5 cents on an ordinary option contract, which covers 100 shares, and about 92 cents on an index option contract. 4 times and 60 times for comparable exposure, though index contracts carry a far larger notional, so treat that last one as directional. It is still the smallest of your costs. The spread dwarfs it. Finally, the endgame. The clearinghouse's education body publishes the breakdown. Historically, more than 72% of option contracts are closed out before expiry, another 22% expire without value, and 6% are exercised. An option is mostly not a way of eventually buying a share. It is bought and sold in its own right, and usually the story ends with a sale or with zero. And pin risk, the hazard of being short an option that finishes right at the strike. In the money by a cent and you are exercised against, out by a cent and you are not. You find out after the close, when you can no longer trade, and you carry the shares through the weekend. Pin risk is not knowing what you own until it is too late to act. So, plainly, this is a category where retail investors demonstrably lose money, peer-reviewed, in the top journal in the field, in the author's own words. That is a population average, not a statement about every individual. It does mean anyone intending to be the exception should be able to say why. None of this is advice. Next, products that promise a multiple of the market and deliver something else entirely. Chapter 19, Leveraged and Inverse Products. I want to start with one sentence, published by a regulator, about a real product over a real period. The American Brokerage Regulator, the Financial Industry Regulatory Authority, wrote this in a notice to the firms it supervises. An exchange-traded fund seeking to deliver 3 times the daily return of the Russell 1000 Financial Services Index fell 53%, while the index actually gained around 8%. Read that again. The index went up about 8%. The fund designed to give 3 times that index went down 53%. The arithmetic you would expect is 8 times 3, so up 24%. What occurred was minus 53. The period was December 2008 to April 2009, and the source is the regulator's own notice. So how does a product do that? The answer is one word, which appears in the fund's legal name and is almost never read as what it is: daily. A leveraged exchange-traded fund, a fund that trades on an exchange like a share, aims to deliver a multiple of the return of an index, commonly 2 or 3 times. An inverse fund aims to deliver the opposite. And here is the defining sentence of this chapter. A 2 times fund targets twice the daily return of the index. It does not target, promise, or in general deliver twice the return over a week, a month, or a year. That is not a lawyer's caveat. It is the mechanical design. To keep its exposure at exactly twice today's assets, the fund must adjust its position at the end of every trading day. If it made money today, it is underexposed relative to target, so it buys more. If it lost money, it is overexposed, so it sells. That is the daily rebalance, and it means the product buys after it rises and sells after it falls, every day by design. Now the arithmetic, which is more convincing than any authority. Take an index at 100. On day 1, it falls 10% to 90. On day 2, it rises 11.11% back to 100. The index is exactly where it started. 2-day return, 0. Now the 2 times fund, starting at $100, delivering exactly twice each daily move, costs ignored. Day 1, the index falls 10%, so the fund falls 20% to $80. Day 2, the index rises 11.11%, so the fund rises 22.22%, and $80 grows to $97.78. The index returned 0. The fund lost 2.22%. the 3 times fund on the same 2 days, down 30% to $70, then up 33.33%, giving $93.33, down 6.67%, worse than 3 times the double fund's loss. And now the escape route closes. The inverse fund, aiming at -1 times the index, rises 10% on day 1 to 110, then falls 11.11% on day 2, giving $97.78. It lost exactly the same 2.22%. Sit with that, the index was flat. The leveraged fund lost, the triple leveraged fund lost more, and the fund betting the other way also lost. Nobody was on the right side because there was no side. Volatility took money from all of them. This is volatility decay, and it is not a malfunction. It is the arithmetic of compounding a multiplied series, always negative in a choppy market, growing with the square of the volatility and with how long you hold. Which brings us to path dependency. For an ordinary fund, if I tell you the index started at 100 and ended at 100, I can tell you your return, roughly 0. For a leveraged fund, that is not enough. I also need to know how it got there. 3 routes, same start, same finish, 2 times daily fund. 1. The index does not move at all, and the fund ends at $100, 0%. 2. Mild chop. The index falls 5%, then rises 5.26%, back to 100, and the fund ends at $99.47, down 0.53%. 3. Violent chop. The index falls 20%, then rises 25%, back to 100, and the fund ends at $90, down 10%. Identical journeys as far as the index is concerned. 0, minus 0.53, minus 10. The only thing that changed was how rough the ride was, and quadrupling the daily swing multiplied the damage roughly 20-fold. The product is at its most dangerous when markets are most exciting, which is when people are most drawn to it. So state the trap plainly. A leveraged fund is not a bet on where the market ends up. It is a bet on where the market ends up and on it getting there calmly. Nobody buying one thinks they are making the second bet. Everybody buying one is. The regulator's language is exact. Inverse and leveraged exchange-traded funds that are reset daily typically are unsuitable for retail investors who plan to hold them for longer than one trading session, particularly in volatile markets. One trading session, not 1 year, 1 day. Now be fair, because a chapter that only warns gets dismissed by anyone who knows someone who made money here. These are not frauds, and they are not badly built. They do exactly what the prospectus says, and over a single day they track their stated multiple closely, the horizon they were engineered for. The legitimate uses are real. A trader with a view about the next day or two, an investor blunting the downside of a portfolio they cannot sell. An inverse fund also caps your loss at the amount invested, which short selling does not. And in a calm, sustained uptrend, compounding runs the other way, and a leveraged fund can beat its stated multiple. The issuer's own documentation concedes both halves. Lower index volatility contributes to returns better than the daily target, higher index volatility worse. You are paid for calm and charged for chop, and you do not choose which the market delivers. So the failure is not the product misbehaving. It is a rent-by-the-day tool used as a rent-by-the-decade tool, easy to do, because these trade exactly like ordinary shares, sitting beside a plain index fund and looking identical. The word daily in the legal name is the warning label, and almost nobody reads it as one. Now the rest of the leverage family, because the leveraged fund is its gentlest member. With a fund, your loss is capped at what you put in. The others are not so kind. A margin loan is your broker lending you money against your securities so you can buy more of them. Under the Federal Reserve's Regulation T, per the regulator, brokers can lend a customer up to 50% of the total purchase price of a margin equity security for new purchases. So $10,000 of your money buys $20,000 of stock, and a 50% fall then wipes out 100% of your money. The stock halves to $10,000. The loan is $10,000. Your equity is 0. The stock fell by half. You lost everything. There is also an ongoing maintenance requirement, a minimum equity level the account must hold. I will not quote a percentage. I could not verify the current figure, and brokers set their own higher ones. What I will quote is this, from the regulator, word for word. Brokers, at their discretion, may liquidate an account at any time to eliminate a margin deficiency. Unpack it. The broker does not need your permission, does not have to reach you first, and does not have to sell the thing you would have chosen. Enforced selling arrives only when prices have already fallen. So the mechanism guarantees you sell at the bottom of your own drawdown, and everyone's call fires at once, which pushes prices down further and triggers more calls. That is the heart of the leverage warning, and it is not about magnification. Leverage removes your ability to wait. An unleveraged investor who is wrong can sit still and be proved right in 3 years. A leveraged one is removed from the position before the 3 years can happen. Then contracts for difference. A private contract with a broker to exchange the difference in an asset's price between opening and closing. You never own the asset. These and spread bets offer high leverage, are marketed heavily online, and are banned for retail clients in the United States. These are the most thoroughly documented retail harm products in the series, because regulators force the sellers to publish their own scorecard. The European Securities and Markets Authority, announcing its intervention in March 2018, stated verbatim that 74 to 89% of retail accounts typically lose money on their investments, with average losses per client ranging from 1,600 to 29,000 euros. Between 3/4 and 9/10 from the provider's own data. Look at the remedies, because a remedy tells you what the harm was. Leverage caps by asset class, 30-1 on major currency pairs, 5-1 on individual shares, 2-1 on cryptocurrencies. A ban on binary options. Negative balance protection, read that plainly. Before the rule, you could lose more than everything you deposited and end up owing the broker. And a standardized risk warning stating the percentage of that provider's own accounts that lose money. Go and read the line at the bottom of the next advertisement you see. You verifying it beats me reciting a figure. One more documented case. In late February 2018, after a violent single session in volatility markets, the issuer of a major inverse volatility fund changed that fund's stated objective from -1 times the daily performance of its index to -1/2 times, effective at the close of business on the 27th of February 2018. That is on the issuer's own page. I will not give you loss figures from that week. I could not verify them, and I do not need them. Issuers do not have the risk profile of a profitable product for fun. That change is their own written admission that the product had been too dangerous to keep selling in that form. So how does the issuer earn? Start with the published expense ratio. One large triple-leveraged technology fund discloses a gross expense ratio of 0.97% and a net ratio of 0.82. The inverse volatility fund charges 0.95. Compare plain index exchange, traded funds. The American fund industry's own trade body reports an asset-weighted average of about 0.14% for index equity funds in 2025. That comes from a body with an interest in fees looking low, which makes the comparison conservative, and the leveraged wrapper still costs roughly 6 times the plain one every year. That is not the full cost. A 3 times fund does not conjure $3 of exposure from one. It buys the extra exposure through swaps with bank counterparties, who charge an embedded financing rate priced off short-term interest rates plus a spread. That never appears in the expense ratio. It is deducted inside the swap, before the return you see. When short-term rates are high, the drag rises, a second headwind on top of volatility decay. Then the broker earns commission and spread on every trade, and margin interest if you borrow, and the market maker earns the bid-offer spread on enormous volume. And here is the structural point. These products are designed to be held for a day, so the same dollar of assets gets traded over and over. High turnover is not a bug in this business model. It is the business model. A buy-and-hold index fund earns its provider a small fraction of a percent a year and almost no trading revenue. A leveraged fund earns 0.8% and regenerates brokerage and spread revenue every time it changes hands. And because volatility decay erodes long-term holders, the product needs a continuous flow of new buyers, which is what the marketing is for. That last connection is my reasoning, not an allegation of intent, but it is worth asking of anything you are sold. Does the seller earn more when I do well or when I trade often? Deciding, and none of this is advice. What is my holding period, decided in advance, because if it is longer than a few days, the regulator has already answered for me. Will I look at this every day, given it rebalances whether I am watching or not? Do I have a view on the path, not just the destination? And would the 8% up, 53% down outcome shock me, because if it would, I do not yet understand the product. These products are not broken. They do precisely what they say. The harm comes from a mismatch between a tool built to be held for one day and a buyer who intends to hold it for a year, and that mismatch is documented and published by regulators in several countries. Next, products that look like a bond and pay like a bond, and are not bonds at all. Chapter 20, Structured Products, the Yield Machine. A relationship manager rings. She has an idea. There is a note closing on Thursday. 6 months, a coupon several times what your savings account pays, linked to a company you have heard of. The paperwork will follow by email. Nothing about that is unusual. These are almost never bought. They are sold by a person inside a relationship at a price nobody else quotes. Here is the sentence to hold on to for the next 15 minutes. Most of these products are a deposit or a bond, plus an option that you have sold. The attractive coupon is largely the premium on that option. A premium is simply the price of an option, paid by the buyer to the seller. So you did not buy a yield. You wrote an insurance policy, and the coupon is what you were paid for writing it. That is not my interpretation. It is the American regulator's own description. The Financial Industry Regulatory Authority, in a notice to firms published in 2010, wrote that, and I quote, "In effect, the investor in the reverse convertible is selling the issuer a put option on the reference asset in exchange for an above-market coupon during the life of the note." A put option is the right to sell something at a fixed price. If you have sold one, you have promised to buy. The European Securities and Markets Authority says the same thing independently. A long position in a reverse convertible can be replicated by a long position in a coupon-bearing bond and a short position in a put option. That is a written put. 2 regulators, 2 continents, 1 description. The customer is short a put. Now the vocabulary. A structured product is a prepackaged investment whose return is set by a formula linked to something else. A share, a basket, an index, an interest rate, a currency, or a company's ability to pay its debts. Legally, it is usually one of 2 things. A note, which is a debt security issued by a bank, meaning you have lent that bank your money, or a deposit with a formula-linked return. The strike is the reference level in the formula, usually the underlying's price on the day the deal is struck. A barrier is a level that, if touched, changes the deal. Let me enumerate the family and give each one its worst case. The mechanics I describe are the standard shapes, in my own words. Every real contract differs, and the only terms that bind anyone are the ones on the term sheet. A fixed coupon note pays a stated coupon over a short life, usually linked to one or a handful of volatile shares. Worst case, one of those shares falls below the level in the contract, and at maturity, you are handed the shares instead of your money, valued at the higher level. You keep the coupons. You also keep the fallen stock. An equity-linked note is the broader family, return linked to a share or a basket, and where a basket is used, the payoff usually references the worst performer in it. Worst case, adding names sounds like diversification and is the opposite. Every extra name is another chance for one of them to break. An accumulator commits you to buy a fixed quantity of an underlying at a set price, on regular dates, over a period. A decumulator is the mirror image, committing you to sell. Worst case, and it is the shape of the whole category. If the price rises above a level, the contract knocks out and your good trade simply ends. If the price falls, you keep buying, often in larger size, all the way down for the full term. Good scenario short, bad scenario long. There is a well-known trading floor nickname for this product. I could not verify it against a source I would stand behind, so I am not going to repeat it. An auto-callable note ends itself early if the underlying reaches a given level before a set date, paying a fixed return. That is close to the European regulator's own definition, and that regulator rates auto-callables among the most complex products in its market. A callable note is the same idea, except the bank chooses whether to end it. Worst case for both. The profitable outcome is terminated early, then rolled into a fresh note, which pays a fresh commission, while the losing outcome runs to full term. A reverse convertible is the plainest version of the idea, a bond that can be handed back to you as shares. High coupon, and if the share falls far enough, you receive shares worth less than your money. A principal-protected note promises your capital back at maturity. Worst case is the one the name conceals, and the Securities and Exchange Commission states it plainly. Products with reassuring names including some variant of principal protection, capital guarantee, absolute return, or minimum return are, in the regulator's words, not risk-free, because any promise to repay some or all of the money you invest will depend on the creditworthiness of the issuer of the note, meaning you could lose all of your money if the issuer of your note goes bankrupt. A capital guarantee is a guarantee by a bank. It is not a guarantee against a bank. A range accrual pays a coupon only on days when a reference, often an interest rate or a currency pair, sits inside a stated band. Worst case, the reference spends the term outside the band, you earn close to nothing, and your money is locked in for years while it happens. A dual currency investment is a deposit in one currency where the bank has the right to repay you in another, at a rate agreed up front, in exchange for a higher rate of interest. Worst case, you are repaid in whichever currency has become worth less, at the old rate. You sold a currency option and were paid for it in extra interest. A credit-linked note pays a higher coupon in exchange for your taking the risk that one or more named borrowers fail to pay. Worst case, a credit event happens and your principal is written down. You were selling insurance on somebody else's debt. Then the barrier mechanics that run through all of them. A knockout ends the product when the underlying rises above a level. A knock-in changes the payoff when the underlying falls below one. Here is the European regulator's own illustration, its example, not a real product's terms. If the underlying price never falls more than 20% below the strike before expiry, the investor receives at least all of their capital. If the price does fall more than 20% below the strike at any point, there is 1-for-1 downside participation. Notice the direction of both triggers. The knockout fires when the market rises, ending your good trade. The knock-in fires when the market falls, starting your bad one. Both work against your return. And ask one question of any barrier. Is it checked only on the final day or every day the market is open? A barrier watched continuously can be broken by a single bad afternoon that has fully recovered by maturity. So again, plainly, you have made a deposit and sold an option. You are short volatility, which means you are paid more when the market expects the underlying to move violently. That is why the best-looking coupons are quoted on the most violent single shares rather than on broad indices. The coupon is a thermometer for risk, not a reward for cleverness. And your position is capped upside, near full downside by construction. The most you can make is the coupon. The most you can lose, in most of these, is close to everything. I want to be fair, because a chapter that only attacks will not be believed. Selling a put is a legitimate strategy. An investor who genuinely wants to own a share at a lower price and wants to be paid for waiting is doing something coherent. These products do pay a contractual coupon in a flat or mildly falling market, where simply owning the share pays little. And the European regulator itself reports academic work suggesting these products draw households into taking any market risk at all, possibly by softening loss aversion. The problem is not the strategy. The problem is that most buyers do not know that is the strategy they are running, and that the price of running it this way is poor. Which brings us to the fee. There is no expense ratio on a structured note and no annual management charge, so the cost is not a charge at all. It is a gap, the difference between what you pay and what the pieces are worth. The Securities and Exchange Commission says so in writing. The price you will pay for a structured note at issuance will likely be higher than the fair value of the structured note on the date of issuance, because issuers include the costs for selling, structuring, or hedging the exposure on the note in the initial price of their notes. How big is that gap? Two finance professors, Henderson and Pearson, repriced 69 issues of one popular American product family, sold by one investment bank between 2001 and 2005, with proceeds of more than $2 billion. The work was published in a leading peer-reviewed finance journal. Their finding: primary market investors paid on average an 8% premium over fair value. Those notes were typically called away after about 6 months, so it was not 8% spread over a lifetime. It was 8% taken out of a 6-month product, on day one, out of your principal, before a single coupon arrived. The authors concluded that expected returns were less than the risk-free rate of interest, and that such investors would have been better off in bank certificates of deposit, not below the stock market, below the risk-free rate. 3 caveats because they matter. That is one product family, one issuer, one country, one period. It is an issue date premium, not an annual charge. And disclosure has changed since. American issuers now publish their own estimated value of the note on the issue date, and it sits below the price you pay. Go and find that number. The European regulator's summary of the wider literature lands in the same place. Studies across France, Switzerland, Denmark, Germany, and the Netherlands find intrinsic costs to investors usually between around 2% and 9%, taken once at issue. That regulator also says, honestly, that there is some evidence those costs have moderated in recent years, and that some of the underlying data is self-reported by issuers. Both halves belong on the record. That gap has 3 tenets: structuring margin, the difference between what the option leg cost the bank to hedge and what it charged you for it; distribution commission, what the private bank or relationship manager is paid out of the issue price; and the secondary market spread, earned again if you leave early. Notice what the roll does. A note that ends at month 3 and is immediately replaced generates fee events at a rate no buy and hold fund ever will. You experience that as attentive service. 2 risks remain, and they are the ones people miss. First, you are an unsecured creditor of the issuing bank, not of the company on the front of the brochure, of the bank. When Lehman Brothers failed in 2008, Hong Kong retail buyers of notes marketed under a brand name containing the word bond discovered that the product was in fact a credit-linked structured note whose value depended on derivative counterparties and on collateral. Many had understood it as a better savings account. 16 distributing banks eventually agreed a repurchase scheme: 60% of principal for eligible customers under 65, 70% for those 65 and over, with more later as collateral was recovered. Accepting meant releasing all claims. And here is the detail that teaches most. You were excluded from the scheme if you had done 5 or more such trades in the previous 3 years, or if you had been classified as a professional investor. The redress went to the inexperienced. Agreeing to be classified as professional, accredited, or sophisticated, often the precondition for being offered these products at all, is not a compliment. It is a waiver. Second, liquidity. The regulator again: your ability to trade or sell structured notes in a secondary market is often very limited. In practice, the issuer is the only entity that will bid, and it sets that bid itself. A listed share has thousands of strangers competing to buy it from you at a public price. A structured note has a market of exactly one, and it is the person who sold it to you. None of this is advice, and I am not telling you to own or avoid anything. I am giving you the questions. What option have I sold and who is long it? What is the issuer's own estimated value against the price I am paying? Whose failure would cost me my money? Would I want to own this underlying at that level in the scenario where the barrier breaks? And who buys this from me in month 3, at what price? That is complexity sold one customer at a time. Next, the same engineering at industrial scale, applied to millions of loans at once, and the assumption inside it that broke the world economy. Chapter 21, Structured Products, Securitization. Here is the whole chapter in one sentence. Securitization is taking a large number of loans that individually nobody wants, putting them in a box, and selling slices of the box, where the slices are deliberately made unequal, so that some buyers are paid first and safely, and others are paid last and dangerously. Start with why anyone bothers. A single mortgage is a terrible investment for a pension fund. One loan, one borrower, one house, and nobody will grade Mrs. Patel's loan on Elm Street. A fund needs the opposite: large, liquid, standardized, rated. So you build a bridge. Take 5,000 mortgages and put them into a legally separate company whose only job is to hold them and pass the cash through, a special purpose vehicle. SPV, it is bankruptcy remote. If the originating bank fails, those loans are not part of the wreckage. Then sell claims on the vehicle's cash flow. The Federal Reserve, in its Financial Stability Report of May 2026, defines securitization as bundling loans and selling claims on the cash flows they generate as tradable securities, much like bonds, and notes that it adds leverage, because these vehicles face lighter rules than banks. Name the family first. A mortgage-backed security, MBS, is backed by property loans. Residential deals pool thousands of small home loans. Commercial deals pool loans on offices, shopping centers, and warehouses, where the dominant risk is whether each large loan can be refinanced when due. Then the great divide: agency versus non-agency. In America, agency paper is issued or guaranteed by Ginnie Mae, Fannie Mae, or Freddie Mac, and Ginnie Mae carries the full faith and credit of the United States government. Hold agency paper, and you take essentially no credit risk. The guarantee makes you whole on defaults. Non-agency, also called private label, has no guarantee. Your only protection is the structure. That is where nearly all the losses of 2008 sat. An asset-backed security, a BS, is identical machinery, different collateral. Car loans, credit card balances, student loans, equipment leases, franchise royalties, music catalogs. Any contractual stream of payments can be boxed. A collateralized debt obligation, CDO, applies the technique not to loans but to other bonds, including slices of other securitizations. A CDO squared does it again, to slices of CDOs, at which point nobody can list the underlying mortgages. A collateralized loan obligation, CLO, is the version that matters today. A vehicle that buys leveraged loans, senior, secured floating-rate loans to companies already carrying a lot of debt, and issues its own slices against them. Covered bonds are the conservative European cousin, and this description is mine, not a regulator's. The loans stay on the bank's own balance sheet, ring-fenced in a pool, and the holder has recourse to both the pool and the bank. 2 claims and no risk transfer. And the synthetic version. Instead of buying bonds, the vehicle sells credit protection through credit default swaps, contracts that pay out if a named borrower fails. It never owns a mortgage. It owns a bet on them. Now, tranching from first principles. Tranche is French for slice. Here is the non-obvious move. Sell 5,000 identical claims on the pool, and every buyer owns an average mortgage, better than one but not top-rated because some borrowers default. So you sell claims of different seniority instead. Picture buckets stacked in a tower, cash pouring in at the top. Cash fills the top bucket before a drop goes lower. Losses work the other way. They eat the bottom bucket first and climb only when it is gone. Cash flows down, losses climb up. If you remember one sentence from this chapter, that is it. An example now, invented for teaching and not a real deal. 1,000 home loans of £200,000 each. Pool, £200 million at an average 5%, throwing off £10 million a year. Class A, the senior slice, is $160 million, 80% of the deal, paid first, losing last at 3.5%. Class B is $20 million, paid second at 5.5%. Class C is $10 million, paid third at 9%. and 10 million of equity at the bottom, paid last, losing first, taking whatever is left. Those coupons cost 7.6 million a year. The pool produces 10. The leftover, 2.4 million on 10 million of equity, is a running yield of 24% if nothing defaults. That is why anyone buys the bottom. Now defaults. Assume a repossessed house sells for 60%, so each default costs the pool 40% of that loan. 2% default costs 1.6 million. Equity absorbs it and survives. A, B, and C are untouched, and the top-rated bond behaved exactly as advertised. 40% default, 32 million of loss. Equity gone, Class C gone, 20 million, and the remaining 12 million hits Class B, which is only 20 million in size. It loses 60%. On a bond rated A Class A is untouched because 40 million of cushion sat beneath it. 55% default, 44 million of loss. The cushion is exhausted and 4 million breaks into Class A, 2.5% of it. Small in percentage terms, catastrophic in every other way. Class A was sold as money good and is held in size, on borrowed money, by institutions permitted nothing riskier. 3 things fall out. The same loans produced a top-rated bond and a bond that can lose everything. No risk was destroyed, it was redistributed. AAA here means AAA conditional on losses being roughly what we assumed, a claim about a model, not about the world. And notice the cliff between the last 2 scenarios. Senior tranches do not degrade gracefully. Which brings us to the center of this chapter, and it is one word: correlation. Everything above rested on a number, how many loans default. That is not a number, it is a distribution, and its shape depends on one question. If this borrower defaults, does that make the next borrower more likely to default too? Imagine 2 worlds. In the first, defaults are independent. People stop paying for unrelated personal reasons: divorce, illness, one employer failing. If 1,000 loans default independently at an average rate of 5%, 55% defaulting is not merely unlikely, it is arithmetically almost impossible. In that world, Class A cannot lose money. In the second, defaults are correlated. People stop paying for the same reason: a national fall in house prices, a recession, a jump in unemployment. These are no longer 1,000 independent bets. They are one bet made 1,000 times. Most years, almost nothing defaults. In a bad year, an enormous share does. Now 55% is entirely reachable, and Class A loses money. And here is the point. The pool is identical in both worlds. Same borrowers, same loans, same average default rate, same recoveries. The only thing that changed is an assumption about how independent people are of one another. So a top rating on a mortgage tranche is not primarily a claim about the borrowers. It is a claim about how independent they are, made by people whose data came from a period in which American house prices had never fallen nationally all at once. The models assumed defaults would be broadly independent. They were not. 2 things made that worse. Correlation is not a constant. It rises in stress, so the figure measured in calm years is wrong exactly when it matters, and the Financial Stability Board cites research finding it can almost double in a crisis. And the senior tranche is the most correlation-sensitive instrument in the structure, because it loses money only in the extreme tail, and correlation controls how fat that tail is. The slice sold as safest, to the most risk-averse buyers, in the largest size, depends most violently on the hardest parameter to estimate. And pooling 100 middle slices into a CDO diversifies nothing. Their borrower-specific risk was already stripped out, so it makes 100 copies of the same bet. The fair case first, because it is real. Securitization genuinely lowers borrowing costs. It lets a pension fund in Tokyo fund a mortgage in Ohio, which makes home loans cheaper. It moves risk to holders who want it, and it is not a niche. On the Federal Reserve's May 2026 figures, securitization outstanding was about $14.3 trillion, larger than the American investment-grade corporate bond market, and roughly 87% of that is agency paper, government-guaranteed plumbing for ordinary home loans. Anyone holding a broad bond fund already owns thousands of mortgages. Now, what went wrong? The Financial Crisis Inquiry Commission was a statutory American inquiry with subpoena power, reporting in January 2011. Its conclusions were the majority view of 6 of its 10 commissioners. 2 dissents were published. The majority concluded that collapsing mortgage lending standards and the mortgage securitization pipeline lit and spread the flame of contagion and crisis. On incentives, the line to memorize. From the speculators who flipped houses, to the brokers who scouted the loans, to the lenders, to the firms that created the mortgage-backed securities, collateralized debt obligations, CDOs squared and synthetic CDOs, no one in this pipeline of toxic mortgages had enough skin in the game. They all believed they could offload their risks on a moment's notice to the next person in line. They were wrong. On underwriting, lenders set the bar so low they took borrowers' qualifications on faith, often with willful disregard for ability to pay. And major institutions sampled the loans they were packaging, knew a share failed their own standards, sold them anyway, and did not disclose it in the prospectuses. On the rating agencies, the conflict has a name and the inquiry named it. The agencies were paid by the issuers whose deals they rated, and an issuer could shop for a better grade. The report names the pressure from the firms that paid for the ratings, alongside flawed models and a drive for market share. The numbers are the argument. From 2000 to 2007, one agency rated nearly 45,000 mortgage securities AAA. In early 2010, 6 American companies carried that rating. In 2006, it stamped AAA on 30 mortgage securities every working day, and 83% of those were later downgraded. Then the synthetics. Credit default swaps let people bet on securities they did not own, so the stock of bad mortgages was finite while the stock of bets on them was not. Synthetic CDOs, the inquiry found, amplified the losses by allowing multiple bets on the same securities. And the ending most retellings get wrong. The banks did not sell it all to naive foreigners. They kept the top. Merrill Lynch's management realized it held $55 billion of super senior, supposedly super safe mortgage securities. That slice paid almost nothing but attracted almost no capital charge, so the return on capital looked wonderful. Originate to distribute ended in reconcentration. How does a bank earn from this? 6 ways, and they stack. Origination fees for making the loans, gain on sale when loans go into the vehicle for more than they cost, structuring and underwriting fees for building and placing the deal, servicing fees for collecting the payments afterwards, year after year, retained tranches, which earn a spread and in the crisis hid the risk, and trading spreads, because these bonds trade dealer to client with no public price. Afterwards came risk retention, rules requiring the sponsor to keep a slice of its own deal, making skin in the game mandatory. I will not quote a percentage, because I could not verify the current requirement across jurisdictions. And one rule bit harder than expected, American restrictions, tied to the Volcker rule mean loan obligation vehicles generally cannot hold other securitizations, closing the squared root. Where does that leave 2026? Leveraged loans outstanding were about $1.5 trillion at the end of 2025, up more than 9% on the year, and non-agency securitization outstanding grew 11.3% against 2.1% for agency. Today's loan obligations are better built than pre-crisis CDOs. Real corporate loans rather than slices of other deals, actively managed, with limits on single borrowers and industries, and automatic tests that divert cash from the equity holder to repay senior bonds when collateral weakens. But better is not safe. Lender protections have weakened. The Financial Stability Board cites Standard & Poor's on an explicitly limited sample, finding recoveries on covenant-light loans of 63.5% against 84.1% for others. Lower recoveries mean bigger losses from the same defaults. And correlation reappears one level up. An estimate the board cites says 90% of American loan obligations are exposed to at least one of the top 50 borrowers. Each deal is diversified. The market is not. The Bank of England found that hurting senior tranches would take a shock more than twice the crisis default rate, while the European Central Bank warned thicker cushions may be offset by weaker collateral and higher correlation. Both are on the record. None of this is advice. Next, an asset with no issuer, no cash flow, and nobody to complain to, and the intermediaries that grew up around it anyway. Chapter 22, Crypto. You have heard two stories about this, both told by people with money at stake. I will tell you neither. I will describe the machinery, report what regulators have published, say what has happened to customers, and be explicit about what I could not verify. Where I have no sourced number, I will say so, and give you the mechanism instead. Every financial system is, underneath, a list of who owns what. Your bank balance is a row in your bank's database. If the bank changes that row, your money changes. You trust the bank, and behind it the regulator and the deposit insurance scheme. A blockchain replaces the single trusted list keeper with many copies of the same list, held by thousands of unrelated computers, none of them in charge. When you send someone a coin, you broadcast a message signed with a private cryptographic key that only you hold, and those computers check it against their copies and agree to add it. The hard part is making thousands of strangers agree on the order of events without a referee. Bitcoin's answer is that adding a page of transactions requires solving a deliberately expensive puzzle, that is mining, and the winner is rewarded with newly issued coins. Rewriting history would mean redoing all that expense faster than the rest of the world combined, so the past becomes impractical to alter. The result is a ledger no single party controls, that nobody can be ordered to change, and where possession of the key is possession of the asset. Everything attractive about crypto and everything dangerous about it comes from those same properties. Nobody can freeze your account. Nobody can restore it either. The word crypto covers wildly different things, so split them. Bitcoin has a fixed maximum supply, no company, no chief executive, no cash flows, and the longest track record. The digital gold argument attaches here. Other Layer 1 networks, of which Ethereum is the best known, are platforms other applications run on, and some have fee revenue accruing to holders, which makes them slightly more analyzable, though nothing like a company. Stablecoins hold a constant value, usually one United States dollar, not an investment but a settlement instrument. Then thousands of application tokens and memecoins, most with no revenue, no use, and short lives. Figures for what share of tokens go to zero circulate widely. I could not verify one, so I will not quote one. What is safe to say is that the great majority of the tens of thousands of tokens created have no economic activity behind them, and are closer to venture stage speculation than to investment. So crypto is not an asset class the way equities are. It is a technology with a huge range of things built on it, some of which are assets and most of which are lottery tickets. How do you actually buy and hold it? The honest framing is that you are choosing which risk you prefer, because there is no option with none. A centralized exchange is the easy route. You open an account, deposit money, buy, and the exchange holds the asset, which reintroduces exactly the intermediary the technology was designed to remove. The exchange's entry in its own database says you own a coin. Whether the coin exists is a separate question. Self-custody means holding the private keys yourself, in software or on a hardware device. No intermediary can fail on you because you are the intermediary. There is no password reset. Lose the key or the recovery phrase and the asset is gone permanently. Then regulated spot exchange-traded products, where approved. The United States Securities and Exchange Commission approved the listing and trading of spot Bitcoin exchange-traded products in January of 2024. I could not retrieve the regulator's own statement, so I will not paraphrase its cautionary language. Go and read it. Similar products exist in some jurisdictions and not others. A fund wrapper trades custody and key loss risk for a management fee and exposure only in market hours. Now the central analytical point, stated neutrally, because it is a description and not an insult. A share entitles you to a slice of a company's future profits. You can argue about how large those will be, but there is a number to argue about. A bond pays stated interest on stated dates and returns your principal. That number is contractual. Property produces rent. Gold produces nothing. Bitcoin produces nothing. For an asset with no cash flows, the entire return comes from what the next person will pay. No coupon, no earnings, no rent, and therefore no internal anchor. You cannot compute a fair value from what the asset does and compare it to the price, because the asset does not do anything. Valuation arguments here are arguments about scarcity, adoption, and belief. Both halves matter. Anyone claiming a valuation model for Bitcoin comparable to a discounted cash flow on a company is overstating what exists. And no cash flow does not mean worthless. You already accept a non-cash flowing asset every time you consider gold, which sits in central bank reserves. Refusing both the dismissal and the hype is the point. Volatility. Crypto's price movement is very substantially larger than that of major share indices, which are in turn more volatile than investment-grade bonds. Specific volatility and drawdown percentages circulate everywhere. I could not verify them against a source I trust, so I will not state one. The more useful version anyway. This is an asset that can fall by more than half and has done so repeatedly. That is not a place for money you will need. And the only lever a retail holder actually controls is position sizing, not prediction. The regulator said this in advance. In a joint warning published on the 17th of March, 2022, the three European supervisory authorities stated that many crypto assets are highly risky and speculative, that consumers face the very real possibility of losing all their invested money if they buy these assets, and that they are not suited for most retail consumers as an investment or as a means of payment or exchange. They warned specifically about misleading advertisements and influencer promotion. Note the date. That was before the sector's largest failures, not after. Which brings me to the most important risk. When you buy crypto on an exchange, in most cases you do not receive a coin. You receive an entry in the exchange's private database saying you are owed one. That is a claim on a company. Unlike a bank deposit, it has typically carried no deposit insurance, and unlike shares held by a regulated broker, it has often not been subject to the client asset segregation rules that apply to securities. So here is the sentence, and I am going to say it twice. Most crypto losses have not come from the price falling. They have come from the intermediary failing. Most crypto losses have not come from the price falling. They have come from the intermediary failing. Now the failures, and here I have to be careful with you. There have been several very large collapses, an exchange whose customer assets funded an affiliated trading operation, a lender promising yields it could not sustain, which halted withdrawals, a stablecoin whose peg rested on a mechanism rather than reserves, which unwound. Those patterns are documented. The dollar amounts, exact dates and sentences handed down I could not verify from primary sources, and widely circulated figures for these events are frequently wrong, so I will not give you numbers. The mechanism is the lesson, the number is decoration. The pattern is the same across all of them. Customer assets were not held the way customers believed. The failure mode is not that crypto went down, it is that the money was not there. Second risk, irreversibility. A confirmed blockchain transaction cannot be reversed. No chargeback, no dispute process, no fraud department, no ombudsman. Send to the wrong address and the funds are gone. Be tricked into approving a transaction and the funds are gone. That is not a bug that will be fixed. It is the design. Which is why crypto is the preferred settlement rail for scams. Anyone instructing you to pay in crypto, an advisor, a romance, a job offer, a service promising to recover money you already lost, is choosing an irreversible rail on purpose. Third, stablecoins. 3 designs, very different risk. Fiat-backed ones hold reserves, cash, and short-term government debt against the tokens issued. They dominate by size, and the risk is whether those reserves are real, liquid, and sufficient. Crypto-collateralized ones are backed by over-collateralized crypto, so the collateral is itself volatile. Algorithmic ones hold no meaningful reserves and defend the peg by minting and burning tokens. That design has failed catastrophically in practice. The Bank for International Settlements, in its annual economic report published in June 2025, assessed stablecoins against 3 tests for sound money: singleness, meaning settlement at par; elasticity, meaning supply that can expand to meet payment needs; and integrity, meaning safeguards against financial crime, and concluded they fail all 3. It observes that stablecoins often trade at varying exchange rates and have seen substantial deviations from par. The always $1 claim is not what is observed, that over 99% of them are dollar-denominated, and that they cannot be the mainstay of the future monetary system. Now the conflict. That institution is the central bank's bank, with an interest in the primacy of central bank money. Say it out loud, then note that its factual claims, that these tokens trade away from par and that algorithmic pegs have broken, are independently observable. Fourth, regulatory status, and everything here has a date on it and a country attached. In the European Union, the Markets in Crypto Assets Regulation entered into force in June 2023, applied fully from the 30th of December 2024, with a transitional period for existing firms running to the 1st of July 2026. It authorizes and supervises crypto asset service providers and requires standardized disclosure documents. So as of 2026, crypto in the European Union is no longer outside the regulatory perimeter, which genuinely changes the honest description of the sector. It also does not make the price less volatile and guarantees nobody a return. In the United States, the position moved from enforcement-led regulation towards specific legislation during 2025 and 2026. I could not verify the statutes, dates, or rule numbers, so I will name none. Other jurisdictions each have their own regime. Check yours. Finally, the question this series asks of everything: how does the platform earn? A single crypto platform runs 6 or 7 revenue lines against the same customer at once. Specific percentages could not be retrieved from platform fee schedules, so here are the mechanisms. Price them yourself. 1. The spread. The platform quotes a buy price and a sell price around the market's middle and keeps the difference. On the simple buy screen, that spread is typically wider than on the same firm's professional screen. Same asset, same firm, different price, decided by which button you pressed. That is the largest and least visible cost for ordinary buyers. 2. Maker and taker fees on the order book, where the taker who removes an existing order pays more than the maker who posts one and waits, and fees fall as your volume rises, pricing engineered to reward trading. 3. The conversion spread when your local currency becomes dollars or a stablecoin, a currency charge inside a crypto platform on top of the trading fee. 4. Deposit and withdrawal fees and network withdrawal fees are often set above the actual blockchain cost, which has a second function: friction that discourages self-custody and keeps your balance where it earns the money. 5. Funding rates on perpetual futures. A perpetual is a futures contract with no expiry, and because it never settles, a payment called the funding rate passes periodically between longs and shorts to tether it to the spot price. So holding a leveraged perpetual is a continuous cost or credit that has nothing to do with whether your view is right. A crowded position bleeds simply for being crowded. 6. Interest on customer cash balances, where the question is the same as at any broker: how much of it reaches you? And 7. Liquidations. Leveraged positions are force-closed when margin runs out, and the more leverage a platform offers, the more of them it collects. The synthesis is a callback. In foreign exchange, the institution earns by giving you a price instead of a fee. In crypto, the platform does the same and adds 6 more fee lines on top. The technology was designed to remove intermediaries. What was built for almost every ordinary user is a new set of intermediaries earning in more ways than the old ones did. That is not an argument that crypto is worthless. It is an argument that the words decentralized and commission-free should make you check the price you were given against the price the market had. None of this is advice, and I have not told you whether to own any of it. The questions are: Could I lose this entirely without changing my life? Where will it be held? And what happens to my claim if that entity fails? And can I say in advance what would make me sell? Next, the chapter this series has been walking towards, adding up every one of these revenue lines and answering, with audited numbers, where the money actually is. Chapter 23, How Banks Earn the Most. This is the chapter the series has been walking towards. Not what to buy, just this. When you hand money to a financial institution, where does its profit come from and which part is largest? Every figure here comes from an audited annual report filed with the American Securities Regulator for 2025 or from a regulator's publication. Where I could not verify something, I say so. One warning: 3 famous names in finance give 3 different answers to where do you make your money. That is not evasion. That is the finding. Start with the largest line, and it is not a fee. Net interest income is the difference between what a bank earns on the money it holds and lends and what it pays you for depositing it. At J.P. Morgan Chase, total interest income was $193.3 billion, and interest expense $97.9 billion, of which only $45.1 billion went to depositors. The residual, $95.4 billion, was 52.3% of the firm's entire revenue of $182.4 billion. Put a number on your side of that trade. At the end of July 2026, the effective federal funds rate in the United States, essentially the overnight risk-free rate, was 3.63%. The national average savings account rate, published by the deposit insurer that month, was 0.38%. Sit with those two. The depositor receives roughly 1/10 of the risk-free rate. Be fair, because this is where lazy criticism goes wrong. That spread is not a trick. Banks provide real things for it: instant access, payment rails, and the willingness to lend long while you withdraw short, a genuine risk. It is what banking is. But notice the scale, and notice it explains why your savings rate rises slowly when the central bank raises rates while your mortgage rate rises fast. The lag is the revenue. It is also the one big revenue line you can reduce in an afternoon, with no expertise, by moving idle cash into a money market fund or short government bills. Second, foreign exchange. When you convert currency, the dealer usually charges no commission. It gives you a rate worse than the one it can trade at and keeps the difference. Turnover averaged $9.6 trillion a day in April 2025 on the Bank for International Settlements survey, and non-financial customers are 5% of it. One British platform publishes its tiers, to its credit. 0.99% on the first £10,000 converted, falling to 0.20 above 25,000, plus a 1% spread on foreign dividends. The small investor pays roughly 5 times the rate per pound the large one pays for the identical operation. And the Financial Stability Board's roadmap sets a target for providers to disclose conversion charges by the end of 2027. A target implies it is not happening now. Third, structuring margin on structured products. The bank builds a note from a bond plus options and sells it at face value. The margin is the gap between what you pay and what the components cost, and there is no expense ratio because there is no fund. The American regulator states the price at issuance will likely exceed the note's fair value that day, because issuers include the costs of selling, structuring, and hedging in the initial price. The one large academic repricing, of 69 issues, found an average premium of 8% over fair value on notes typically called away in 6 months. The European regulator puts the usual range at 2 to 9%, taken once, at issue. Fourth, the bid-offer spread. Shares mostly trade on exchanges with a visible order book, so commission is charged separately and the spread is observable. Bonds and currencies are dealer markets. You trade against a bank, not another customer, and there is usually no commission at all because the spread is the entire fee. If someone tells you bond trading is commission-free, they have told you the opposite of cheap. At Goldman Sachs, market making produced $17.99 billion, 30.9% of revenue, and its largest single line. One caution: that firm's product-by-product trading split is a mark-to-market attribution, so it shows where risk sat, not where customer margin came from. Fifth, payment for order flow. A retail broker routes customer orders to a wholesale trading firm rather than a public exchange, and that firm pays for them. Why? Because retail orders are, in the trade's own language, uninformed. Someone buying 40 shares is unlikely to know something the market maker does not, so that flow is safer to trade against than an institution halfway through a large informed order. You are not the customer. You are the safe side of somebody else's trade. At Robinhood, transaction-based revenues were $2.63 billion, 58.8% of total revenue, at a firm charging no commission. The split is the tell. Options $1.12 billion, equities $302 million, while customers held $212 billion of equities against $2.8 billion of options and futures. The vastly smaller book produced nearly 4 times the revenue. In fairness, defenders argue wholesalers execute retail orders inside the public quoted spread, giving price improvement, and that this funded the collapse of commissions to zero. Both can be true. You got a benefit, paid for in a currency you cannot measure. Sixth, asset management fees, a percentage of your assets each year, charged on the balance, not the gain. 1% a year on $100,000 is $1,000 a year, good years and bad. At Morgan Stanley, this was the largest line in the firm, $25.1 billion of $70.6 billion, against net interest of $10 billion. Seventh, prime brokerage, financing, stock lending, custody, and clearing sold to hedge funds. The manager is paid for performance and can lose his fund. The prime broker is paid for balance sheet, borrow, and volume, and earns on the way up and the way down. I could not retrieve the financing sublines, so I quote none. Eighth, securities lending of ordinary customer holdings. Your shares are lent to a short seller who posts collateral and pays a borrow fee. Note who pays, the borrower, not you. The question is who keeps it, and the split is set by a contract nobody reads. Schwab reported $437 million of securities lending revenue. Ninth, and the most underpublicized, interest retained on idle client cash. Money sitting uninvested in your brokerage account does not sit there. It is swept into deposits at an affiliated or partner bank earning the short-term rate. You are paid far less, and the broker keeps the difference. It is net interest margin, run by a broker, on money you think of as simply cash in your account. Schwab's numbers say it plainly. $15.5 billion of interest revenue against $244 million paid to brokerage clients. Net interest revenue of $11.75 billion, 49.1% of the whole firm, at a business customers think of as a stockbroker. Robinhood's accounts contain a line labeled cash sweep, $229 million. And the practice is contested. Morgan Stanley's own filing discloses consolidated class actions alleging its brokerage arms failed to pay a reasonable rate of interest on cash sweep products, seeking treble damages, and discloses that the firm is responding to requests from state securities regulators about cash swept to its affiliate bank. Two things in the same breath. These are allegations in pending litigation. A motion to dismiss was filed, and nothing establishes wrongdoing, and the balance is disclosed in the same filing, at $145.2 billion of client brokerage cash swept into the affiliated bank at one firm. 10th, underwriting and advisory, fees paid by issuers and acquirers, not by you, and disclosed. Goldman Sachs earned $9.35 billion from investment banking, J.P. Morgan $9.6 billion, 5.3% of its revenue. The glamorous business is not the big business. 11th, margin interest, lending you money against your own portfolio. Schwab earned $5.7 billion from brokerage client receivables, more than its entire trading revenue of $3.9 billion. And Interactive Brokers, the low-cost choice of cost-conscious active traders, earned $3.56 billion of net interest income against $2.15 billion of commissions. Even where commission is low and visible, the interest line is bigger. 12th, custody and platform fees for holding the assets, and commissions, the one charge every customer knows about. At JP Morgan, brokerage commissions were 2% of revenue. The fee you can see is not the fee that matters. Where do they earn the most? The usual error is treating that as one question. It is 3. Largest in absolute dollars. Net interest income. $95.4 billion at JP Morgan, over half of everything, and the same pattern at firms you would not call banks. 49.1% of Schwab, 57.4% of Interactive Brokers. The honest exception, at a wealth manager the biggest line is asset management, at a pure dealer it is market making. The business model decides the answer. Highest margin per dollar of your money, the things you cannot price. Structured notes, where the one rigorous repricing found an 8% premium taken on day one. Currency conversion, where a retail-sized trade pays 0.99% for an operation held for seconds. I have no verified industry-wide margin for either and will not invent one. The indirect evidence is strong. When every comparable price in finance collapsed, these did not. Most reliable regardless of markets, spreads and fees on assets. Goldman's market making across 3 very different years ran 18.2, then 18.4, then $18 billion, almost a flat line. Its investment banking over the same years went 6.2, 7.7, 9.3 billion, a swing of about half. Spreads and percentage of assets fees are annuities, collected in rallies and crashes, from winners and losers alike. Now the number I would put on a poster. Take JP Morgan's income statement and add the lines where the customer never sees a charge. Net interest income, market making, asset management fees deducted inside funds, and card income paid by merchants. That is $147.7 billion, 81% of the largest American bank's revenue. That percentage is my own arithmetic on audited line items, not a figure the bank publishes. Hold it as a calculation, not a quotation. 4/5 of the revenue comes from charges nobody is ever billed for. Which brings me to the thesis this series has been testing. The industry earns least from the products that serve customers best, and most from the products customers cannot price. Now the evidence against my own thesis, because a claim with no counter-evidence is a slogan, and this counter-evidence is strong. Fee compression is real and enormous. On the American fund, trade bodies own asset-weighted figures, and a trade body has an interest in showing falling fees. Index equity mutual funds charged 0.05% in 2025, down from 0.27% in the year 2000. 5 basis points is $5 a year per 10,000 invested, compression to approximately zero, not merely towards it. Equity mutual funds overall fell from 0.99% to 0.40% across the same quarter-century. And here is the subtlety. Neither component fell that far. Active went from 1.06 to 0.64. The blend fell faster than either part because investors moved their money. Most of the customers' gain came from switching, not from waiting for prices to fall. The shift to passive tells the same story from the other side. The share of long-term American fund and exchange-traded fund assets held in index funds rose from 19% at the end of 2010 to 52% at the end of 2025. Passive crossed half. Revenue is fee rate times assets, and the mix moved to a product charging roughly 1/13 as much. You can watch it inside one manager's audited accounts. Index equity fund revenue up by 1/3 in 3 years, while its active equity revenue sat flat through a rising market. And regulation has deleted whole revenue lines. Britain's retail distribution review banned commission from product providers to advisors, forcing advice to be charged for explicitly. European rules restricted inducements and banned them for independent advice and portfolio management. One flag: my sources for those rules and their dates are secondary accounts, not the regulator's own texts, which I could not retrieve for this recording, so take the substance and check the detail. On payment for order flow, the position is firmer. prohibited in the European Union, with one member state permitted to run on into 2026, and the British regulator has determined it is generally incompatible with inducement and best execution rules. So the thesis survives, with a correction worth more than the thesis. Prices fell wherever they became a single comparable number. Every fee in finance that got printed as one figure got cheap. Every charge that stayed embedded in a price, a spread, or a rate stayed expensive, and several grew. That is not a conspiracy. It is what competition does and does not do. None of this is advice, but it gives you the two questions you actually need. What is the all-in cost of this as a percentage, and where would I check it? And who is on the other side of my trade? Next, the discipline that decides whether any of this matters for you. Risk, position sizing, and why diversification fails when you need it most. Chapter 24, Risk and Position Sizing. Ask someone who works in finance what risk means, and you usually get one word: volatility. Ask someone who has actually lost a lot of money, and you get a different answer. The year I could not sleep. The morning somebody rang and asked me for money I did not have. That gap is this chapter. The profession measures risk with statistics chosen largely because they are mathematically convenient. What ruins people is something else: the depth of a loss, borrowed money, not being able to sell, and being forced to sell at the worst moment. The industry knows this and uses the convenient measures anyway. Nothing here is advice. Start with volatility. It measures how much a price moves around. Formally, it is the standard deviation of returns, which just means take all the returns, find the average, then measure how widely scattered they were around it. Wider scatter, higher number, a measure of wobble. It has 3 defects nobody mentions while quoting it at you. It is symmetric. A surprise gain of 20% and a surprise loss of 20% count as equally risky, and nobody experiences those as equivalent. It assumes a shape markets do not have. It works best if returns follow a neat bell curve, and real markets have what are called fat tails, meaning extreme moves happen far more often than the bell curve allows, so every risk number built on it understates the extremes. And it says nothing about the path. 2 portfolios can have identical wobble and identical endpoints, and one of them can have put you through an experience that would have made you sell. So here is the measure I think matters more. Maximum drawdown is the largest fall from a peak to a trough as a percentage of the peak, not the worst calendar year. The worst journey from the best moment to the worst moment, however long it took. It beats volatility for 3 reasons. First, it is what you experience. Nobody has ever felt a standard deviation. Everybody feels being down 40% from where they were last spring. Second, it is the number that predicts when people sell. The dominant reason investors underperform their own investments is that they capitulate near the bottom, and what predicts capitulation is the depth of the fall, and almost never quoted, its duration, how long you sit underwater with no sign of recovery. Depth is a shock. Duration erodes conviction slowly enough that quitting feels like a rational decision rather than a surrender. Third, the arithmetic, which takes 15 seconds. Lose 10%, you need about 11.1% to get back. Lose 20, you need 25. Lose a third, you need about 50. Lose half, you need 100%, you must double your money simply to break even. Lose 80%, you need 400%. That is not a claim about markets. It is division. So avoiding the deep loss is worth more than catching the big gain, because losses compound against you at an accelerating rate. Now correlation and the great disappointment of portfolio construction. Correlation measures how far 2 things move together, from +1, meaning lockstep, through 0, meaning no relationship, to -1, meaning exact opposition. Diversification works because assets are not perfectly correlated. When one zigs, another does not necessarily zig with it, so the combination is smoother than its parts. The problem is that correlation is not a constant. It is a behavior, and it changes with conditions. In calm markets, assets follow their own individual stories, correlations are low, and diversification appears to work beautifully. That is precisely when the backtest gets run and the brochure gets printed. In a crisis, everything is driven by one thing: the desire for cash and the forced selling of whoever borrowed. Assets with nothing in common get sold by the same distressed holders on the same day because they needed money and these were what they could sell. Correlations therefore converge towards one exactly in the episodes. The diversification was bought to survive. Measured diversification benefit is systematically overstated because it is mostly measured during the periods when you did not need it. 2 consequences. Diversification across things sharing a hidden driver is not diversification. Supposedly different assets that are all really bets on interest rates staying low. And real diversification feels bad to own. An uncorrelated holding spends long stretches doing nothing while everything else rises, which is when people sell it, usually a week before it does its job. Next, the Sharpe ratio, because you will be shown one. It is return above the risk-free rate divided by the standard deviation of returns, excess return per unit of wobble. Higher is better, and its merit is real. It stops you admiring a big return obtained by taking enormous risk. Its limits matter more. It inherits every flaw of standard deviation, and it punishes upside, because a large unexpected gain raises the standard deviation and lowers the ratio. A measure that penalizes making money is not purely a measure of risk. It is also gameable twice over. Gameable by a hidden left tail. Any strategy earning a small, steady premium in exchange for a rare, enormous loss, which is selling insurance, shows a magnificent Sharpe ratio right up until the rare event happens. Selling options has that shape, and so do several structured products. A high Sharpe ratio is what picking up pennies in front of a steamroller looks like on a spreadsheet. Gameable also by illiquidity. Private equity, private credit, and unlisted property are valued by appraisal rather than by a real market, so they report smoothed returns, and smoothed returns have low measured volatility. The risk did not go anywhere. The measurement of it did. So interrogate any quoted ratio, over what period, and what happens in the worst plausible case. The second question is not in it at all. Which brings me to value at risk, the cleanest demonstration in finance that an official, precise, universally used number can be blind to the only thing that matters. It answers, over a given period, at a given confidence level, what is the most I should expect to lose? A one-day 99% value at risk means that on 99 days out of 100, losses should not exceed it. Notice what is missing. It tells you the threshold you will rarely breach, and nothing whatsoever about how bad things are on the days you do breach it. The 1 in 100 day could be a loss slightly over the line or 10 times the line, and the number is identical in both cases. The entire tail, the only part capable of destroying an institution or a person, sits outside the measure by construction. Worse, it is usually estimated from history, so a calm history produces a small number, making value at risk lowest just before crises and largest just after. And if a firm is managed to a value at risk limit, the way to take more risk without breaching it is to take risk the measure cannot see. Now the practical part, and in my opinion the most useful skill in this whole series. Position sizing. How much you commit dominates what you commit to. Someone with a genuinely good edge and reckless sizing goes broke. Someone with a mediocre edge and disciplined sizing survives long enough for the edge to work. Compounding requires survival as a precondition. So concentration versus diversification is a sizing decision, not a philosophical one. The question is not whether this is a good investment. It is how much of everything you have is in this one thing. Because a 50% loss needs a 100% gain to recover, a position big enough to cause a deep drawdown is far more expensive than it looks. My rule, labeled as opinion, size to what you can hold, not to what you can afford. A position sized so that a normal bad month makes you sell at the bottom has a negative expected return regardless of its merits. Formal sizing rules exist, but I will not quote a percentage because the thresholds people repeat have no common provenance. Rebalancing is the companion discipline. Winners grow into a larger share, so rebalancing sells some of what rose to buy some of what fell. Its defensible function is risk control. Without it, A portfolio silently concentrates in whatever recently performed best, which is typically the riskiest part. Whether it adds return is conditional, not automatic. And it is behaviorally hard, which is the point. Now asset allocation, and a piece of honesty worth more than the finding itself. You will hear endlessly that studies show asset allocation determines about 90% of your returns, so security selection barely matters. That sentence is wrong, even though the research beneath it is real. It is Brinson, Hood, and Biebauer, 1986, Determinants of Portfolio Performance. The paper correcting the popular misreading is Ibbotson and Kaplan, 2000, whose title is itself the argument. Does asset allocation policy explain 40, 90, or 100% of performance? I could not retrieve the originals to verify the percentages, so I will not attach a number. 3 completely different questions hide inside one sentence. 1. How much of the variation over time in a single portfolio's returns is explained by its allocation? Why was it up this quarter and down last? The great majority, and that is close to a tautology. Of course, a portfolio's ups and downs track what it holds. 2. How much of the variation between different funds is explained by their differing allocations? Why did this fund beat that one? Far less, because those funds hold similar mixes, and the differences come substantially from selection, timing, and fees. The misquote takes the answer to question 1 and applies it to question 2. It is the difference between saying the tide explains most of why the boat went up and down, and saying the tide explains most of why this boat beat that boat. That matters beyond pedantry, because the misquoted version is used to sell things, to persuade you to stop worrying about costs and buy an allocation product instead. The accurate version supports a better conclusion. Decide your mix thoughtfully, then minimize what you pay to hold it. Last, protection, and the thing almost everyone gets backwards. Compensation schemes are insolvency insurance on the intermediary. They are not insurance on the investment. They answer, my broker collapsed and my shares are missing, do I get them back? They do not answer, I bought a share and it halved. Let the schemes say it themselves. In the United States, the Securities Investor Protection Corporation, SIPC, states on its own website, quoting, SIPC does not protect against the decline in value of your securities. And SIPC does not bail out investors when the value of their stocks, bonds, and other investment falls. Its limit, the limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. Note 2 exclusions overlapping with this series, commodity futures and foreign exchange trades. In the United Kingdom, the Financial Services Compensation Scheme covers investments up to £85,000 per eligible person, per firm, for firms that failed after the 1st of April 2019. It pays, in its words, if a provider goes out of business and there's a shortfall in the money or assets it's holding for you. Its exclusion, verbatim, we can't accept any claims that are for poor investment performance. Unfortunately, the nature of investments means their value can go down as well as up. Deposits carry a separate, higher limit, changed recently, so check it yourself. And per firm does heavy lifting. 2 accounts at one firm share one limit. The European Union has no single fund. It has a minimum harmonization directive requiring each member state to run a scheme with a floor that states may exceed. I could not retrieve the euro figure, so I will not state one. But the structural point is underappreciated. Your protection depends on the member state your firm is authorized in, not on the European Union as such. Singapore is the sharpest contrast, and it may be your jurisdiction. Deposits are covered to 100,000 Singapore dollars per depositor per scheme member, with Central Provident Fund investment monies aggregated and separately insured to the same amount. But for securities, the model is different. It rests primarily on client asset segregation and custody rules rather than on a broad compensation guarantee. Do not assume an American-style equivalent exists locally. What protects you day to day is in fact segregation, the requirement that client money and securities are held apart from the firm's own, so that if the firm fails, your shares were never part of its estate. Notice the British trigger language again. A shortfall in the money or assets it is holding for you. That is a segregation failure. And segregation does not apply where you are a creditor of the institution rather than the owner of an asset. Structured notes, deposits above the guarantee. There you own a promise, and if the promisor fails, the promise fails, whatever the underlying index did. So, measure drawdown, not just wobble. Assume your diversification is weaker than the brochure claims. Never trust a risk number that cannot see the tail. Decide how much before you decide what. And know which of your holdings you own and which are promises you are owed. Next, the honest chapter. What the published evidence says about people like us once we start trading. Chapter 25. What the evidence says about you. This is the honesty chapter. Everything so far has been about instruments and the people who sell them. This one is about the person buying, which means it is about you and about me. Start with the study that founded the field. Brad Barber of the University of California at Davis and Terrence Odian of Berkeley obtained the actual position statements and trading records of households at a large American discount brokerage. Not a survey, not recollections, the trades themselves. The headline sample is 66,465 households, 1991 to 1996. It was published in the Journal of Finance in April 2000, under a title that gives away the conclusion: Trading is hazardous to your wealth. Here are the numbers from the paper's own abstract. Over that period, the market returned 17.9% a year. The average household earned 16.4% a year after costs, and the households that traded most earned 11.4%, while the households that traded least earned 18.5%. A spread of roughly 7 percentage points a year between the busiest and the quietest, in the same market over the same years. Now the part that matters more than the numbers. What caused that gap? Not stock picking. The authors are explicit. Before costs, the gross returns of the frequent and the infrequent traders were near enough identical. In their words, there is very little difference in the gross performance of households that trade frequently and those that trade infrequently. The average household's gross return was 18.7%, slightly ahead of the index. These people were not bad at choosing shares. The gap is the cost of trading, and the paper measures it. The average round-trip trade above $1,000 cost 3% in commissions and 1% in the bid-ask spread, the gap between the price you can sell at and the price you must pay to buy. Roughly 4% of the trade, gone, each time in and out. Then multiply by turnover. The average household turned over more than 75% of its portfolio a year. The busiest group averaged more than 250%. The author's conclusion, verbatim: it is the cost of trading and the frequency of trading, not portfolio selections, that explain the poor investment performance of households during our sample period. Now the caveats, and I want to raise them before you do. Commissions in the early 1990s were enormous compared with today, so the cost channel is weaker now for plain share dealing. That is the strongest good faith objection to using this study as a 2026 argument. What has not gone away is the bid-ask spread, the market impact of your own order, tax, and the awkward fact that cheaper trading induces more trading and pushes people towards riskier instruments. And this was a raging bull market, so the absolute numbers are period-specific. The relative gap is the finding. Which is why the Taiwan work matters more. The Taiwan Stock Exchange gave researchers something no American dataset offers: the complete trading record of an entire national market. Every investor, every trade. Not one firm's customers, everybody. That removes the sample selection worry entirely. 2 findings from that data, both peer-reviewed. The first is the single most quotable number in this series. Across the Taiwan market from 1992 to 2006, day traders with strong past performance did go on to earn strong returns, but only about 1% of all day traders were able to predictably profit net of fees. Notice carefully what that does and does not say. It does not say 99% of day traders lose money on every trade. Many have winning days, weeks, even years. It says roughly 1 in 100 demonstrates skill that persists and survives costs. For the rest, past performance does not predict future performance once fees are removed, the technical way of saying they cannot be distinguished from luck. The finding is two-sided and honest. A small group of genuinely skilled speculators does exist and does persist. So this is not a study saying nobody can do it. It says almost nobody can. Skill is real and vanishingly rare, roughly a 1 in 100 outcome among people already trading full-time. The second Taiwan finding is about scale. Looking at 1995 to 1999, and counting commissions and the transaction tax on sales, the aggregate trading losses of individual investors came to 2.8% of total personal income in Taiwan and 2.2% of the country's gross domestic product. Retail trading losses in one country equivalent to more than 2% of everything that country produced. That is not a rounding error in individual lives. That is macroeconomic. The composition of that shortfall is instructive. Individuals in aggregate earned about 3.8 percentage points below market returns, with roughly 3 equal contributors: commissions, the transaction tax, and the author's own phrase, perverse stock selection ability. Worse than random. That third one survives the arrival of zero commissions. One more finding, because it identifies a cause rather than a symptom. Using over 35,000 households from the same broker, the same two researchers found that men trade 45% more than women, and that trading reduces men's net returns by 2.65 percentage points a year against 1.72 for women. Handle that correctly. The finding is not that women are better investors. Both groups destroyed return by trading. Gender is a measuring instrument for overconfidence. The point is that the group with more overconfidence traded more and lost more. Confidence about markets is not correlated with being right about markets, and acting on it costs money. Now the argument that is stronger than any of these studies, because it cannot be refuted by a study at all. It comes from William Sharpe, Nobel laureate in economics in 1990, in a short paper called The Arithmetic of Active Management, published in the Financial Analyst's Journal in 1991. Every share of every company is owned by somebody all the time. Sort the owners into 2 buckets. Bucket 1 holds the whole market in market proportions and leaves it alone. Bucket 2 is everybody else, a hedge fund, a pension manager, or you on your phone at midnight. Bucket 1, by construction, earns the market return. Bucket 1 and Bucket 2 together are the market, so together they earn the market return. Therefore, Bucket 2, everybody who is trying must, as a group, also earn exactly the market return before costs. Now subtract costs. Bucket 2 trades, commissions, spreads, management fees, tax. Bucket 1 barely trades. So after costs, the average active dollar earns less than the average passive dollar. Sharpe's own words: the return on the average actively managed dollar will equal the return on the average passively managed dollar before costs, and will be less than it after costs. And on the status of the claim, these assertions depend only on the laws of addition, subtraction, multiplication, and division. Nothing else is required. That last sentence is why this is the most powerful thing here. It is not the claim that studies show active managers usually lose. That would be empirical, and you could imagine a decade where it happened not to hold. Sharpe's claim is an accounting identity about how a fixed pie divides. It cannot fail. You cannot refute it with a counterexample manager, any more than you can refute the statement that the average is the average by finding somebody above it. Be scrupulous about what it does not say. It does not say no individual can beat the market. It says active investors as a group cannot. Winners exist, funded by other active investors' losses, zero-sum before costs, negative-sum after. And Sharpe himself lists the escape hatches. The argument breaks if the passive managers are not truly passive, if the active group does not comprise every non-passive participant, or if you average across managers rather than weighting by the money they run. That last one bites in practice. If the passive benchmark is a particular index rather than every security in existence, funds tracking it must trade when the index changes its constituents, and so are not passive in sharp, strict sense. A real objection, not a quibble. So costs explain a great deal. What explains the rest? Behavior, and here the research is unusually good. The disposition effect is the best evidenced behavioral finding about real investors, the tendency to sell winners and hold losers, demonstrated from brokerage records by Odeon in 1998 and replicated across the whole Taiwanese market. It is doubly costly because in many markets selling a winner triggers a tax bill that could have been deferred by selling a loser instead. The psychology is plain. Realizing a loss forces you to admit an error, while holding it lets you believe the story is not over. Neither has anything to do with the asset's future. Overconfidence is the best supported cause. One paper is titled Volume, Volatility, Price, and Profit when all traders are above average, which is the whole argument. Another, Learning to be Overconfident, identifies the nastiest mechanism in the literature. Success breeds overconfidence because people attribute good outcomes to skill and bad ones to luck. So a beginner who happens to win early becomes more dangerous, not less. And in Finnish data, researchers used speeding tickets as a measure of sensation-seeking and found investors who collect more of them trade more. Attention explains what you buy. When you sell, you choose among the few things you own. When you buy, you face thousands of candidates, and no human can evaluate thousands, so the decision gets made from whatever subset attention has already selected: shares in the news, with unusual volume, or with an extreme one-day move. Individuals are net buyers of attention-grabbing shares. Institutions, using systematic screens, are far less susceptible. So your buy list is not chosen by you. It is chosen by whatever the media, an app's top movers list, or a social feed put in front of you. Then lottery preference, and one result I find close to conclusive. In Taiwan's stock exchange data from 2002 to 2009, during periods with unusually large lottery jackpots, individual investor trading declines. When the actual lottery gets more attractive, people trade shares less. The two are substitutes for the same appetite, close to direct evidence that a meaningful share of retail trading is the consumption of gambling rather than investment, and more convincing than any moralizing, because the investors revealed it themselves. And herding, individuals as a group make systematic rather than random buying and selling decisions. If retail errors were random, they would cancel out and be harmless in aggregate. They do not cancel. People pile into the same shares at the same time for the same reasons, which is why the losses aggregate to the scale seen in Taiwan, and why they can move prices and create the crowded conditions in which the losses happen. Noise versus a stampede. One more piece of honesty, because the literature is not unanimous. Retail trades do predict returns positively over 1 to 2 weeks and negatively over 2 to 12 months, while the average holding period is far longer than a few weeks. So the defensible claim is not that retail investors are stupid. It is that their trades contain a little real information and a lot of noise, and the noise wins. Now the conflicts of interest in both directions, because you should not take this on trust. Direction 1. Index and exchange-traded fund providers sell low-cost passive products, so every study showing active managers underperform is marketing for them. The organization publishing the best-known active versus index scorecard also licenses the very indices that passive funds track and pay for, so it earns more when index tracking grows. A structural conflict, and it should be named even though the finding is probably true. Direction 2. Brokers, contract for difference providers, options platforms, trading educators, and financial media earn from activity, not outcomes. A zero-commission broker is paid per order routed, so its revenue rises with your turnover regardless of your returns. Educators are paid whether or not the student profits. The conflicts are not equal in size. Direction 2 has far more money behind it and far weaker evidence. But apply the test both ways, and notice that the academic work carrying most of the weight here has no commercial sponsor on either side. That is exactly why it anchors the chapter. So what does the evidence support? Diversification, the closest thing to a free lunch in finance, and something real investors demonstrably fail at: holding shares in companies near where they live and in their own employer, putting job risk and wealth risk in the same place. Low cost, the strongest actionable item, because it is the only input known with certainty in advance. Not trading, which is this chapter restated. Long horizons, though the claim that shares are safe if you hold them long enough is genuinely contested. And tax efficiency, where the direction is confident even though the magnitude is unmeasured, because no dataset contains account-level tax liabilities. Notice what all of that has in common. It is boring, mechanical, and requires no skill. Own a lot of things, pay little, keep contributing, leave it alone, do not realize gains needlessly. None of it is what anybody pictures when they imagine becoming an expert in trading. Which brings us to the last chapter, where I have to answer for that directly. Chapter 26, Verdict and What Would Change My Mind. Let me close the way I opened, with my working shown, my confidence graded, and the specific things that would prove me wrong. The thesis of this series has been one sentence. The industry earns least from the products that serve you best and most from the products you cannot price. Here is the evidence for it, gathered across 25 chapters. A plain index fund tracking a major market charges around 5 basis points, 0.05%, on $100,000 that is $50 a year for owning a slice of thousands of companies. You can compare it against a dozen near-identical products in under a minute, which is exactly why it costs almost nothing. A structured note has no stated expense ratio at all. 2 finance professors repriced 69 of these notes from a single large issuer, worth over $2 billion, and found buyers paid on average an 8% premium over the estimated fair value of the components. And these were products typically called away after about 6 months, so that 8% was not spread across a lifetime. It came out of a 6-month product. Their conclusion, in their own words, was that buyers would have been better off in a bank certificate of deposit, and that the expected return was below the risk-free rate, not below the stock market. Below the risk-free rate. Be fair about that evidence. One product family, one issuer, one market, one period. It is not a measurement of every structured product ever sold. And disclosure has changed since. Issuers in that market now publish an estimated value on the issue date, which is itself a consequence of regulatory pressure on exactly this gap. So your takeaway is not to assume 8%. It is to go and read that number. Foreign exchange conversion is charged on almost every cross-border transaction you will ever make, and the international body coordinating this work has set a target that by end 2027, providers should disclose the total cost, including the currency conversion charge. Sit with that. The world's financial authorities have set a target, for the year 2027, that customers should be told what the conversion charge is. A target implies it is not happening now. Non-traded property vehicles have carried upfront commissions of around 9 to 10%, according to the securities regulator's own investor bulletin. Do the arithmetic aloud. If 10% goes to commissions and offering costs, then of every $100 you invest, about 90 is actually put to work, and the underlying portfolio must gain about 11.1% just to get you back to your 100, before any ongoing management fee, acquisition fee, or exit fee. And carry away the general principle. The size of the commission on a product is an excellent predictor of how enthusiastically it will be recommended to you. And at one of the largest banks in the world, in its audited accounts, roughly 81% of revenue came from lines carrying no visible charge to the customer at all. The interest gap, market making, where the profit sits inside the price, asset management fees deducted rather than billed, and card income paid by merchants. That 81% is my own arithmetic on their filed line items, not a figure the bank publishes. But it is arithmetic on numbers they were legally required to file. 5 different corners of finance. One pattern. Transparency drives price towards zero, opacity preserves margin. Now let me tell you where my thesis does not hold. because a claim that survives no counterexamples is not a thesis, it is a slogan. It does not hold for plain exchange-traded funds. They are cheap and they are good. The product that costs the industry the most in lost margin is also, for most people, the most sensible default. My framing would predict tension there, and there is none. It does not hold for net interest margin. The gap between the policy rate and your savings rate is the single largest profit line in banking, far bigger than any fee in this series, and it is not hidden. The rates are published. Anyone can look. The problem is that almost nobody does, and inattention is not the same thing as concealment. And it does not hold for all complexity. Securitization genuinely lowers the cost of a mortgage. Some derivatives genuinely move risk to parties better able to carry it: the airline that fixes its fuel cost, the exporter that hedges a currency, the pension fund matching a long liability. Those are not victims of financial engineering, they are its intended beneficiaries. Complexity is sometimes extraction, and sometimes it is engineering, and you cannot tell from the outside without asking. The failure mode is not complexity itself. It is complexity sold to somebody who has no risk to transfer, and who is therefore, without knowing it, standing on the selling side of an insurance contract. So the honest verdict is narrower than the slogan. It is not that complexity is fraud. It is that complexity removes your ability to check the price, and wherever your ability to check the price is removed, the margin reliably grows. That is a claim about information, not about morality, and it is testable, which is the point. So here is the framework I would actually give you. 6 questions. Ask them of anything anyone ever tries to sell you, including things that have not been invented yet. What is the all-in annual cost in money, not percentages? Not the headline fee, the ongoing charge, plus the fund's own dealing costs, plus the platform fee, plus the spread you pay going in and coming out, plus any currency conversion. Then make them convert it to cash. 1% on 100,000 is $1,000 a year, every year, whether you gain or lose. Percentages hide, money does not. A person who will not tell you what 1% is in dollars on your balance is telling you something. Who is paid for putting me into this, and how much? In one jurisdiction, the regulator publishes that trailer commissions can run from 20 to 60% of the management fee, flowing back every year to whoever recommended it, whether or not they ever speak to you again. In others, commission to advisors has been banned outright. Ask which world you are in. That is not a scandal. It is a disclosed structure, but it means the person advising you may be paid more for advising you badly. What is the worst case, not the expected case? Not the illustrative scenario in the brochure. The worst one. For a leveraged product that might be a fund falling 53% while its index rose 8%. For an unallocated metal account, it is that the bank fails and you are an unsecured creditor rather than an owner of metal. Who is my counterparty and what happens if they fail? For a fund, the assets are usually ring-fenced. For a structured note, you are lending to the issuing bank. Those are completely different risks wearing similar marketing. Can I sell it to whom and at whose price? If the only buyer is the institution that sold it to you, there is no market, only a quote. And could I explain this to someone else? If you cannot, you do not own it. It owns you. Now, the things you did not ask about, ranked by how expensive the ignorance is. This came out of the research, and it surprised me because none of the top items are instruments at all. Fees and total cost of ownership rank first. 2% a year consumes roughly 42% of your gross gain over a long horizon. No instrument choice in this series matters as much as that arithmetic. Tax ranks second. Withholding on foreign dividends, the treatment of gains, the domicile of a fund. Silent, automatic, and larger than most people's alpha. Inflation ranks third, because a nominal return you feel good about can be a real loss. Interest rates rank fourth, because they are the price of everything else. They set what a bond is worth, what a company is worth, what your deposit earns, and what your mortgage costs. Only after those come bonds, exchange-traded funds, foreign exchange, pensions, property, and everything else you listed. Which brings me to the thing I owe you, and I want to say it carefully because it was in your brief, and it deserves a straight answer. You said that once you had listened to all of this, you would have to be an expert in trading. I do not think that is true, and I would be doing you a disservice if I let the last chapter imply otherwise. Here is what I think this does give you, and I do not want to undersell it because it is genuinely rare. You can now read a term sheet and identify what you are actually being sold. You can decompose a structured product and see the option you are selling. You can compute what a fee does over 20 years. You can look at a leveraged fund and know why it decays. You can ask who your counterparty is and what happens if they fail. You can spot when the invisible cost is 19 times the visible one. You can tell the difference between an investor protection scheme covering a broker's failure and one covering your losses, which almost nobody can. That is financial literacy, and most people who work in finance are less literate than that across this many instruments. I do not say that to flatter you. I say it because literacy is what lets you refuse a bad product, negotiate a fee, choose the right account before you choose the right fund, and, hardest of all, not be frightened out of a sensible position at the worst possible moment. It is rarer than it should be, and it is worth more over a lifetime than any trade you are ever likely to place. But trading skill is a different thing, and the evidence on it is unkind. In a study of about 66,000 households, the most active traders earned around 11.4% a year against 18.5% for the least active. In Taiwan, only about 1% of day traders were found to profit predictably after fees, while aggregate retail trading losses ran to roughly 2.2% of the country's entire economic output. In leveraged retail products, regulators require brokers to publish the share of accounts that lose money, and the published figures run from about 74 to 89%. None of those people were stupid. Many were highly educated. Several had read more than this. So the honest answer is that this series can make you literate, and literacy is what protects you from being sold badly. Expertise in trading is not conferred by listening to anything, including this. And the most useful thing literacy tends to produce is not more trading, but less of it. Now, what would change my mind? If a large, well-designed study showed that retail investors who trade actively, after all costs, reliably beat a low-cost, diversified benchmark over a full market cycle, the core of what I have argued collapses. I do not expect it, but that is the test. If fee compression reversed, if the transparent products started getting more expensive rather than cheaper, my claim that transparency drives price toward zero would be wrong, and I would need a different explanation for the pattern. If the opaque products started reliably delivering returns that justified their embedded margin, then complexity would be earning its cost rather than extracting it, and my framing would be unfair. And if a jurisdiction mandated full disclosure of foreign exchange spreads and structuring margins, and customer behavior did not change at all, then my assumption that people respond to visible prices would be wrong, and the whole story would need rebuilding around something other than information. Two more, specific and dated. If the 2027 transparency target is met, conversion charges become visible and comparable at the point of sale, and the spreads then compress. That confirms my mechanism while removing one of my best examples, and I will say so out loud. And if index fund fees started rising materially now that the market has consolidated into a handful of enormous providers, my whole framework would need revisiting, because it assumes transparency plus competition drives price down and then keeps it there. Watch for those. They are the shape of me being wrong. If you ever hear me hold this thesis while one of them comes true, stop trusting me. I said at the start that nothing in this series is financial advice, and I want to end on that rather than soften it. I have not told you to buy anything. I have not told you what to hold, or in what proportion, or when. I do not know your circumstances, your obligations, your tax position, or your temperament, and anyone who offers you a portfolio without knowing those things is selling, not advising. What I have tried to give you instead is a standard. Follow the money, Ask what it costs in dollars. Ask who is paid. Ask what the worst case looks like. Ask who is on the other side of the trade, because someone always is. Do that consistently, and you will avoid most of the ways people lose money in markets, which, on the evidence, has always mattered more than finding the ways they make it.